Good morning and welcome to ABG Investor Day. Today we have 34 companies presenting on two live and two parallel tracks. And the presentation will also be available afterwards, both on YouTube and Introduce. During the day, we'll have a short lunch break between 12 and 12:30. And then the presentations will continue until 5:30 this afternoon. Myself, my name is Max Bacco, and I'm an equity research analyst here at ABG within industrials. And with that said, we will start off today with Nordic Waterproofing and CEO Martin Ellis. Martin, please go ahead with the presentation.
Thank you very much, Max. It's a pleasure to present Nordic Waterproofing Group to you. Thank you very much all for your interest, for dialing in. We are a producer and installer of building and infrastructure solutions. Moving on to the next page, I'm going to make a quick recap of our life over the last 10 years. We've been constituted 10 years ago by putting two pieces of similar businesses together, one from Trelleborg, non-strategic, and the other from Lemminkainen in Finland. And we created Nordic Waterproofing in that way in 2011 by merging. We made a few acquisitions in the years after that, but the key date is our IPO in 2016 on the Stockholm Nasdaq. And from then on, we increased the speed of our acquisition drives. We made a number of acquisitions in Finland, in Benelux, in 2017. In 2017 and 18, we created our prefab elements, wood-based prefab elements business in Denmark and Norway. In 2018, we entered the green infrastructure business with the acquisition of Vegtech in Sweden. Basically green roofs and green areas in urban environments. In 2019, another acquisition in Benelux, Ponds and Landscapes, again geared towards sustainable solutions, especially for individual homes. In 2020, we re-domiciled our parent from Denmark to Sweden. It's a sort of an administrative move, but didn't change our business model, of course, at all, but made it basically easier for our Swedish shareholders receiving dividends. And in 2021, we again accelerated our acquisition drive, which was a bit slower in 2020, by making 6 acquisitions so far this year. Moving on to the next page, I want to emphasize that our business case is built on sustainability. First of all, in our traditional legacy business of waterproofing, we make and install materials which are on the roof at least for 50 years. So that in itself obviously contributes to a lower environmental footprint. We also improve the CO2 balance with wood-based solutions. All of our prefab elements are made from wood. Wood, as you know, captures CO2 as opposed to traditional solutions using cement, which emits a large quantity of CO2. So we think that's an important contribution to reducing the global warming effect. We also promote biodiversity through the green infrastructure products. And last but not least, we have a solar panel installation business in Finland, which also contributes obviously to clean energy. Moving on to the next page. This gives you an illustration of basically where our products go on the building. On the left, you see a flat roof. That's the biggest part of the demand we are serving. And we install obviously waterproofing products, green infrastructure, we just mentioned, solar panels. So pretty much all different options on a flat roof we're able to provide. On the right, you see a pitched roof. And again, we provide a number of products there. You can also see the facade of the building, which is made of prefabricated elements. The advantage of these prefab elements, obviously, is that they are much faster to install on the job site. It's difficult to find workers on job sites, especially these days. So the speed of installation by prefabricating the whole functionality, the doors, the insulation, the windows, etc., makes it much faster on the job site. And that's a trend we've seen for a number of years, and we're confident it will continue and take market share in the future. Moving on to the next page, this describes our installation business. So the previous slide showed basically the products we are making ourselves as an industrial company. Here you see an illustration of what we install as an entrepreneur. So traditionally we are subcontracted to the main contractor when we install our waterproofing material on roofs. Main contractors usually don't do that themselves. We have the prefab elements we just talked about. We also make flooring solutions on both buildings, parking lots, and ships. Green infrastructure we mentioned. We have metallic facades and eaves, a recent acquisition, and the solar panels we install ourselves. We also have a business where we clean roofs that started in Finland very successfully, and we've now copy-pasted it to Sweden. So we also in Sweden are able to clean and repair individual home roofs. Again, service in general is a growing business in the sense that people tend to subcontract more and more and insource a number of products and services regarding their homes. Moving on to the next page, we have a footprint which is centered, obviously for historic reasons, in the Nordics. So we have significant market share in the 4 Nordic countries, between 20 and 35% in our legacy business. But we also have plants in the UK, in Benelux, and in Poland. These are mostly linked to our EPDM synthetic rubber waterproofing material. The bitumen-based waterproofing material doesn't travel that far, so usually you serve around your plant about 500 kilometers. In the case of the synthetic rubber material, which is an alternative waterproofing solution, the material is more expensive and travels basically throughout Europe without any problem. So what we do is we send the material to Benelux, for example, and then we prefabricate the roof again. It's a solution where you can do with synthetic rubber, where you cover the entire roof in your plant and then ship the material and install it very quickly. In terms of our exposure to new build versus renovation, we're about 50-50. That gives us good stability. Renovation obviously is a very stable demand picture. New build can be a bit more cyclical, but basically in the last 10 years we haven't seen any dramatic cyclicality. We've seen a housing boom in Denmark 6 years ago, but all in all the demand picture also in new build is quite stable in Scandinavia. Next slide shows you the contribution we make to sustainability. I've touched upon that. First of all, the long-lasting nature of our material in itself is a favorable factor in terms of sustainability. The second factor, which is not as well known, which is important, is that our material is basically keeping the insulation material dry. And insulation material is only functional as long as it's dry. If there's water leaks, if the insulation material becomes wet, it doesn't insulate anymore. So a very important factor. We also use a certain amount of bitumen, and bitumen basically is a material which is considered waste in the refinery. The refineries try to produce as little as possible of it, as opposed to gasoline and jet fuel, etc. So using that material in itself avoids putting it to waste, burning it, and our industry is the only one with the road builders who is able to use bitumen. The next item we talked about, we capture a lot of CO2 in the wood we use for construction, and basically CO2 remains in the building as long as it stands. So a much better solution than traditional materials. And the green vegetation service I mentioned, those promote obviously a green look, but maybe more important, they help to absorb heavy rainfall. We've seen recently in Europe that that's a growing problem in cities especially. So our green vegetational surfaces help slow down the water introduction into the sewage system. So contribute to reducing flooding. Next slide shows the ESG aspect of our business. We've described the sustainable solutions drive. We also have emission reduction targets. We basically target zero CO2 emissions for scope 1, 2, and 3 at the latest in 2050. We also have a target of reducing scope 1 and 2 emissions to zero at the latest by 2030. We also use already today 100% recycled polyethylene in our carrier. The carrier is basically the plastic textile which we impregnate with bitumen and SPS to make our core products. So already now we use basically recycled plastic bottles in that important material. And we comply with a number of international regulations you can see here. One specific initiative we have in Denmark is a training program for roofers, basically for young people who have trouble finding a job, finding a profession. And that's been very successful. We also rank quite highly in best place to work surveys, which we participate in. So we are regularly pretty well positioned in the quality of our work environment. And that's really important for us. Next page, we show the strategy. As you probably know, we have a pretty active acquisition strategy. We've doubled our sales over the last 5 years since the IPO, and a lot of that is due to the acquisitions. The strategy there is to focus obviously on sustainable solutions. Almost all of our acquisitions have been centered on that. We also want to expand our product and service offering to our existing customers and basically be a bit of a one-stop shop when it makes sense. And the third aspect, again, is linked to our synthetic rubber material, where we have a downstream integration strategy, where we, as I mentioned, buy shops in different European countries, which are going to use our EPDM rolls and then prefabricate roofs to make a quick installation. In 21, we've made 6 acquisitions in waterproofing contracting, which is a business where we are present mainly in Finland and Denmark, but we've made 1 acquisition in Norway in that area. Ponds and landscaping, which use our synthetic rubber material in Holland. Prefab wood elements in Finland, urban green landscaping in Sweden, liquid floor coating in Finland, and pre-made eave systems in Finland. So 20 plus acquisitions since the IPO and basically doubled our turnover. Following slide gives you a more focused information about the first half of this year. What we see is, in spite of the COVID, and you're probably aware of that very well, demand remains strong. We have had strong input cost inflation, but we're able to pass it on to our customers. We might not indefinitely be able to do that. So if we see further input cost inflation accelerate again, we especially have a bit of a time lag in passing it on to our customers, so we might have a negative effect in the remaining part of the year. The main risk we see right now is delays in job site execution. What we see is that some materials are not being supplied. We have been able to supply our material throughout until now, but we see that some complementary product categories are in short supply, and we start to see significant impact of that, especially in Finland. So we see especially new build projects being delayed because some components are missing. We have created a Chief Sustainability Officer a few months ago, obviously illustrating our focus on sustainability, and we are going to continue to obviously to put a significant emphasis on that. And as we've shown, this is basically favorable for our business. We have made sort of above average number of acquisitions in the first half, and we're not sure that we're going to continue at that pace. The focus is to remain disciplined in the multiples we pay, and we're not ready to make acquisitions, obviously, just for the sake of it. Next page gives you some more figures about how we've performed. So I would say so far so good. We have had a very good performance again in the first half of the year after quite strong last year, 2020. So basically we are above our performance thresholds. If you look at the right side, we have ROCE at 16.8%. We have a threshold value which we want to always attain is 13%. So right now we're significantly above that. And our balance sheet remains very solid, so we are financially able, of course, to make additional acquisitions. Next page gives you a reminder of our financial targets. We want to grow faster than the market, and we've achieved that over the last years. We've been able to gain some market share especially in our legacy business. In terms of profitability, I mentioned we want to hit at least 30% in terms of ROCE. We've been able to do that. And the capital structure, we want to be close, but not above 3 times debt on EBITDA. Right now, we'll probably finish the year again below 1. So we have room to take on additional debt. Dividend policy, 50% of net profit at least, and historically we've been between 55 and 60% of distributed net profit, and we intend to continue that rule. Next page gives you a summary of why we believe Nordic Waterproofing can be an attractive investment. We have strong market positions in our core business. We usually have about 30%, 30 to 35% of the market. And that gives us a certain amount of pricing power. Usually we have 3 to 4 competitors at the most in our legacy business of waterproofing material. And historically we've been able to pass on cost increases to our customers. We have a very close relationship, especially with our contractor customers. We are a reliable partner. We give them top quality product. Our logistics and delivery speed is second to none, and that's really important for our customers. And we also help them with a number of legal, marketing, personnel issues they might have. We're talking about relatively small companies, and they're happy to receive some support from us. So a very solid market position. Our solutions are sustainable. That's really critical, and I think will continue to give us an advantage in the future. We have low cyclical sensitivity, as I described in the beginning. Our balance sheet is strong, and we still have a relatively attractive yield in terms of the dividends we pay. So that is a short description of who we are, and I'm very much looking forward to your questions now.
Yes, thank you very much, Martin, for the presentation. And as you said, time for some questions. So first off, you have talked some of becoming more of a one-stop shop for your customers. Could you perhaps elaborate on what types of products and services you would like to add to your current offering?
Yeah, first of all, in terms of products, there's a number of examples, which is with this metal fixing, which are used in roofing. There's some details, specific products which go on pitched roofs, which we've added to our portfolio. In terms of services, maybe that's even more important. What we increasingly do is we have maintenance contracts with our customers. So basically, they can basically forget about their roof, and we take care of maintaining it and guaranteeing that it works for even more than 50 years. We also have a number of services for individual homeowners. I mentioned the cleaning roofs. We also have for individual homeowners the pond solutions we provide, where we basically promote swimming ponds, which are ponds where you don't need chlorine, which are basically self-sustaining with vegetation. We do that in Benelux, but we are ready to expand that geographically. So that's just a few examples. So you could argue it's bits and pieces. It's not huge pieces in our offering, but we're constantly on the lookout to add additional products and services there. Okay,
and as you mentioned during the presentation, you have finalized 6 acquisitions this year, which is quite a lot. But looking historically, M&A activity for you have been rather volatile, with a few years of high activity, followed by some low activity the following years. Would you say that this is a result of your end markets or internal strategy? And what should we expect going forward?
Yeah, that's an interesting question. Actually, we've had one really slow year, that was 2020. During the other 5 years since the IPO, we've made a number of acquisitions every year. So that's really the norm. But as you know, multiples are relatively high, and we don't want to overpay. So that's obviously a challenge, and it explains why in 2020 we just made one acquisition. So we want to remain disciplined. We usually avoid auctions, and we focus on small to medium-sized targets, usually family-owned. And the trigger quite often is a generational shift, where the family wants to make sure the company has a future within a large organization. And that's obviously totally unpredictable. Either it happens or it doesn't. We don't have a big influence on that. So that explains why we have these waves. So it's an opportunistic strategy, but it means that we talk about cheaper multiples, and we talk about relatively easy to integrate companies because of a relatively low size.
Okay, and finally, what is your view on the technology development in your industry? Will bitumen products remain for a long time to come, or is progress being made on developing non-fossil-based alternatives?
Yeah, again, an interesting question. What we see is that there are competing materials to bitumen. Bitumen is still the dominant solution, but you have the synthetic rubber we produce ourselves. You have PVC, TPO. All of those are oil-based. So in that respect, there's no way around oil-based solutions. What we see is a stable situation now in terms of market share of these different materials. So we don't see bitumen reducing its market share. In some European countries, EPDM, the rubber is already quite dominant, and there's some market share gained by EPDM, but basically not in the Nordics. So we believe there's no way around bitumen from a technology point of view. It's the only affordable waterproof material. The same goes, by the way, for roads. It's very difficult to replace asphalt on roads as well. So we believe bitumen has a solid long-term future.
Okay, perfect. That was all from me, and I think we are running out of time as well. Thank you very much for joining us here today, Martin, and good luck going ahead.
Thank you very much, and thank you for all listening in.
Bye. Bye.
Bye.
Hi and welcome everyone to today's presentation of Projektengagemang. My name is Stefan Knutsson. I'm an equity analyst here at ABG covering the name, and with me today I have the CEO of Projektengagemang, Helena Hed. Welcome.
Thank you very much. So this is a really nice day because I'm going to tell you all about Projektengagemang and our journey. So if you go to the next slide, please. Today, I'm going to talk about our focus forward, our focus to become the leading company within buildings in Sweden. But first, if we go to the next slide, I'm going to tell you about the agenda for today. As I said, we're going to talk about us being the leading technical consultant with a focus on buildings. But first, I want to tell you a bit about our journey and the trends for our company. We're going to look for the financial summary during the last 12 years and also looking for 2025, our ambitions going forward. And then we're going to have a summary, and afterwards Stefan will be able to ask any questions he wants. So if you go to the next slide, please. This is our journey. Projektengagemang started in 2006, and we had a really nice journey during these last years. First with the startup phase, then we grew, we built this critical mass, and today we have a stable platform, a good foundation for future growth. Projektengagemang, we are a multidisciplinary engineering company, and we have all disciplines you need to create a sustainable future and to create it together. We have the architects, we have the engineers, and we have the specialists that are needed to create the future of tomorrow. We work with innovative and sustainable solutions, and we help more than 4,000 clients every year in more than 13,000 assignments. We have, as I said, engineers, we have the architects, and we have the specialists, and we are shaping cities and societies of tomorrow. And looking at this picture, you can see that we had a really nice growth during the years from startup phase until today, and we have this great potential going forward. So if we go to the next slide, please. I want to show you our share price development since we got into the stock market. As I said before, we have grown organically, but we also grew through acquisitions, more than 50 different companies that came into Projektengagemang, to this company that we are today. We are building strong teams, local teams, and you can find us all over Sweden. Our culture is strong, and it's built on focus to be entrepreneurs, to be strong and to be quick. So we have this strong platform going forward. So if you go to the next slide, please. This is our financial summary during the last 12 months. And if you look to the EBITDA, it's been 60.6 million. Last year, we had an EBITDA on 78 million. Our margin during the last 12 months been 5.7%, and 2020 it was 6.7%. During the last years, we have really focused on strengthening our financial position, and today I can say it is strong. We have a strong financial position, which is good. And looking at our net revenue, it's decreased compared to the last year, and it's actually due to both the pandemic and due to missions we did the last years to enable the platform that we have today. We, for instance, took away underperforming units. So if we go to the next slide, please. Today we have this really strong platform, as I said. And to begin with, Projektengagemang, we have fantastic employers. And for me, it's so important that people working at Projektengagemang, that we are satisfied, that we have the best workplace. And we can see that the employee satisfaction is increasing all the time. And we are measuring this every week. So the employee satisfaction is increasing. And that's also the turnover per consultant. So every consulting is having a greater and more bigger turnover compared to the last year, which is very good. We can also see that the earnings per consultant is increasing. And that is due to the utilization rates, which is also increasing. So as I said, we have this strong platform, it is in place, and now we're going forward, focusing on the journey towards 2025. So if you go to the next slide, please. We have this big trends which are driving the development of the society. And you know all about this. You know about the urbanization, the digitalization, you know about the sustainability. And we are working in these areas. We work in cities and to enable the urbanization to create a safe and a strong society. Looking to the digitalization, we are in the front line working to enable the digitalization. And looking at COVID, we can look in the mirror, in the behind, and see that we could go through this pandemic thanks to the digitalization and still help our clients every day in a very good way. And very important for me and for all my employees and for the company is that we work with sustainable and innovative solutions to create the future of tomorrow. And this awareness that we have, it is actually growing the need of consultants, growing the need of engineers, of architects, and the specialists, which you can find in Projektengagemang. So these trends, which is driving the development of the cities, it's also enable us to grow in the future. So if you go to the next slide, please. This is our ambition. By 2025, we, Projektengagemang and PE, as we are called in Swedish, we will be the Swedish leading technical consultants, and we are focusing on buildings. And when I say we focus on buildings, I say that our offer is wide, it is high, and it is sustainable. And when I talk about wide, it's both all the skills we have and also the broad client base that we have and this wide range of projects that we do every day. As I said, more than 13,000 assignments each year. And when I say high, it's not just building the tall buildings. You can see one of them on the picture in behind. We are working with the most prestigious buildings in Sweden. But it's also the high level of competence which we have in the company, which I'm very impressed of. I've been here for 8 months, and every day I get impressed of the employees and my colleagues. And also, as I said before, the sustainability. It's very important for us that our solutions, the way we help our clients, it has to be sustainable solutions, innovative solutions, so that we together can create a better future, better cities, and better societies. So this is our ambition, and for me it is very strong. We've been talking about this a lot in the company. We will be Sweden's leading technical consulting, and we're focusing on buildings. So if we go to the next slide, please. If we look at our focus going forward, there are 5 things I would like to talk about. First of all, for us, it's very important to be a committed partner, a long-term partner with our clients. We want to help them. We want to understand their needs so we really can give them the best solutions on their problems. Also, we will develop and we will grow in our areas where we are specialized. So that's a focus for us. Also, we are a learning and creative organization. My colleagues, it's so important that we develop ourselves every day. So we are focusing on learning a lot. We're learning in all the assignments we do. We're learning together with our clients. And also, we will every day contribute to combat the climate change. That's in our vision, and that's also our ambition. And finally, to be a partner, this long-term committed partner, we also use the digitalization and new technology so we always can give the best help to our clients, but also to be this creative and learning organization to create the highest client value and to be the best workplace. And this will give us long-term profitable growth. So if we go to the next slide, please. This summer, when we presented the second quarter, together with the board, we set new financial targets and we told them about them with the second quarter report. And these new targets, they actually reflect the full potential that we have. We will achieve them over time, but latest at 2025. So we increased the targets looking at our EBITDA margin. So we will perform at least 10% EBITDA margin over time. And we also will grow 15% over time. We'll grow organically, but it will also include acquisitions. We also set a new target looking at our net debt, and it will not increase 2.5 times EBITDA. And looking at the dividend policy, it is 30 to 50%. So this organization would focus on focusing to be the best partner, a committed partner, which gives employees the best workplace. That made us take this new financial targets to raise them to aim higher. And as I said, we will reach them over time, but latest at 2025. So 10% EBITDA margin, 15% yearly revenue growth, net debt 2.5 times EBITDA, and a dividend policy of 30 to 50%. So if we go to the next slide, please. If we make a short summary and also an outlook going forward. Over time, Projektengagemang, we have had stable margins. These stable margins, they are a strong platform for us. As we've seen over time, we have an improved order intake. And for instance, June this year was the best month looking to order backlog and growing orders. So we can also see an increased market activity. We felt it, we saw it, we recognized it before the summer, and we can feel it. And we have a really good order intake now during the first start of the third quarter. So the market is getting stronger. We can see that our revenue is impacted by the fact that we are fewer employees in 2021. We came into 2021 with fewer employees due to COVID-19, due to having people in short-term commitment, but also due to the organizational changes we made during 2020, but also 2021. But what we see now, we see growth. And during this year, we welcomed 110 new employees to the company. And we will see the organic growth coming back when we come to the end of this year, beginning of 2022. Our focus is profitable growth. We will continue to focus on growing. It starts with clients who needs us, who wants our help, with the employees, they really like the company and they want to stay long at the company. That enables the profitable growth and also shareholder value. So for us, it's important to create this long-term profitable growth and shareholder value. And these new financial targets that we set, they really reflect our true potential going forward. By 2021, Projektengagemang will be the leading company within buildings. And we do everything within buildings. We work with hospitals. We help industries creating their new buildings. We work with schools. We work with commercial buildings. We work with the buildings where people want to live. So everything which is in and around a building. And that's our main focus and our ambition, to be the leading company within building. And we have, as I said, we have the engineers, we have the architects, and we have the specialists going forward, creating solutions for sustainable city and sustainable societies for tomorrow. So that's Projektengagemang and our journey. It started in 2006, and today we have this strong platform going forward. This platform which will enable growth with the new financial targets, with a position on the market which is strong today, and we will take an even stronger position tomorrow. So for me, as the president and CEO of Projektengagemang, I'm very proud. I'm very happy to be on this journey, and together with all my employees, we will ensure that we will get to the full potential of this company. Thank you very much. Stefan, I'm really interested to see if you have any questions.
Of course I do, and thank you for the presentation, Helena. You're now looking ahead after the COVID-19 struggles of 2020 with new financial targets. Among them, you have a raised EBITDA margin target. What will you need to do in order to reach that new margin target, would you say?
Our focus is growth. That is very, very important for us. We will grow both organically and with M&As. And when we're growing, we can also take an even larger position on the market, and we will also raise the margins. And of course, the utilization rate is important for us.
So you think you can reach there by only increasing the utilization rate, or do you need to also do some other measures in order to reach 10%?
What we've done during 2020 and before, we've been focusing the organization. For instance, we took away one management level. We've been focusing on building this really, really strong platform. So during 2019, we did big measurements to enable this growth and also to enable a new margin level. So yes, the utilization rate and the growth, and of course the time rate, but we're increasing the time rates and are really proud of that.
Perfect. And now we're also in mid of September. How would you say that the demand for your service and the market in general is shaping up after the summer?
I think it's growing. We can see that our clients' activity is increasing a lot and the needs are very big. We can, for instance, see that a lot of companies are looking at their office and considering what will we do in our office next year and going forward. So we are there helping them to find the best way to use their houses, their buildings. We can also see a big demand going for hospitals, for instance, going for schools, going for residential buildings. So the demand is increasing, and we can also see an increasing activity. And one thing which I think is important to say, that we can see this within the architecture part, and architects are often quite early looking at changes in the market. So I see a good and strong market position and a good strong market development going forward.
Perfect, sounds promising. And have you also seen any change to the elevated staff turnover that we have seen in the industry post COVID-19?
Sorry, can you say that again? Can I see a change in...
After COVID-19, we saw an increase in staff turnover in the industry in general, mostly or probably because people didn't switch their jobs during the 2020. But have you seen any change to that pattern in now after the summer, that the staff turnover has decreased again?
We can see that in the whole market, it's been a lot of activities. And we've seen that it's been a lot of people changing jobs. What I can see in our company is that the personal turnover is decreasing, and we're, for instance, in August, we had 35 new employees that we welcomed to the company. So we can see a decreased turnover and an increased personal growth.
Good. And then I also am curious about, you mentioned sustainability among your offering. And as we all know, buildings can have a rather high carbon footprint. Can you tell us more how you can help your customers to decrease this footprint in the future?
That is very true. Like, looking at Sweden, 20% of the carbon emissions come from buildings. So 20% of the footprints is within our main focus. So what we can do is to create sustainable solutions, for instance, to make the life longer for a building, to ensure that we can reuse the building, but it's also to ensure that we can work with energy efficiency. It's to enable also a secure society for people living in areas or working in areas. So we want to be in that area for a longer time. So that's a few examples to ensure that the buildings live longer. We can, for instance, make them taller, we can make them wider, to change them during time, looking at efficiency to decrease the footprint when we use the buildings, and also to create sustainable solutions so people want to be in the area for a long time. So 3 things which is important looking at sustainability.
And how much of your business is towards newly built buildings, and how much is towards refurbishing old buildings?
We work with both parts. We work with new buildings, we work with new areas, but we work a lot with buildings that are already here today. I can't say the numbers, sorry, but we work with both parts of it. I'm going to look it up.
Perfect. And then lastly, where would you put yourself in your journey towards your 2025 ambition as of today?
I see myself and our company, I really see that we increase our position. I see that everyone will know about Projektengagemang and PE. I see that we are this long-term committed partner. And today we're one of the 10 leading technical consultants in Sweden. I want us to be the best within buildings.
Okay. Thank you very much, Lena Hed, for coming and presenting with us today.
Thank you.
Hello, and thank you for tuning in to today's ABG Introduce Investor Day. My name is Victor Kruger. I'm an equity analyst for ABG's real estate and construction team. It's my pleasure to introduce our next company presenting today, a real estate company with a quite distinguished business model. CEO Tommy Johansson, please feel free to walk us through Svenska Nyttobostäder.
Thank you very much, and I'm happy to be here today. Svenska Nyttobostäder, if you can take the next slide immediately. If we just take a quick little snapshot of the company in brief, we are a real estate management company with only residential assets in only Stockholm area, which makes us quite unique. We was established at 2013 as a subsidiary to Alm Equity in order to take care of the company's focus on more real estate management and being the business branch in Alm. As always, when we work in Alm Equity, we develop things in company with the external investors, and so it was also in this branch. But at 2020, we took a big package together, and that made the starting package for the noting in Nasdaq First North Exchange. Alm Equity is still the largest shareholder. When we took that package and put it together, we took as many as 29 of our properties, both existing and non-existing, and packaged that together with a total value of 11.8 billion Swedish kronor and with a net profit of 600 million to be in the year 2025. And also this is a very unique standpoint for a company as ours. As of per the Q2 figures, we have 2.5 billion out of those 11.8 billion in our management. A total of almost 900 of those apartments are in management. We have fully let all of our apartments and all of our stores. And in construction, we have about a little more than 2,000 units or apartments, and a little more than 2,500 is going into production this year and the coming 2 years. You can change the slide, please. As stated, we are a very unique company with a very niched special business concept and target. And the idea was born almost 10 years ago when we saw a very large imbalance and a gap between supply and demand for smaller homes in the Stockholm region, especially in the Stockholm region, where you can see in the picture to the right that 3/4 of the people living and demanding the apartments in Stockholm have about 20% of the market. That would mean up to 50 square meters apartments. And if you also take up to 60 square meters, is only 1/3 of the available apartments. So we saw a very large mismatch and a very, very strong demand. And also in 2017, when the FSA introduced the new rules, which led to the restricted lending by banks to ordinary people, this imbalance were very, very much accentuated. And that meant a large acceleration for our business model in total. And well, as I said, this acceleration has been made possible through the very tight work together with external co-investors. You can take the next slide, please. As I said, the big management portfolio makes us unique because we have already acquired almost 6,000 apartments, whereof 900 of those are in management right now. All of these apartments are in the Stockholm region, as you can see on the map. And also, the business model is that all of these apartments are acquired at a fixed rate with a fixed yield already in hand. So we take no risk at all. You can take the next slide. As you see of the pipeline here, we have like a very smooth, if you can say smooth, with several thousand apartments line where we take in about between 500 and 1,500 apartments every year. That means a growth rate of almost 550% within the 5 years to come. And that makes us super unique. And also, since we have acquired these at the fixed rate, we have, as I said, a very, very low risk. As seen on the right, you can see the pipeline too. And the NOI is about 600 million when we come to the end of 2025. You can take the next slide. As I said, we have no development risk in our business model and the business that we made with Alms MOA last year. The acquisition was made with a fixed price, and all of the building risks and the supply risks are at the seller. On our hand, we have the risk of the financial. That would mean if, for example, properties in Stockholm would drop or something like that, and also the financial risk. How the setup was that all of the external investors, together with Alm Equity, committed to the own capital, to put in the capital when we take in a new property. And that means we are doing this with the preference shares. So up to 35% of the capital of the money needed with every assets we have there. And that means also it's a very good position that we only have the depth of up to 65% to take care of. All of the properties are also acquired using a rental apartment model. That means we have, even though almost all of our apartments are built in classical Swedish bostadsrätter, we have acquired them at the lower level of rental apartments. That means we have a business model that's very, very risk minimized. We can either take these and do just ordinary rental apartments and let them on the private market. We can also make co-ops for them if that would be better, and we can also have a sale, package it as a sale of a whole building. And that makes our business model even more unique because the risk is almost completely eliminated in our business model. We can also have them rented out to the apartments to companies or institutions and so on also. So it's a very flexible business model. You can take the next slide, please. If we look into the properties and how we approach them, we have a couple of things that are really, really important to us. Number one is that they are all located in the Stockholm region, and that they are also very close to a commute into Stockholm city or to the IT clusters or the big workplaces in Stockholm. So that's one thing. The other thing is that we have to have very space efficient apartments, since we are addressing the lack of space efficient apartments, and that is completely our niche. And also that means that the apartments are immediately also very resource efficient, since the smaller apartment makes a much smaller footprint or impact on the environment. So that means they're very resource efficient. And also, of course, every project that we have are newly produced, so the high standards, of course, is very important too. You can take the next slide. The properties are very, very artistically pleasing, at least in our view. They're very resource efficient. We take a very big pride in having very minimized environmental footprint. That means also that we have efficient heating and so on. And also the properties are also from the beginning very much digitalized, not only the property itself, meaning that we have digital readings and digital possibilities to change the heat and the cold and everything, but also for the people living in the apartments. We have digital locking systems and access control systems and so on. And this is a very big part of our business model too, to be very streamlined and automated. You can take the next slide. looking into the apartments or our product, so to say, they're very space efficient, and still they feel large. They always are appreciated because of the well-planned layout. That means even if you have a studio, 1 bedroom or 2 bedroom, they're minimized to a bare minimum, but with the highest standards still. So we have real kitchens, of course, and so on. They're also, of course, handicap adjusted and everything that should be. But since we have the big plans to make these optimized, they're really good for us. You can take the next slide. We work with something that we call communities. Since we have those space-efficient apartments, we also have a demand for other areas, and that's what we call communities. That means that we take the living room and expand it to other areas. For example, in our blocks that we build, we have cafes, gyms, restaurants, co-working areas, services, and everything like that. But also we have resource sharing, bicycle sharing, and nowadays also electrical car pools that the tenants can access easily via their mobile phone and our in-house apps. And for a very small amount, rent a car for either hour or days. And also that means community-wise, we have a lot of shared economy features in our communities. You can take the next slide, please. That means that we have a good possibility to create meeting places in the properties. The commercial areas are almost to see as an extended living room, as I just said. And we can see that it's very much appreciated by our tenants and the people living in both our project and also in the neighborhood itself. And it's a very good way to meet friends and so on and socialize. So that's a very big important part for us. Take the next slide. A way to realize this community thinking is via digitalizing our apartments and our homes. And I don't mean by that smart homes where you can hey Google things. I mean we have an in-house app that it's a social platform more or less where you can share things. You can talk to your neighbors and write things to your neighbors. But you can also access, for example, the shared areas and the electric car pools and so on. And also we have now a pilot project that we're just in the finishing stages of, where we digitalize the whole digital lock in our both our apartments and the whole building. That means that the mobile phone is also not only the social platform between your neighbors, it's also your keychain and everything else. And it's a very, very good way to be efficient. And also it's a good way for us to communicate with our tenants and the people living in the apartments and have a high standard of service, but with a very limited personal resource. You can take the next slide. And well, this should illustrate an optimal community in our way to see it. Not only you have all the apartments on top, but you have the car pools, the cycle pools, but also the restaurants and grocery stores and everything. And all is kept together via our app and the extended services that we can provide via this. Okay, take the next slide. As all of this means, that means since we have newly produced properties and they are very, very space efficient, we can create much more homes in a limited area. The environmental footprint is also very much minimized per person. And this is actually a number that we are looking more into than, for example, per square meters, because when everything comes to close, it's the person living there that makes the footprint on the environment. And with this, if you live in one of our space-efficient studios or one-bedroom apartments and so on, you make a much more smaller imprint on the community and the environment. And since everything is also in hand, you also minimize the travels. And since we have carpools in our properties, that means also you don't have to have your own car and so on. And that means, all in all, we have a very resource-efficient and sustainable view on our properties and people living in our apartments. You can take the next slide. As I said in the beginning, we were listed on Nasdaq First North growth market in November last year. Today, the market cap is about 6 billion Swedish kroners. We have two shares listed on Nasdaq. We have ordinary shares for long-term growth and preference shares for a very stable dividend every quarter. We have 5% dividend, and they're very, very popular share. Yeah, as I said, also the share, you can see the share as a share where you can see a long time value too, since we have the portfolio of almost 12 billion in property value. We can see that the way forward for a company is very, very bright and very, very low risk, and that means also that we have a built-in big value. You can take the next one. Here you can see the biggest shareholders. Our founder, so to say, Alm Equity, is still the biggest owner. You can take the next slide. This is just a very brief summary of the KPIs of the Q2 this year. As you can see, the rental values and the net operating incomes have increased quite rapidly. And of course, this is not due to us being super special and raising rents and so on. It's because we have this portfolio falling in place and so on. But also what this means, these are actually quite dull and boring numbers, because what we do every quarter is delivering just as promised when we noted the company last year. So we have a very stable plan, we have a very stable delivery, and every quarter we deliver at that plan and that ratio and keep doing so. And also our seller is delivering all the apartments and all the properties just on time, and even early in some cases, which means a stable growth of rental value, rental income earlier, which is also positive for us. The housing economic occupancy is 100%. We have no available apartments at all. And if you look at the whole range, that means some of the stores and so on that we are having in the part of the community, those are being built out as we speak. So that's the reason why you have 99% in total. But those are being built out as we speak. You can just slide through a couple of the next slides kind of rapidly, because just some examples of our properties. These are the properties we have already in our portfolio now. And if you look forward to the next slide, you can see properties coming in play this year and the next year and the year after that. So yeah, and the last slide. So that was a very fast, but I think kind of in-depth view of us and well, our business model. Now, thank you very much for listening, and I'm pleased to answer some questions now.
Great, thank you, Tommy, for an excellent presentation.
Thank you.
I'm wondering first about the deal structure with Alm. Could you tell us something more about how the deals are structured? For example, are you accessing buildings at the predetermined price, or is it at the okay? Not
absolutely, yeah. So what we do, we did the portfolio in the whole last summer, where we packaged everything together, and in that package the pricing was determined, and there are only some small variables that can differ. For example, where we haven't, for example, opt for a different building method, change from concrete to wood or vice versa, that could mean it's a small difference in the layout of the apartment. That means there could be some square meters coming in or going off, and that's the only thing. But all the resources, like the cement crisis now, for example, that's on the seller to take in play. So they're delivered in the fixed income at the fixed yield on forehand.
Very clear. And who's in charge of the property management once the building is up?
It's ourselves. We have the economic management in house, and we take the technical. We rent it in. We take it from outside, so to say. We like to have a very small and very specialized niche staff. So we have asset management, economic management, and of course the management in total. We have that in house, but the technical management we leave to people that know better things.
And in terms of legal responsibility, if there is a leakage 2 years after you access the property, is that on your responsibility then?
Yeah, of course. But since we own the apartments and the properties, so that's on us, of course.
Yeah. And how does the rent on your property stand against other properties in the area?
I think since we're newly produced, we come in play to the newly produced rent regulation, but we don't stand out at any point at all. But because of the very space efficient apartments, of course, per square meters we get a much higher income, for example, than if you look at the old kind of apartments in central Stockholm and so on. So rent-wise, we are very happy with both the regulated rent market and if we go to another market too. So, yeah, we have a high NOI, and that because of the super space efficiency we have built in our business model.
Yes, indeed, with a yield of just above 5% at Access, I would agree.
Yeah, thanks. We're quite happy with that too.
And if we look a bit more on your preference shares, would you like to develop those a bit more? Because I also find them sort of distinguished from preference shares issued by other real estate companies.
Yeah. Well, as I said, we put together this package at last year, and together with our external investors that we had in different projects when we still were a part of the Alm branch, we had a little less than 10 investors that were coming in, where the properties were coming into our management, and they were keen on co-owning those projects, those properties after the project was finished, because they were very high yielding properties. So we took that in hand and put together a bigger package where we put together 29 properties in whole. And the way that was formalized was via a preference shares from those external investors. So they have an obligation to commit to this these 35% of the pricing. That means up to 3.3 billion Swedish kronor in preference shares. In our strategy is also that with the cash building up, we should in the time to come dilute these shares too. But that's for come later on. We can also use the cash built up to acquire new properties or new companies and so on.
Yeah. And just like you said on the last sentence, basically, is that they're not supposed to be eternal and run forever.
Yeah. No,
you're looking to at some point redeem them.
Yeah, exactly. So we're looking to redeem them at the point where it suits our strategy of growth, so to say. But they're not eternal, how you say? But yeah.
So all these projects are signed, and it's all pretty easy to forecast, straightforward in that sense. After 2025, will there be more to the pipe from Alm, or are you open to acquire projects from other players as well?
Actually, we're not at all committed to do anything more with, for example, Alm, and but it was how you say, a good starting package or a good platform for us to stand on with these 29 first properties. But we are actually quite keen to do business with other people too. We're hungry to grow, but we want to grow in a manner and a speed that suits us and our organization, of course. But we can look even before 2025 to grow, either by buying projects or JVs or something like that, or buying companies. But that's for sure. But we're not at all committed to do something with Alm Equity.
Thank you so much. I have to take a punctuation of the presentation there.
Very nice. Well, thank you for having us and listening in to us also.
Thank you, Tommy. Bye.
Thank you. Bye.
Hello and welcome back to our broadcasting here at ABG Investor Day. Our next company is within real estate and primarily within industry and warehouse. However, since recently also within the residential segment. It'll be interesting to hear more from CEO Erik Ranje and CFO Per-Henrik Karlsson. You two are very welcome to begin presenting on Stendörren.
Thank you very much, and thank you for giving us the opportunity to present Stendörren to all of you. We are obviously a listed real estate company on the mid-cap list, focusing, as you said, on logistics, warehouse, and industrial assets. We manage properties, we develop properties, and we acquire properties where we find attractive properties. And as you also said, we recently announced that we also will move into residential properties, and we will get back to that in more detail. But the logic behind that is the fact that we have warehouse, logistics, and light industrial properties in urban areas where there is a conversion potential within the existing portfolio into residential. So there is an industrial logic behind that. On the second page we are right now, and real estate is very much about location, and the market opportunity that we as a company capitalize on is the fact that our properties are located in Mälardalen region. Even though we are evaluating moving into new markets where we see the same kind of industrial logic, where we have logistics, warehouse, and industrial properties in urban locations, but also with a potential for conversion into residential. The dynamics, the fact that we have these kind of assets in urban location has a particular kind of dynamic, and that is the fact that within light industrial and logistics properties in urban locations, there is in the Stockholm region there is a demand increasing over time. However, supply is stable or actually decreasing as a result of such conversions to other use. And if demand increases and supply decreases, then that has a very positive effect on rents, obviously. So that is a short introduction to Stendörren. If we move to the next page 3, we have some key figures. We have assets of around 10 billion SEK, high-yielding assets around 6%, excluding land and projects, i.e. standing assets, 6%, which is a high figure. 750,000 square meters about, long leases in general. Average remaining lease duration is 3.8 years at a modest leverage ratio of LTV slightly below 50%. We also have a building right potential, some 600,000 square meters of building rights, which I will get back to slightly later. On the next, we actually skipped the next page, so we move directly to page 5, a little background when it comes to the history of Stendörren. Stendörren was founded in 2014 when a portfolio was carved out from Kvaliteten in Mälardalen, a property portfolio of 2 billion around, and put under separate management and listed on First North. Since then, it has been a growing company, quite substantially growing, primarily acquisition driven. Some key data points over time is the fact that EQT placed a public bid on the company in 2018 and became the majority shareholder, or 40% of the share capital, approximately 60% of the votes. And that's the key data points, I would say, listed on mid cap in 2018. So now we have 2.4 billion of assets, some 125 properties. If we move to the next page, page 6, the investment theme of Stendörren, we will get back to all of those 4 items on the subsequent pages. But we have a stable and strong diversified cash flow as a result of having many properties, many tenants, 800 tenants in a high-yielding segment. We have an embedded growth potential in the company. As I said earlier, we are located in the growing Mälardalen region. We are in a segment where there is a increasing demand. Supply is not increasing, rather decreasing in many places. We have the third item, we have a quite strong potential in our project pipeline. We have, again, some 600,000 square meters of building rights, which is almost doubling the size in relation to the standing assets of today. And if we dig a little bit further into those 4 items, and look more into detail when it comes to the portfolio, if you look on page 7, we see that in the pie chart in the middle, about 1/3 of the property portfolio is located in the Stockholm municipality, another third roughly in the greater Stockholm region, and another third in the Mälardalen region, or the rest of the Mälardalen region. We have some 67% of the portfolio within warehouse, logistics, and light industrials. We have office 22%. However, this is area, which means that to some extent, these office square meters are office square meters in logistics properties, i.e. it's not office risk as such. It's rather logistics or warehouse risk or potential, if you want. On the next page, excuse me, I mentioned the diversified tenant base. We have 800 tenants, which is quite a large number. Top 10 represent 25% of the lease income. From different industries, we have both municipality tenants such as Nacka Vatten, Stockholm Vatten. We have engineering such as Alfa Laval, Fuchs Lubricant. We have Bactiguard, which is medtech. We have Unilever, which is international larger company, and the average lease duration is 3.8 years. So we have a very stable and strong cash flow, which is the fundament of the company. However, then if we move to the next page, located in the Stockholm region, and in the interest of time, because the clock is ticking, I don't have to convince anyone that Stockholm is where we have the growth in Sweden. Obviously other areas as well, but Stockholm is very much the growth engine of Sweden. And that is where we have our properties, both population-wise, but also when it comes to economic growth. We have a potential when it comes to e-commerce. There is migration from traditional retail into logistics, and that increases demand for urban logistics where our properties are located. I mentioned earlier that there is a conversion from excuse me. There is a conversion from light industrial use into, for example, residential, which means that supply is decreasing and demand is increasing. If you look at our quarterly report, you will see that the rent increase historically per quarter has been some 25% on leases up for renegotiation, and that is very much a part of the potential of Stendörren, where we see that we have a strong embedded growth in the company. if we move forward, we tend to focus on or continue to grow in Mälardalen region, but we are evaluating new markets. We will focus on acquiring cash flow generating assets, i.e. we will not acquire building rights, but rather develop building rights within the existing portfolio. We are now on page 10. Again, in the interest of time, I think we skip page 11. If we move to page 12, what we have done during the last 18 months when I've been the CEO of the company, we have analyzed all the 125 properties to see where we have properties with low percentage of exploitation. And with that, I mean a property, large land plot, small building, we can build another property on the site. We also look into where we, by way of rezoning, can shift from industrial use into residential use. And having done that analysis, we have found quite significant project pipeline, and this is on this particular page, which we also disclose in the quarterly report, where we see the most concrete potential in the company on when it comes to projects. But we also there is more to come, so to say, but these are the most concrete ones. And we move to the next page. We have some projects where we have submitted building permit application. We will, when we develop project, we will focus on pre-let and build on a fixed price turnkey basis. And considering that the pace of completion of this project will be sort of decided by the market where we have found tenants. If we move to the next page, this is a very typical example of when I talk about shifting from a particular use into residential where we have low degree of exploitation. In 2016, we acquired this property, and the building, which is ours, is the building with the gray roof and the bluish facade. And the residential building that we see here, that is just illustration. And as of today, that is just pure empty land. We work with rezoning this property and have a building, sort of a zoning which has gained legal force to build some 800 apartments. And we did submit a building permit application for the first phase of this to build 350 apartments. And this is very typical than what we intend to do when it comes to residential, i.e. shifting from a particular use into residential on properties with low percentage of exploitation. Now I think it's over to you, Pelle.
Yes, so page 16, we have rolling 12 months to June 2021, where we have done a rental income of 659 million and a net NOI of 482 million, and then a net profit of 682 million. And the other key figures we have already mentioned. So let's move to page 17, where we have our financial targets, and in the graphs below you can see the performance since 2018. We have return on equity at 16% at Q2 2021, and our target is 12%. An ICR of 2.9, and our target is not lower than 2.0. An equity ratio of 43%, and target is long-term 35%. And NAV growth of 22%, and our target is 15%. Next slide. More financial key metrics. Property value to the left. We have a growing property portfolio, both value-wise and also in amount of properties. The graph starts at Q2 2017. We have 96 properties, and in Q2 2021 we have 125. We have also an increasing NOI and also increasing margin, even though Q1 2021 was both cold and snowy. And down to the left, you see profit from property management, and as you can see in the graph, it's higher and more stable since Q1 2020. And our LTV is also decreasing, also secured LTV. Next slide. It's a net income walk where we start at a rental value of 756 million, vacancy of 97 million, which gives us a total income of then 659, and property expense of 177, which gives us an NOI of 482 million. And as you can see here, we have a high value changes, 623 million, and a tax effect that is mainly deferred taxes. And net income is then 682 million. Next slide, which is about our debt funding as of Q2 2021. We have a total interest-bearing debt amounts to 5.1 billion, and the bank debt is 4.5 billion of that amount. And also we have a senior unsecured bond debt of 700 million. We use several of the leading Nordic banks for our financing, and approximately we use 60% of bank financing at acquisitions. And during 2019, we issued a 800 million hybrid bond, which accounts as equity according to IFRS. And this bond is about approximately 13% of our total debt funding, but as then disclosed as equity. As we can see in the graph in the middle, we have a good spread on our maturity profile, and our average loan maturity of interest-bearing debt is 2.5 years, and the average interest rate is 1.9%. Including the interest caps and swap, the average interest fixing was 2.1 years. To the next slide. Share value and key equity ratios. We have increasing share price, but also increasing equity and NAV. Share price has increased about 70% from June 2020 to June 2021. As of yesterday, the share price was 250.5 SEK per share. And all-time high closing price was at 12th of August at 285 SEK per share. And as you can see also in the graph, we have, as many other companies, a COVID-19 effect at the beginning of 2020. Let's move down to the next slide. To the left, you can see our top 10 shareholders. And you can see also our share price development. Our share price at end of Q2 was 205 SEK per share. And the market cap at that time was 5.8 billion. As of yesterday, it was 7.1 billion. And as we mentioned before, we are trading at the Stockholm mid cap. And we have about 3,500 shareholders. If I move to the last slide, which is assessed earnings capacity. Our assessment is that as of Q2 2021, we have a total rental income on a rolling 12-month basis, about 648 million. And our estimate is that our current property cost will amount to 152 million, which then gives us an assessed NOI of 496 million. That was the end of the slides.
Yes, I think we're done with the presentation, so we are ready for questions.
Excellent. Thank you for your presentation, Eric and Pelle. I will get on here with my first question, and it concerns your residential properties. You dove into your rationale behind expanding to this area with your industrial properties located in urban areas, and that you, from that angle, see clear conversion opportunities. My question is, what, if anything, do you as a company need to change in order to be able to run residential properties going forward? Are you looking, in that case, into in-house property management, or are you just developing and divesting? Just tell us a little bit more about how you're looking to run these properties, please.
Yes, I mean, again, I want to emphasize before I answer your question the logic behind it, because you can view residential versus logistics on different ends of, let's say, a property access, if you want. But there is really a strong industrial logic behind it, and that is, again, we have property in urban locations, which over time may very well be suitable for residential. You have I think if there are many Swedes on the call, once upon a time, Lugnets industriområde, which became Hammarby Sjöstad, and you have Västra Kungsholmen, Hornsbergstrand, which was also an industrial area just not that many years ago. And that is an industrial rationale. Whether it is condominiums, i.e. bostadsrätter, then obviously we will sell it. And that depends on what the demand is at each point in time. But to the extent it's rental apartments, then we intend to develop them ourselves and at the outset keep them under management. And of course, initially it's not necessarily that we need to establish a larger sort of organization for taking care of it. That can be before reaching a critical mass sourced from outside, but over time, obviously, it would make sense, having reached critical mass, to establish an organization. But we have engaged and recruited persons on the development side. Ulla Sjölund, for example, we were recruited not that many months ago to help us on the residential side. So that, I hope that is an answer to your question.
Yes, it's very clear. Thank you for developing on that. Regarding another project, or your biggest project, Green Hub Bro, outside of Stockholm, it's been on the list for a while now, and my question is if you have any new outlooks on it and any thoughts on when you think you can start the project.
Yeah, and just to then shed some more light for those who listen, Green Hub is located in Upplandsbro. That is where Coop today has their main logistics hub. That's our largest tenants, and it's a large area, 1.4 million square meters, so it's very large. We have some 400,000 building rights there. We are sort of exploring how to develop it. We also have a railroad into the property going actually all the way inside the Coop building. So it's a fantastic logistics location, just 25 minutes from Stockholm, which has a clear green focus considering the railway. But it's also a huge area when there is, we have to be careful how we develop it in many ways and what is the highest potential. There's also questions about how to source electricity and other matters related thereto. So I cannot give you a timeline, more explicit timeline, but we are working on it, whatever that answer is worth. But we are doing progress on it to see how we, in the very best way, can develop it.
Thank you. When you have renegotiated your rents, it has been, as you mentioned, around 25%, looking at quarters 1 or 2 or maybe even 3 years back, which are good levels. And my question is if what your outlook is moving forward for renegotiations. How long do you think you can keep this type of level up?
I think this is really an embedded over time sustainable growth potential in the market, which we need to capitalize on. Again, very much related to that we are in growing macro location, i.e. Mälardalen, but also in urban areas, i.e. central micro locations. So that is a sustainable growth level in my mind. To add a little bit more flavor to that, what we have, 25 is an impressive figure. However, 25% based on what's the base, so to say, and that base will, in my mind, increase. What I mean with that is that we will renegotiate more rent contracts because we do not serve notice for renegotiation on all contracts. And in my mind, what we are doing in the budget process last year and also this year is that we're really going through lease agreement by lease agreement. Is this under rented? And if so, then we serve notice for renegotiation. So there will be more leases served for renegotiation. Also, perhaps those which do not have the, let's say, 25% potential, but also low potential, which means that the percentage figure may very well decrease. But that is because we're adding more contracts for renegotiation.
There are even more things I would like to ask you guys, but time is unfortunately running out. So I will have to conclude there, and thank you for being with us on the seminar today.
Thank you very much.
Thank you.
Hi and welcome back. Our next presentation is with Stockwik, presented by CEO David Andreasson. Myself, my name is Mark Bacco, and I'm an equity research analyst here with ABG within industrials. And with that said, David, please go ahead with the presentation.
Yes, thank you very much, Max, and thanks everyone for watching this. I'm David Andreasson, CEO and co-founder of Stockwik since the inception 2013. And I think so far we have been on a great journey, making 18 acquisitions, and we are looking forward to making further acquisitions, of course, going forward. To start with, I would like to touch upon the second quarter report, which I believe could have been better. And everyone who has been monitoring us for a while, I'm sure will agree. The main reason for the disappointment was within the property services segment, and in particular our actually first acquisition we made in Bergfast, which has been an absolute gem of an acquisition for many years. But lately they got stuck in some projects too, where they were hampered by additional costs due to further material needing to be delivered and more work needing to be done than originally calculated. We have done what we can to strengthen this part of the business within Bergfast, and we have been actually for a while looking for an employee that can strengthen Bergfast within, in particular, the calculating part of the projects. And we are looking forward to coming back with business as usual in Bergfast and their landscaping business going forward. So that is the main explanation of a sort of slightly softer earnings than we had been looking forward to. Also, we have also changed part of the accounting within Galdax, which is the largest company within our industry segment. And Galdax, as you may recall, is our rethreading tire business. And they also buy a lot of tires to distribute to our tire workshops. And typically the margin assumption for these tires have been a bit too high in the first half of the year. So due to that, we have looked over that together with our accounting business and made an adjustment for that, which should even out the earnings over the year for this business. So with that said, we come to the conclusion that in that sense, earnings could have been a bit better during the first half of the year, and not least in relation to what I believe investors and the market seem to have been expecting. Otherwise, Stockwik is on track as a fast-growing, non-cyclical business with great opportunities to grow with further acquisitions going forward. I would like to stress the focus we have when it comes to the kind of businesses we target. It's non-cyclical businesses, and that makes Stockwik actually sort of a counter-cyclical animal, so to speak, that our opportunities to grow is actually a bit better in slightly weaker economic conditions. And we should provide a very stable earnings development. And what happened in the first half of this year is not related to any cycle, but more to specific projects and things in our business. So we always target companies that we believe are non-cyclical in their nature. So we are building up a portfolio consisting of very stable, every company in their own right, businesses, and that's our main focus. And we believe that Stockwik will always be an enticing proposition in that sense, that we are growing through very stable companies and that we have great opportunities to grow going forward. If we move forward to slide number 3, I'm afraid I actually can't see the slides, but I recall that we have at least a few words on Richard, which has joined us recently, earlier this year. And Richard has been actually head of equity research for Nordea in Sweden and has a great background for his role as a COO coming into Stockwik. So we are very glad to see Richard join us, and this will definitely strengthen up our team in the sense that he will focus on the organizational development and has already implemented a few follow-up models for all our subsidiaries, which will improve the monitoring of these companies going forward. And we're also growing fast enough not to have included our latest colleague Johan Faglund, who joined us actually yesterday, coming in from Betsson. Johan has also a very an excellent background as a corporate lawyer at Betsson, and he will have the same role here at Stockwik. And Johan will of course help us to improve and speed up our due diligence process. To date, Andreas and I have done a lot of this work ourselves, and we have come to the conclusion that we are the bottleneck in this organization, although I think we can say that we've done a good job during the first 7 years. But now with Richard and Johan joining us, we definitely have strengthened our management team and can improve both the companies we already have within our group and also the processes for going forward and growing with further acquisitions ahead. If we move forward to the next slide, slide number 4, we can conclude that although we have spotted some room for improvement to date, we can say that the overall improvement is stable. And we are working very hard to make this year, 2021, Stockwik's best year ever. We have actually already completed 5 acquisitions. And we can move to the next slide. And these acquisitions are Kålarviks, Sokab and Svärd, which we already have touched upon during the last investor presentation we made together with ABG, which was in March. And since then we have made an additional 2, which are Mittex and Hela Health. And to say a few words about Mittex, this is really a beautiful little industry company, which we're very glad to have acquired. Mittex makes what is called the Mittex bar, which is an application for heavy-duty vehicles and agricultural equipment. They make an aluminum bar, which is model-specific to fit on construction machinery or agricultural machinery for their hoods or counterweights on excavators and on top of the roofs. And these aluminum pipes are model specific, and they are used for an easy and neat installation of position lights, flashlights, and work lights. And I would like to say that they are best in class when it comes to producing this additional equipment for this kind of machinery. And I remember actually Warren Buffett saying one thing about companies: if you make your customers delighted, you're on the way to success. And I would definitely say that Mitteks, they are really making their customers delighted, and they are more actually surrounded by fans more rather than just customers. And even though they mainly target Sweden as their market, the word has started to spread, and they have actually received orders from as far away as Australia, just because if you really want the best application for light installation on your vehicle, Mitteks is a great company to turn to. So we are very happy to having been joined by Mitteks this spring 2021. And we also quite recently completed the acquisition of Hela Healthcare, which you can see is an addition to our healthcare segment. And Hela is actually not that different from Team in the sense that it's a healthcare company which offers a very wide variety of services for patients. And although it's not that big company with about 20 employees, it's a really nice little quality company offering a very wide variety of services, and also very nicely geographically positioned in Norrtälje, just north of Stockholm, and Åkersberga, and also they also have a small office in Stockholm. So we believe that that also represents a company which is non-cyclical, and also contributes to the at least to some extent to some good in the society, which we want all our companies to do in some way. So of course we are looking forward to expanding the healthcare segment, because we believe that there can be some procurement synergies within or between companies in that segment. So all in all, we have 18 companies today, and this is how our group looks today. Quite well balanced, I would like to say, within the different segments. So let's move forward to slide number 6. And this slide speaks about how our business model works, at least in numbers. As you can see, we have been growing our company quite a bit, and we like to, of course, look at how the companies we are about to invest in have performed in 2007, 2008, how they fared during the last financial crisis. And of course, going forward, we will look how the companies have performed during the pandemic. We want to see that the companies have been stable even in trying times, and that has been a prerequisite for Stockwik to go through and follow through with an acquisition. So we have been growing quite a while, and we have been performing and are performing stable. And of course, we look forward to making further acquisitions going forward. And well, what about that outlook? If you look into the second quarter report, you can see that in our parent company we have about 150 million kronor, and in the group as a whole we have about 220 million kronor. So together with an additional possible tap issue of our bond of 75 million Swedish kronor and a positive cash flow, one could come to the conclusion, or if you make the maths, to about roughly 300 million Swedish kronor as an acquisition room, and that is of course excluding vendor notes and also the issue of further shares as part of the payment when making acquisitions. Anyhow, if we keep to the average multiple we have been buying companies at, one could see that we could buy further profits, additional profits of about maybe up to 60, maybe even more, 60 million Swedish kronor. So that is sort of the case when it comes to the share investment case of Stockwik, that we can, I wouldn't say easily, but we have at least the potential to lift our earnings above 100 million kronor. And of course, that is what we are aiming to do. I won't give a specific deadline for when that is going to happen, but I would like to conclude that I believe that the outlook is good. The market for making deals is as it has used to have been, and I haven't seen any change with regards to the market. We have a good deal flow, and we are of course just doing what we have always been doing, trying to find the right companies with the right people and making the deals at the right valuations. So that is what I had in mind to say today. So I would like to thank you for watching this presentation and hand over to Max for any further questions.
Thank you very much, David, for the presentation. And to begin with, which you touched upon during the presentation, you have done 5 acquisitions year to date. Would you say that this is a reasonable level going forward as well, given that you find attractive acquisitions to reasonable prices?
Well, I would like to avoid to make any promise of how many acquisitions we will make during a single year, but let me give you some background. The fastest acquisition we made took 3 months to complete. The longest one took more than 1.5 years. So it's difficult to say when they materialize and can be announced as an acquisition that Stockwik has finalized. But we have been making quite at least a handful of acquisitions each year when we've had the means to complete acquisitions. And now we have brought in Johan and Richard, and the market or the acquisition climate is still very good. And I believe that we have a good outlook when it comes to making a few acquisitions each year.
Okay, and since your inception in 2013, have you seen any expansion in acquisition multiples?
No, I wouldn't say that.
Okay.
Of course, that's. I know that there's been a sort of maybe investors worrying about more. There are a few companies that are slightly similar to Stockwik, and that may sort of drive up the prices, but I wouldn't say that we are experiencing that. And I also would like to stress the fact that we have actually made a handful of acquisitions out of these 18 acquisitions where we have had direct competition with not other listed companies, but industry consolidators. And these owners or sellers, they have actually actively chosen not to sell to them because they don't want to see their little baby, their company, becoming a part of such a large entity. They want it to live on, and they want to see that their personnel still have their jobs, and that's why they turn to Stockwik. So we have something unique to offer within the segment we are operating in. So no, I'm still confident that we will be able to make acquisitions at levels that are appealing.
Okay. And for the viewers that are new to the case, could you perhaps restate your acquisition criteria and refresh our memory?
Yes, absolutely. Stockwik is actually mainly founded on a philosophy of trying to do something good. And with that, we mean that we want to do something good for those who are selling the company, in the sense that we will continue to take care of the company in the same way that they have been managed during the ownership of the original founder or entrepreneur. So we are offering that opportunity for the seller to sort of both keep the cake and eat it. So the company can live on, and they can feel comfortable with that, and selling to Stockwik gives them that opportunity. And we also want to take care of the personnel in the sense that we like to see people grow, and there is often quite a lot of energy within these companies that we acquire, and people that want to maybe take a step forward and continue to grow within their organization, which is something we really appreciate. And we also have made Stockwik into a public company because we want to give the average investor the opportunity to invest in the best small companies, family businesses in Sweden via Stockwik. So when we do something good for the sellers of these companies, for the personnel, and for our shareholders, we do something good for ourselves. That's the philosophy Stockwik is based upon. And we invest in non-cyclical companies that have a proven track record of earnings. And by investing in a variety of different companies, we create a very, very stable portfolio, which we anticipate will live on for a very, very long time going forward. So that is sort of Stockwik in a nutshell.
Okay, perfect. I think that were some good concluding words for today. Thank you very much for joining us here today, David, and we look forward to see you the next time.
Thank you very much, Max. Have a great day, and thanks everyone for watching this.
You too. Bye.
So welcome to the next presentation from a Danish listed company. My name is Laurits Louis Kjærgaard, equity analyst at ABG in Copenhagen office. I would like to welcome back to the seminar MC Hojgaard, this time represented by Group CFO Martin Solbjerg. We've arranged a 20-minute presentation following by a short Q&A. And thank you so much for joining us today, Martin, and the floor is yours.
Thank you. And please take next slide. Just in short, we will give an introduction to the group, including the strategy. We will go into the financial figures and some market trends we are seeing right now. Then we will give our outlook for 2021, and finally give some few comments related to our share. Next slide, please. Hojgaard Holding is representing a long history in the Danish construction market. We are as a group represented by 6 independent business units: Enemærke Petersen, MT Hojgaard Denmark, Ejers, Scandibyg, Project Development, and MT Hojgaard International. All 6 business units operating independent and operating with its own brands. We are a major contractor within construction. We are a major contractor within housing and new buildings, including refurbishment and big projects in refurbishment. As a group, we are expecting a turnover in 2021 of 6.8 billion, with an operating profit of 160 million. It's important to notice that we are primarily a Danish-based company with approximately 90% of our turnover revenue sitting in Denmark. The last 10% is primarily coming from activities in Greenland and the Faroe Islands, and we have a small operations in the Maldives and also in Portugal. We are represented by 2,500 people throughout the group. The 2 major entities are Enemærke Petersen and MT Hojgaard Denmark, which are representing close to 75% of our total revenue in the group. Next slide, please. The strategy of MT Hojgaard Holding is very much a turnaround strategy where we have high focus on transformation. If you're looking into our financial figures in both 19, 18, and also further back, we had some years with challenges. We introduced our new strategy in Q1 2020, and the strategy running for 3 years, with very much focus on creating profitability and creating a sustainable company again. Our aim is to deliver EBIT in 2022 of 4%. We are deliberately here not talking about turnover and net sales. This is not a growth strategy, but very much a turnaround where we have to show that we can create a sustainable profit for the future. We are having 5 strategic pillars that are our focus areas throughout the group, both internally, but as important also external towards the market and our customers, which is very much focused on our employees. We are not representing by any products. We are project driven, so our employees are super important, and even more important also today, where we have a market with a high demand for employees. High focus on cooperations within the group between the independent units, so we are driving our synergies, but as important, we are also very focused on cooperations with our customers. As a project company, we need to have high focus on innovation and processes. We have to deliver the best processes to the market so we can optimize around our projects. At the same time, we are in a market where we are talking about sustainability. We are in a market where there's a high demand for products that have focus on sustainability. Plus, we of course also playing the word. We as a group have to be sustainable and create a increase profit looking from where we are coming from. Next slide. Important part of our strategy, first of all, was to create a new structure with 6 independent portfolio companies, which also created the possibility to create individual focus for the business units. When we started the strategy in early 2020, we were sitting with 7 independent units, and the first step was to sell Lindbro. Very much driven by a fact that we were sitting in a situation where we have to make sustainable investments, or we have to sell at that time. That has been the same discussion when we're looking at Ejers Hoist, Ejers Crane, and now also lately Ejers Hot, Ejers Side Hots. That is very much business areas where we as a company have to look at major investments, or we have to find a better owner for those activities. During the same period, we had a number of acquisitions, primarily strategic acquisitions. We had an acquisition in Greenland with Madu. We had an acquisition with RTS in the Faroe Islands, very much focused around our international activities. And then we had 2 acquisitions here in 2021. The biggest one, Ravnstrup, and lately Nembyg. The last acquisitions in 2021 has been driven by ABGSC. ABGSC have over the last number of years seen a strong financial performance, strong growth, and the 2 acquisitions are very much supporting ABGSC's growth focus, and also create a better geographic coverage in the Danish market. Next slide. Despite I was mentioning before that our strategy is very much focused on profitability and it's not a growth strategy, we are in a situation where we are seeing a high growth. We have the last couple of quarters seen very high order intake. In Q2 isolated, we saw an order intake of close to 3 billion. And if you look at if you're looking at the last 4 quarters, we are in average seeing an order intake that are way above the 2020 level. And this is also above the level that we were expecting when we were going into 21. We are in general seeing a high market activity, and we also would like to believe that we are seeing improved competitiveness and a higher quality when we are tendering projects. It is important to mention that when we are looking at this high order intake, we are still seeing a high number of projects that has been won but still not signed. So we will continue seeing also high activity levels in Q3, Q4. Next slide. The high order intake is obviously very much reflected in our order backlog. We are end of June very close to touching the 10 billion in order backlog, which is an all-time high backlog for MT Hojgaard Holding when we are comparing with the last 10 years. So we are overall seeing a very high activity level. As mentioned before, it's important to mention that when we're looking at this backlog, we still have a number of contracts that we have been winning, but still not contracting, that we will see over the next 3 to 6 months. And this backlog is also, on the top of that, we also have to include the partnerships, which are partnerships typically running over 4 to 5 years. So when we're looking at our baseline for the next 3 to 5 years, we are seeing a very healthy baseline with this backlog. Next slide. Obviously, the question are coming: how much of this order intake and order book are created by very positive market trends, and how much of that is coming from taking market share in the market? We would like to mention 6 key projects here that are very strategic, important project for us, and those projects we will not been able to win 2 years back. We are seeing major partnerships with Civica in Fyn that are going to run over the next 4 or 5 years of 3 billion. We're seeing a very important partnership project of around 2 million for the capital of Copenhagen. We're seeing a major project for new headquarters for AP Pension and Nykredit in just north of Copenhagen for 1.6 billion. And we are seeing a major project for DSB. If you look at the number of projects with DSB over the last 1 year, we have seen more than 2 billion orders coming into phases with DSB over the next couple of years. We are seeing a major project development project in Fyn, Dalum, and lately here in August, we have seen a new order for ABGSC Galjebakken, which is obviously not part of the backlog end of June. All 6 projects are in many ways representing the new MT Hojgaard Holding. It is projects where we have been the winner in close relationship, in close partnership with the customers, developing projects together with our customers. It is projects more into the construction where we have not been visible the last number of years. And then we are seeing huge renovation projects in residential projects, which is the biggest project ever for Enemærke Petersen. So yes, there are high activities in the market in Denmark, but we also believe that we are taking market share. Next slides. Next slides are giving an overview of the major drivers we are seeing in Danish market right now, and what we are expecting to be the major drivers for the coming years, and to some extent is also reflecting the projects we have seen on the previous slides. We are seeing customers more focus on corporations and a need for early involvement. And that we are definitely seeing on the partnerships and also the big frame agreements with DSB. We are seeing high activities on renovation. Earlier we had a cap on civil work for the public sector, which has been raised, and a number of investments are expected to float into the market over the coming years. Throughout the market, both on public projects, private customers, and also towards more the pension funds, we are seeing a very high focus on sustainability across the portfolio, and that's going to be key for MT Hojgaard Holding over the coming years to be able to deliver on that demand. On the top of that, a little bit more long term, we are seeing political plans. We are seeing huge investments into infrastructure over the next 10 to 15 years. We will definitely not be running after all of those projects, and some of them are not part of our strategy, but there will be important projects also for MT Hojgaard Holding that they're going to have our strategic focus for the coming years. Next slide. We have been mentioning a couple of times that we were expecting a slow start on 2021. We are still maintaining our guidance for the year, which we'll come back to. And obviously, when we're looking at the first 6 months, we are not seeing an average 2 quarters when we're comparing the full year. We are starting slowly this year, primarily because we saw a low order intake in the beginning of 2020. We have to keep in mind that when we are booking the big orders, we typically first really see major activities on such projects 8-9 months into the projects. So there is a delay from when we are making an announcement and winning the projects till we really start seeing our income recognition taking off. At the same time, we also are closing few major projects from our old backlog where we are not carrying the same contribution as we are on the new projects. So short history is that we're going to be busy for the second half of the year, where a major part of the earning are expecting to be realized to meet our guidance for the year. Overall, we are seeing a growth. Important to mention here, approximately 50% of the growth right now is coming organically, and the other half is coming from our acquisition, primarily in Netbyg and in Ravnstrup. Next slide, please. We are maintaining our guidance for the year with 6.8 billion turnover, with an operating profit of 160 million. Important to mention that this is the second year in our third-year strategy, so we are at this stage approximately 50% into our 3-year strategy, which, as I mentioned before, are very, very focused on the turnaround, and bring us into a situation where we can deliver a operating profit going forward of 4%. Next slide, please. Few comments related to the share. Please keep in mind that MT Hojgaard Holding, the holding company, is basically a merger coming from the two original funds or original families from the family. This is a merger back from 2019, representing the Knud Hojgaard Fund and representing the M&T family, Ejner Meta Holding and Ejner Meta Thorsen Fund. Today we are sitting with approximately 40% of the shares free floating, and the two original funds are still sitting with two major positions of the shares. We are working with a dividend policy where when we are having a solvency of 20 to 30%, we are working with a policy of distributing profit of 25 to 30% of the profit. Are we bringing a solvency above 30%? We are running with a policy where we could pay out at least 50% of the net profit. That was the information from Hojgaard Holding. Questions, please.
Super. Thank you, Martin, for the presentation. A couple of points there that perhaps we can dig a little bit into. You mentioned there's a number of large infrastructure initiatives in Denmark, along with a growing pipeline of large orders. Could you talk a little bit about perhaps the appetite of taking on large orders, which we know MC Hojgaard has historically been quite involved in, versus perhaps underlying bread and butter smaller pieces of activity? Could you talk a little about balancing those two things?
Yeah. And the questions are very relevant. Very, very important for us that we keep a balance and a mix in major projects, but also what we call, and that is not to be unpolite, but the more bread and butter projects, to use that word, that is projects between 100 up to 500 million Danish crowns. It's important that we maintain the projects around this 250, 300 million. This is projects that we will also continue seeing also when, depending on, even if you have market trends going ups and downs, there will still be projects that we're gonna see. At the same time, it's also important for us to send a signal that we as a group can take big projects like the latest one for AP Pension and Nykredit. But it's important for us going forward that we will not be solely dependent on large projects. Coming back to the infrastructure projects, we do not expect, and you should not expect to see MC Hojgaard start renovating big highways or running big highway projects. We will take more specific infrastructure projects where we have specific knowledge that can make a difference. And we have lately seen that, for instance, on Rønnehavn on Bornholm. That is a project for 300 million, where we very specifically are going for an infrastructure project that are fitting our skills.
So if we dig into these larger projects here, you mentioned that partnerships and early involvement has become very interesting for you. Does that also mean that perhaps you are perhaps sacrificing a little bit of margins, but then instead gaining, let's say, more visibility into the market, or how do you view these partnerships?
First of all, the partnerships, for instance, taking Civica with a 3 billion, it's important to mention that is a number of smaller projects that we're going to see going to be executed over the next 4 or 5 years. So we are not into a 1 billion projects. We are into more the 200 million type of projects. We do not believe that we are sacrificing margins by going for the partnerships. We believe, on the other hand, that we are creating projects that are having a lower risk seen from our position, and for hopefully also seen from the customer side that they are sitting with a lower risk. That is projects where we, with our early involvement, are able to spend more time on the projects and hopefully bring ourselves into details where we're going to have fewer surprises, and by that having a lower risk seen from our side, but also from the customer's position.
And if we could also touch this on the sustainability arguments, obviously there's many investors from other Nordic countries here very engaged in sustainable solutions and ESG, and it seems that you were quite early stage in terms of developers in creating, sort of an ESG platform. And when we look at some of the new projects, for example, the Nordhavn Tunnel in Copenhagen, it seems that they, in connection with the solicitation, they will also have a number of green targets and also even a CO2 bonuses if the entrepreneur meets the targets. How are you viewing sort of sustainability within your pipeline?
First of all, we are feeling privileged that we have this position around the sustainable projects, and that of course is supported by our history and by the fact that we are sitting with our own project development department that support us in that focus is also supporting that companies like Inga, Petersen, MT Hojgaard, Denmark from very early stage has been focused on sustainable projects. And then we have to keep in mind that we are also sitting with Scandibyg that we would like to believe is market leading in building in wood and certified modulars for the market. So we are bringing products and we are bringing know-how from the last number of years around this subject. And there's no doubt that we are seeing, I mean, as I also mentioned before, we are seeing very specific focus to bring certified buildings to the market, both for the public and private customers.
And is that the same rate for public and private customers? Was my next question. Is the same demand in both of them? Because it seems that many of the private developers were a little bit early in this, and now it seems that the publics are sort of following through these trends. Is that a fair speculation?
We are definitely seeing project from the public segment increasing focus on sustainability. To make the really split, if that is the same level or not the same level, I think that's difficult. But it goes without saying that all have focus on it, and we are definitely seeing the pension funds having a very, very strong focus on that area.
And are they prepared to pay for it? Because that's obviously the big question. Fair enough, you can deliver a project, but if there's further sustainability needs for the project, it could cost more money. Are they prepared to pay for it?
Yeah, so far I believe so. And when we're looking at some of the projects that we have seen from our product development and also from Scandibyg, I don't think we are sacrificed our ratios to bring sustainable projects to the market. But of course, end of the day, there is also a discussion on price. So it's difficult to make an overall conclusion on it. But there are customers that are very focused on sustainability and also seem to be willing to pay an extra price.
And if we dig a little bit into your objective, where you are halfway through your 3-year strategy period, which you mentioned before, where you don't have a target on, let's say, order intake or revenue specifically, but more on delivering an EBIT before special items of 4%.
Yeah.
This 4%, is this a run rate also after this? Is that the target for MT Hojgaard, or is this sort of, let's say, a baseline following the turnaround period?
For us, it's more baseline, and we are still not looking at guidance above 2022. Looking at our history, we have been relatively short-term focused, and it is important to send a signal to the market, but also for our understanding internal that we can bring the company to 4% in 2022.
And do you have any negative margin businesses of legacy contracts in these 4%?
We do not have that.
So nothing that drags down the 4%. So it's only
not at this stage.
Okay, and maybe just a last question from my side. You mentioned the guidance for 2021, where the second half of this year will be extremely busy implicitly versus the first half. How much? Is there any risk for investors seeing perhaps delays into 2022, which could cause a downgrade, or are you comfortable enough? Do you have enough leadway and flexibility in your guidance?
We are comfortable. I understand the question, and of course, when you're looking into our segments end of second quarter, we are seeing fairly negative figures from our project development. But we have a number of projects that we are executing on, and some of them are going to be delivered in third quarter, and some of them are going to be delivered in fourth quarter, which makes us comfortable that we're going to make it. And we are seeing earnings in other of our units that will pick up during the second half of the year. So we believe that we are comfortable on that guidance.
The project development segment will save your guidance for the second half?
No, that is a general deliverable coming from all 6 business units. But project development being a little bit unique in that way that the projects are not coming per rate with our percent of completions, but it's coming in one go when we are setting projects. That makes it more specific on individual quarters. But we still believe that the timing is going to be this year.
That's very clear. So I think we have run out of time. As a friendly reminder, we have investment coverage on our introduced platform on MC Hojgaard. Feel free to reach out to me, and if you have any outstanding questions. And Martin is always helpful to talk to new investors also if you find interest in that. So thank you so much for listening in, and thank you for your time today, Martin, and have a great day from my side.
Thank you.
Hi and welcome to the next presentation. And my name is Christer Linde. I'm Global Head of Research for ABG Sundal Collier. And we have the pleasure to have NewCell with us today. We have Hugo Petit, which is the CFO, which will present the company, around 20 minutes presentation, followed by Q&A. So Hugo, the floor is yours and welcome.
Thank you very much. Yes, so my name is Hugo Petit. I'm the CFO at NewCell since May this year. You can move to the next slide. Just to give you some background, you can see the picture on the left side. It looks like a desert, but it has been a lake. It's the Aral, or the former Aral Lake, which was, I think, the fourth largest lake in the world. That completely disappeared, actually, because of the fact that the water from the lake was redirected in order to feed the cotton plantages in mainly Uzbekistan and Kazakhstan. To give you some examples, a pair of jeans costs around 10,000 liters of water. And if you look at polyester, for example, in clothes, it's contributing with around 35% of all ocean microplastics. Also, every year, more than 200 million trees are cut down in order to make viscose. Next slide, please. Okay. So if you look at the need of textiles, 2019, the volume was estimated at around 110 million tons. And the prediction is that will increase to around in 2030 to around 160 million tons. And the reason is that during this period, around 1.7 billion people will enter the middle class. And as you all know, for many people, the way you dress is very important and reflects what you reflects your values, and it's very important that you can express in the way you want. And especially middle class has a need for this. So we expect the need for textiles to increase significantly then. And you can go to the next exhibit. So we have a huge problem, and also you can see that many of the large brands have already committed themselves in becoming more sustainable. Hennes & Mauritz believes that they will be 100% or use 100% recycled by 2030. Patagonia, all in all the brands have committed themselves to become more sustainable, but so far, it's still a question mark how this can be solved. So if you go to the next slide. If you look at this exhibit, of course, everybody is aware of the fact that the conventional textiles have their issues. But also, if you look at more sustainable fibers, like, for example, recycled polyester, they still imply a significant impact on the environment. For example, if you reuse a plastic bottle and make it into fabrics, you will accelerate the fact that they contribute to the microplastics in the oceans. And also, if you have painted colored polyester once, you can't change the color, so it's not really reusable. If you look at organic cottons, they still use a lot of water. And again, if you look at the viscose based options, they require that trees are still cut down because they can't 100% recycle these fibers. And that is, of course, a risk for brands. Of course, the brand value might decrease. They will have issues in financing, and also regulation will force them to adapt. So there really needs to be we really need to have a new or a better solution. We can go to the next exhibit. And here again, this is Greta, who really emphasizes that we need change now. Again, the 1.7 billion people that join the middle class will have a significant effect on the need for a sustainable solution. You can go to the next exhibit. So in here, RenewCell comes in. So until now, the textile industry has been linear, meaning that virgin fibers are used, made into clothes, and then, well, to a very, very large extent, they have been, when they have been used, become landfill or burned. RenewCell has developed a solution actually to reuse cellulosic fibers, making it possible for the whole value chain to become circular. And move to the next. That's it. So the invention, RenewCell was founded by two professors from the Royal Institute of Technology here in Stockholm, and they have, well, most of their career developed or focused their research on the paper and pulp industry, but they invented a way to reuse fibers. And the way it works is as shown here. We put textile waste into a shredding stage. So we make the textile into small pieces, and then we have a chemical process where we bleach and also make the textiles into the pulp. After that, we dewater it, dry it, and then we have small, what do you call it? Small, like sheets with our pulp. I can mention that the chemical process consists of a couple of stages, but the chemicals that are used are the same as used in traditional paper and pulp industry. So no special chemistry is needed. You can move to the next slide. Just to give you an impression, when we compare the Circulose is the brand that we use for the recycled pulp or fiber. If you compare that to other traditional fabrics, you can see that we actually have a negative impact. And this is done this is a study that was done through Stella McCartney. So it's not RenewCell that has ordered the study, important to know, to emphasize. So if you compare the net impact, the coal dioxide impact, we have a negative impact compared to plastic, cotton, and viscose. And also, if you look at the water usage, we have very little need for water. And of course, especially compared to cotton, it's a huge difference. And when you look at the other areas, we have no impact because we don't need to use land, we don't use pesticides, and we have no microplastic pollution impact. You can move to the next. So, and this is where everything is going to happen. As you might know, we have raised money and also have a couple of loan facilities available in order to build our large commercial factory in Sundsvall. And why Sundsvall? That's mainly because the site we use is a former SCA site, so it's a brownfield location. We were able to use a lot of infrastructure and facilities that SCA has, and now our building is the building in the front closest to the water on the lower left side, and also SCA is investing around 1.5 billion in this site as well. It's also due to the fact that SCA has had a very large paper and pulp factory here. We have a harbor very close, so we will be able to, in a very efficient way, have inbound and outbound logistics. All the electricity that we use is coming from water, and the heat or the steam is produced by burning bark. So also this is green steam. So we have started to build. We have taken over the property that we need, and now currently we are doing making the initial preparations in order to start the mounting of the equipment that will come during fall. And the aim is to finish commissioning by the end of the first half year of 2022. Yes, you can move to the next. Just to give you an idea of the unit economics, the signal is somewhat disappearing. I hope you can follow. If you look on the right side of the exhibit, you can see that the sales price we have agreed is around $1,200 US per ton. We estimate the cost for the raw material to around 220, can be lower as well. And then we estimate the COGS and OPEX needed to produce our pulp at around 460, which means that we estimate a gross margin of around $520 US per ton, which equals around 43% of margin. This estimate or this calculation is based on a plan of 120,000 tons. And you need to keep in mind that the initial size or the initial capacity of the site will be 60,000 tons. If you then look on the left side of the exhibit, we sell our pulp for $1,200, and then we have customers that turn this into fiber, and doing this will add around $900 to $1,000 US per ton, meaning that the fiber price of our circulose will be around 2,200, which is, when you compare it to the other sustainable brands or fibers, a pretty low price. So all in all, we believe that we have possibility to increase the profitability, but given the fact that we have such good margins, we think it's more important to create a pool for a product and to, as fast as possible, reach higher market share. So it's the growth that is the most important, and not to optimize our margins, given the fact that we have a very nice margin. Yes, you can move on. Here are some of our financial or our targets. So we aim by 2026 to have a production capacity of around 250,000 ton. and an EBITDA margin of around 30 and an equity ratio of 50. And we hopefully have launched with about 20 global brands with our own brand, Circulose. And then if we look at 2030, we hope to increase to 360,000 tons and exceed the 30% EBITDA margin and also the equity ratio above 50%. And we hope to have launched with 30 global brands by then. Just to give you an idea, that if you look at the size that we have as a target of our capacity of 250 and 360 tons, if you remember the size of the total market, and of course not the full market is completely addressable for us, but given the total market size, this is still these volumes are still quite low. Yes, you can move to the next. A little bit more about the financing of the project or the company. If we start on the upper left side, the sources and uses, as I mentioned, we raised equity, 800 million during the IPO of the company at the end of 2020. And then we have agreed on a loan facility with, it's a Finwire, a backed loan facility by Svenska Exportkredit and Nordea of 409. And we have an agreement with EIB on a loan facility of 311. These numbers add up to 1.520 million. So here there is a buffer of 20 million because there is some flexibility in these agreements. So, but the total amount of capital raised, including the loan facilities, is 1.5. Of these, we believe 870 will be used for building the actual facility. Keep in mind it includes a reserve of around 113 million. And then we believe there is a need for covering the OPEX of 220. And then we have other operations that will require 160. And then we have a 250 million left as an additional buffer. I forgot to mention that in the 220 we have a buffer as well here of around 100 million. So all in all, we have a buffer of around 460 million SEK. The first two ones, the 130 and 100, are easy to access. The 250, the last reserve, are more difficult to access. Nevertheless, we have significant buffers. Looking a little bit at the risks, there are of course significant risks related to a project like this, but I think we have been able to mitigate many of them. First of all, we have a very experienced team with people that have built these type of factories before. Also, we use we were establishing the plant in a brown brown facility, so we don't need to build the property ourselves, which also is very often a main reason for delays and increased costs. Thirdly, we use a lot of standard equipment. So I would say 80-90% of the equipment we buy is standard equipment. So it will be easy for us to have specialists that can help to find them to help us installing and serving and so forth. And of course, last but not least, we have these financial reserves as well. And the environmental permit risk, of course, but we have received the permit as we have, as you might have read. that was actually the beginning of July this year. If we look at the right side of the exhibit, I will talk maybe a little bit more about this, but in general, we have a timetable that estimates that we will finish the commissioning by the end of the second quarter 2022, and until now we follow that plan very well, and we do not foresee any significant delays. Okay, we can move to the next exhibit. I think we stay here. I think this is a short, brief summary. So again, there is a massive need for circular fashion. NewCell has a commercially proven solution, and what we try to do is to invest to be able to, as soon as possible, scale up our capacity. So now my 20 minutes are over. So I suggest that I open up for questions.
Thank you, Hugo, and thank you for a very interesting presentation. And I start off, you mentioned that by 2025 you will have target to have 20 global brands. I don't know if you can disclose how many brands you have today that you cooperate with, and also when you work together with them, what type of clothes are used mostly for your Circulose product?
We work with a lot of brands, and there are a lot of brands that we actually need to reject because we do not have the resources to cooperate with all the brands. So we have our own short list that we work with. We work, among others, with of course H&M. We work together with Levi's. We work together with Bestseller. So Vera Moda, Kapal have launched with our Circulose. Now I partially answered your question, I think.
Yes, you answered that. So I mean, you're on a good track. If we continue with this Circulose, the product that comes out of your factories, how do you work together with the global brands when it comes to marketing this Circulose? I mean, most of the consumers today want to know what kind of content is included in food or clothes. So it would be interesting to hear a bit about how you develop the brand together with them.
Yeah, well, so we have our guidelines. So in order to have on a label that it's a piece of clothes is produced with Circulose, it needs to exceed 50%. So it needs to contain 50% at least of Circulose. The way we work with brands is, I mean, you can use Circulose for more or less all type of clothes, and it's of course very dependent on how you make the yarn and how you create the fibers and stuff like that. But in principle, you can use Circulose for any clothes, and that's also the reason why we cooperate with all type of brands. So we work together with the big brands like Hennes & Mauritz that have the large volumes, but we also cooperate with brands that are more focused on luxury clothes in order to show that we can or that Circulose can be used in clothes with luxury brands, with high quality and low volume brands.
Okay, thank you for that. Over to this new plant that you're working on in Ortviken, Sundsvall. You mentioned that will be H2 2022. It will be up for production. Is there any data points we can follow when we know that is on track? And Also, by 2020, will it be full capacity from day one, or will it be a gradual ramp up of capacity to the 60,000 tons?
Yes, it will be a gradual ramp up, of course. Of course, yes, it's a gradually ramp up, and that's because, of course, in a new site, we need to trim or optimize the different production windows depending on the different feedstocks that we use. So that will take time. So the second half year we will most likely not produce at our intended capacity. And in order for you to follow, we have in our latest quarterly report, we show a table that gives an idea on the different milestones. And of course, these are not financial milestones, but project milestones that we will report on going forward. So that's a way to follow the progress.
Thank you. I have a last question then. NewCell, can you, with a short sentence, maybe explain how unique you are as a company? Do you have real competitors out there with this kind of technology that is developed, or are you a true unique company?
Yeah, there are some competitors, of course, but there is so far no competitor that is actually able to do what we can. And what I mean with that is that we can use 100% recycled textiles for producing our circulose. So we have competitors like Södra, for example, is in the industry, but they use tree fibers, but they always need to add virgin fibers in order to recycle their fibers.
Thank you, Hugo. I have many more questions, but we don't have the time. But it will be very interesting to follow the journey, and also how it will be with the new plant in Sundsvall. So thank you very much for the presentation.
You're welcome. Thank you yourself.
Yes, hi everyone and welcome to our next presentation. My name is Daniel Torsson, covering the IT sector here at ABG in Sweden. The next presenter will be CAG Group with CEO Åsa Landén Eriksson. So I welcome you to start your presentation for some 20 minutes and then I will end up with a few minutes Q&A.
Thanks a lot, Daniel, and welcome to everybody who's listening in. My name is Åsa Landén Eriksson, and I've been the CEO of CAG since March 2018, so almost 3.5 years. You can move on to the next slide, and I'm going to jump right into just giving you a brief overview of what our history looks like. As you know, probably CAG is such a magical mix of a stable IT consulting company with broad and cutting-edge expertise within several areas within IT. And last year, 2020, our revenue was 533 million Swedish kronor, with a profitability of 8.4%, adjusted for acquisition-related costs mainly. And as we speak, we have roughly 375 employees, centered mostly in the Stockholm area, but also in Uppsala and Linköping and other defense-related locations, I should say, like Enköping and Krokom, close to Östersund. We've also been paying out dividends for a long time. And I'll give you also, if you move on to the next slide, Daniel, I'll give you a reason for why I think that you made a good choice listening in to us today. Why CAG as an investment? Well, we think we have a really well-balanced sector mix, especially maybe after the acquisitions that we made this year. We've been focused on the public sector for a long time, so we have roughly 50% of our revenue in the public sector, where of defense is slightly over 20%, and that's maybe something that sticks out a bit. We are very strong in the defense sector, I would say, and that's for many reasons a sector that we believe will continue to develop well over the next many years, actually. We also balance our revenues as a pure, IT consulting company with more stable, often 3-year agreements in our IT service operations business. So that's more of a recurring revenue business model, which is kind of nice to have. It gives more visibility. And regarding the IT service operations revenues, it's mostly within the banking and finance sector and also some other service companies like legal outfits and so on. We have fantastic customers within the sector, and I'll come back to that a bit later on. Also, it's a profitable sector for us. We also have, as I said in the introduction, cutting-edge expertise in very interesting technology areas, such as cybersecurity, where we are active both in the defense sector and the civilian society, private companies. We run secure IT service operations, as I mentioned, with recurring revenue. We're very heavy, I would say, on systems development, and by that I mean .NET within the Microsoft stack, Java, also very strong in testing and test automation. And one of our acquisitions this year was a company within the BI and analytics space where we were already somewhat active. And that's also a very interesting area, given the explosion, I would say, of data-driven business models for the customer sector. And cloud solutions, of course, they tie into our IT operations. Looking at CAG as an investment, we realize that our organic growth is important, but also we are an M&A-driven company. Of course, we grow by making acquisitions in addition to organic growth. And we're looking, I would say, pretty strong financially. We have a strong balance sheet. We have a long history of stable dividend payouts, and we have an ambition to increase those. We have a good structure and company culture. By that, I mean that we have at present 9 independent subsidiaries. So I usually say when it comes to M&A, if you're a consulting outfit looking for a new home with CAG, you can sort of, as we say in Swedish, you can both have the cake and eat it. That is, you can run your company mostly independently, but you still get lots of support when it comes to frame agreements, marketing, financial support, and so on from CAG. And we're also very proud of our institutional owners that I have a slide on later on, and our high share of employee ownership. And I, of course, follow myself the pilot school, so I'm pretty invested in CAG, and I'm happy about that. Okay, you can go on to the next slide, and I'll give you a very brief, you might have read this already, but our Q2 this year, we had a turnover of 172 million Swedish, which was an increase of almost 23%. 16% was acquired and 6.6% organic. And admittedly, we did face, a COVID quarter, if I may say so, of last year. 2020 Q2 was maybe the weakest quarter, but still for us pretty strong organic figure. And we are also very happy with the margins that we showed, which in fact is over 2 percentage points higher than last year if you disregard the effect of the reduced employer contributions that the government put in place for all Swedish companies last year. And excluding that, we haven't received any money for whatever it's called, korttidspermitteringar, the reduction of work at all. So an adjusted margin of 9.7% from Q2. And that also translated into an increased profit per share. And if we just look briefly at the next slide, Daniel, we can then see that for the first half year of 2021, we had a turnover in 333 million SEK, which was an increase of 18%. And given that we had a slightly weaker first quarter of the year, the margin is a bit lower at 8.9%, but still a very good increase over last year, and an increased profit per share as well. And these numbers are, of course, in our quarterly report if you should wish to read that in more detail. Just to give you a feeling for the events that happened during the quarter, we can mention that, on the picture to the right, you see the CEO of our IT operations unit, Johan Sundbo, and Linus Westling, who is the CEO of LC24, that we acquired coming into CAG on July 1st. We're very happy. It's a small acquisition, but they fit us really well, so we're really happy about that. And this is something that happened in April, and we're still very proud of the fact that our CEO of our cybersecurity company, Engvall Security, led the Swedish national team to victory in the world's largest national cybersecurity competition, Locked Shields. So since we are presenting at ABG, I have to mention that Sweden actually beat Norway in this competition, which is not easy, so we're happy. We also took an important project for us that was led by our newly acquired business intelligence unit, now within CAG Detta. And that was a project with Mathem, a Swedish food retailer, online food retailer, for a performance management platform that's budgeting and planning and financial reporting. And that's a partner software that we work with. So that's a very fun project at a very interesting customer, where we of course hope to add lots of value to their business. We had a prolongation of a frame agreement with Finansinspektionen. And we also actually, this is a very current issue, the environment, of course, and the climate. And we certified the parent company, CAG Group, and 2 of our subsidiaries according to the environmental standard 14001. So that's some of the events that happened during the quarter. But I am going to talk a little bit about what we do also and for whom we do it. So exactly, we can look briefly at this side just as an introduction. I already mentioned some of these segments that are important to us: banking and finance, e-health, defense and cybersecurity, and also retail and services, where we now have actually 18% of our revenues. It's been increasing in importance since we, on January 1st, acquired a company called Ateles, which is active in the e-commerce space. So that's also something that we're pleased about. It's been a tough ride over the past few years for the e-com businesses, with lots of opportunities, but also with COVID, something that's had to, take into account that some customers have had to close down and so on. But very interesting segment. So if we go to the next slide, I actually brought with me an illustration of the breadth of our customer base. And I can point out, for example, in the financial segment, Fjärde AP-fonden, one of our owners, actually, Clients. We have Nasdaq, of course, many portfolio managing outfits in the financial sector, and also some of the actually larger venture capital companies, but also then the major banks like SE-banken and Handelsbanken. If we look for a few customers within the industrial segment, it's nice to be able to point out Xylem, for example, which works with, among other things, with water solutions, so helping to the environment to improve, and also Profoto, which is a company that was newly listed and is doing really well, so that's kind of fun. Looking at the e-commerce space, you find, for example, Boots, the British pharmacy chain that's also very active in Norway. It's a blue chip customer of ours. And also Kinto, which is Toyota's solution for car sharing, is a good customer of ours that we're proud to be working for. Looking a little bit at the public sector, I can mention, if you look in the lower left corner, Tillväxtverket, which has been a customer of ours for a long time, and where it's been very busy this past year, building out and adapting the systems that actually regulate the COVID-related state subsidies that have been given out to companies. Of course, the business rules for these subsidies and the process and has to be refined, and that gives us a lot of work on the IT side. So that gives you maybe a bit of more of a feeling for what we do for the customers. I'll come a little bit back to that in a while, but I thought we should glimpse at the next slide, which gives you a brief overview of these segments that I've been talking about. So you see roughly half of it in the public sector, and you see the importance of defense. Sorry, it's not translated, but Försvarets defense there in the middle pie. We could actually move on to the next slide. And as you understood in the introduction, we have a pretty broad technology offering that goes across these customer verticals that we work with. IT management is maybe a little bit of a fluffy term, but most of the work within digitization or digitalization of manual processes, for example, where you have to, you have to look at the process that you want to automate or digitize in a professional way. That's something that we can help the customer to do. And we also do lots of work as project managers or agile leaders, as is often called, the new way of running things a bit more in an agile way. In the defense sector, we do lots of, Swedish is often called beställarstöd, but also a term, it's systems engineering, where we look at the requirements for acquiring, for example, a material systems like an air defense system, or it can be an IT system too. What does the customer want to acquire? How do we specify that? And then plan out everything from actually acquiring the system, implementing it, maintaining it, and also decommissioning it. So the whole life cycle, it's something that we do quite a lot of. In systems development, I think I already mentioned this, .NET, Java, testing, automation, integration. And within IT service operations, I should not forget to mention that not only is this office-related IT services, it's also application management of financial expert systems like the portfolio management system SimCorp Dimension, which maybe some of you listening in might use. We have also launched the past year something called the Security Operations Center, and that's a nice synergy between our cyber defense unit and our IT operations. And that's a more offensive, proactive cybersecurity surveillance service, you can say, that is often tied into the fact that we already manage customers' IT services, like the Wi-Fi's and the fixed networks and the related equipment and software. This is a more proactive way of trying to make sure that you don't get IT attacks. Training is a very small business. It's mostly related to agile project management frameworks and test automation. So just to finish off with a few remarks, as you know, we are mainly a consultant company. We're active in the IT space, which is seeing, lots of competition over available personnel, recruits out there. So it's very important for us to be a great place to work. And we've been working with the company Great Place to Work for a few years and have a very good score, and not actually a higher score during the COVID year than we had before. So we've done at least something right to keep our employees happy and productive over this past year. And we are a very earnest company, I would say, with very strong values. We have our independent subsidiaries, and we make sure that our employees feel that they are valuable to us, they're seen by the management, and they're cared for. So our values is competent, caring, and we have a long-term value perspective. We have these in Swedish, really, so kompetent, omtänksam, och långsiktig, which is a sign in itself of our culture, I would say. Okay, the next slide, because I think despite trying to be quick here, the time is very short, and I just wanted to show this slide, which we put together before we listed the company in December 2018. It's been unchanged since then, and it just goes to show that these trends that drive our market, I would say, they are very long-term trends, and they're not going to go away. So despite, both public and private institutions and companies have been working with digitalization, automation for a long time, there's so much left to do, so much left. One project, for example, that we do with Skolverket is digitala nationella prov, digital national tests for students. That it's not done yet is a sign of that this trend is here to stay for quite a long time. Business-driven IT, I think it's very exciting to tie together, for example, e-commerce and business intelligence and analytics and recommendations, and with our systems development and cybersecurity area. So these trends are here to stay, and my message here is that there's a lot left to do in this market. So we're here for the long term. just 2 brief slides left. I can't resist to just point out, I mentioned we're very proud of our institutional owners. Our chairman of the board, i.e. my boss, though, is the founder, you can say, of CAG, and of the company that's C in the name. He still owns a bit over 20%, Bosse Lindström. But we also have with us Creades, a highly blue chip successful investor. We're very proud of that. And Nordea Fonder, Nordea Småbolagsfond, that we came to join us when we listed the company, and also clients who joined a little bit afterwards. And in addition to this, as I said before, the names that you see on the list, and my name is slightly below the 10 largest, is our employees in the company, and that's of course very important to us too. We like to be engaged in the company. And I'm going to finish off with just a remark on the future. So our plan, of course, is to keep working on M&A, keep working on innovation, put a lot of effort actually into organic growth. Recruiting is a tough task, but we're going to do our utmost to attract and retain employees and try to stick out so that we get the best recruits. We're very experienced consultants, so we need to be good at it. We also want to develop our recurring revenue business, of course, by complementing the services that we do within IT operations primarily, like the security operations center, private cloud, and services like that. And also keep focusing on having an efficient machine, I would say, on the consulting side, utilization, sales, pricing. And of course, to do things like this, to be active in our internal, external communications, and not least also make sure that we get across that we actually contribute to a sustainable working environment and to a positive effect on the climate and the environment. And our values are very long-term and earnest, I would say. So that's it. Maybe did I manage to hit my 20 minutes, more or less? More or less. Yes. So Daniel, I guess it's your turn.
Yes, absolutely. Thank you very much, Åsa. That was a great presentation. I think we have a few minutes left for some questions from my side. If I start off with, we see many signs of the IT services sector really accelerating post-COVID and also post the summer now, short term. From companies, and we see that from market research agencies as well. What do you really see in the current market? How is demand? Is it strong, or how do you find it?
Yeah, we have a positive view of the market. We can see that there's lots of interesting projects and lots of requests from our customers for more resources and projects starting up. So yeah, we have a positive view of the market and demand.
Mm. And I guess that the main challenge, you touched upon it briefly in the end here, recruiting and net recruitment going forward. We hear that from many companies, it's the main challenge to meet the high demand. How are you working on that practically to be a strong brand and to attract talent?
We started a new model actually from January, where we actually hired a central resource to work with sourcing and to assist our subsidiaries with recruiting issues. So that's good. At least our processes and our interviews and the things that we can control in that way, we should be excellent at that. But of course, attracting people even to come and listen to us is also a question, like you mentioned, of brand building and being visible. So we are, working on doing more with that. We're launching a new website, and we are thinking hard about some messaging that can put us more on the map. We have to work across the board with this. And of course, also internally to use all our available resources, like all our employees should be aware of, our hiring needs and We have just done an internal campaign to remind everybody that we have a cross-company recruiting bonus. So if you work in the defense sector and you find a candidate for the banking consulting side, you also get a reward for that. So we're trying to do everything we can to stick out and use what we have.
Okay, I see. It's a challenging task. And then just a really final question from my side. Typically in a downturn, which we saw in the pandemic and COVID last year, the non-cyclical sectors and the public sector tends to hold up relatively well. But then post a downturn, you see that the cyclical end market is coming back and the public side is coming down a little bit slower. Do you see any signs of slower demand or lower demand from the public side, or are they still keeping up at a high pace right now?
Yeah, we haven't really seen anything like that. I mean, our plus 20% in defense, I would say, unfortunately, our nation's situation is such that we need to keep putting resources into our national security, of course, and with that comes all the cybersecurity and the other, projects within the defense sector that we see will continue for a long time in the future. We also see that we have good public financing, public finances still. So we have really, and when it comes to e-health, I think the activity is actually picking up because that sector was a bit paralyzed by the sort of acute COVID situation, and some of the necessary IT developments and improvements didn't get done. So I think some of it will increase actually.
Okay, interesting. Thank you very much, Åsa. I think that was the time that we had together. Very good presentation. And for everyone listening in, feel free to reach out either to me or to Åsa at CAG Group for further questions.
Absolutely. Thanks a lot, Daniel. And thanks everybody for listening. And do have a look at our website if you wish. And there's also a podcast actually out on Spotify and SoundCloud that you can listen into if you search for Investeraren. Okay.
Yes. Thank you very much, Åsa.
Yeah. Thanks. Bye-bye.
Bye.
Hello and welcome to ABG Investor Day. My name is Simon and I'm an equity research analyst here at ABG. I have the pleasure of welcoming the CEO of Clavister, John Westberg. John will hold a short presentation of the company, and after which we will have a short Q&A. John, the floor is yours.
Thank you, Simon. So thank you. I'm John Westberg. I'm the co-founder of Clavister and CEO since 2017. So if we take the next slide, please. For those of you who are not completely new to Clavister, I will give you a very quick introduction. So we are all about cybersecurity. So we develop and sell what we refer to as carrier-grade cybersecurity solutions. We provide those to mission-critical applications, mainly for selected markets within the European Union, but also globally through some key partners. And if we click forward there, during the 20 years approximately of Clavister's history, we have been shipping a bit over 130,000 products worldwide. We have a very strong gross margin business with over 85% gross margin, sustainable gross margin of over 85%. And we have a decent amount of recurring revenue, which is also a metric which is absolutely important in terms of creating shareholder value. And it's a metric that is constantly increasing. If we move to the next slide. The core of our business is, of course, our technology platform. And we claim that this is a platform that is one of, if not the most versatile platforms on the market. We have been investing over these years a bit north of 60 million euros into software R&D. And I would claim that the vast majority of that investment is not a sunk cost. It's live production technology that we sell today. We support over 40 distinct cybersecurity use cases with this platform, and those ranges from things like firewalling to antivirus to user authentication and to more advanced threat protection type of use cases. And one of the key distinctive features of our platform is that it's entirely designed and developed here in Sweden. And that is important for a number of reasons that I will come back to. We also used to say that this technology follows the customer the entire journey from the individual user to the device, through the network, even through automotive or connected cars and into the cloud. If we then move to the next, please. In order to make our technology a bit more sort of tangible and understandable for our customers, we have established or derived a number of specific solutions based on this platform. So we have 6 solutions that we take to market today with next-gen firewalling, secure SD-WAN, our identity and access management solution, our 5G security solution, Cyber Armor, and the latest is our secure access service edge, which I will get back to. It's really worth emphasizing that even though these might look like 6 very distinct and discrete solutions, they are all inherited or all built upon our common technology platform. So to make an analogy from the automotive world, you have a single platform. From that, you build different models. This is the same concept here. So we have a set of R&D initiatives that we drive, but all of those will feed all of those solutions. So no individual R&D tracks for the individual solutions. If we then move to the next and look at some macro trends that are relevant to Clavister. Of course, a general one is the increased digitalization that happens across the board with strong drivers for security, identity, and so on. Especially in the pandemic era, it was very clear that the work from home or work from anywhere initiatives really was driving this part. There is also a number of regulations that are either implemented already or in the process of being implemented. One example is the EU Cybersecurity Act that was established in 2019. And all of these, specifically the European regulations, have a good positive impact on us as a European supplier. Naturally, the adoption of 5G, the explosive growth that is expected to happen or is already happening in mobile data, that drives demand. Also the fact that, you know, cybersecurity in the past was a quite distinct operation. You had a problem, you bought a product. Nowadays, it's so complex, so no one can really longer use a few products to address a very complex problem. So that really drives demand for more comprehensive solutions, such as the technology platform that we have. Of course, the cloud services adoption rate increasing is driving growth as well, and not the least, the increased geopolitical tension. So as most of you know, all of you know, the increased suspicion from governments on non-EU, non-Swedish technology, especially for Swedish government agencies, of course, that drives not only demand, but also clear directives from governments and agencies into really looking into what is the technical origin of the cybersecurity solution you're using. And again, as a European Union company, that really is important for us. I'll move to the next. We are obviously, I mean, we're operating on a very fast growing market, a very relevant market, obviously. And for us, the best chance to drive shareholder value is, of course, to drive growth. We have a very clear growth strategy. It's founded on 5 distinct key pillars. From left to right, a focus on few selected industries where Clavister is most relevant. Our upcoming SASE solution, our transition from having been a product-based company or a tech company into more of a value solution sales company. A big transition that we're carrying out this year from quite a lot of perpetual one-time license sales into a full recurring revenue business model. And then finally, looking at, you know, potential acquisitions that fits into our strategy that will help us either to bridge technology gaps or get us access to market. If we move on to the next one and just look a little bit more detail into the industrial focus. We are, of course, still a small company. We need to pick our battles. And following quite an extensive research that we made in 2020, we arrived at a focus strategy. We decided on 3 distinct customer groups or industry verticals, if you like, where the public administration sector, mainly within EU, the service provider segment, including mobile operators, managed security service providers, even internet service providers, adding security as a value add, and finally the defense sector. Those 3 areas have become the 3 focus customer groups for Clavister starting this year. The common denominator between these 3 areas is the lack of cybersecurity in those areas could have quite fatal consequences, ranging from sensitive public administration data being leaked to severe interruptions on communication. And in the defense segment, obviously that's as fatal as you can come with lack of proper defense, proper cybersecurity. If we then move to the next one, I'd like to just show 2 specific customer case studies just to give a bit more insight into what we provide more specifically. One is with our partner Nokia, which we have been working with since 2016 as a partner. Nokia started to differentiate themselves in the telecom industry by making cybersecurity as one of their strategic pillars. And they selected, after quite an extensive selection process, they selected Clavister as their partner for several use cases within both 5G as well as 4G deployments. So we're today part of the Nokia 5G core offering. We're built in part of their blueprint design for 5G core. We have together with Nokia and together with other partners as well in this industry, deployed to over 30 tier 1 mobile operators. We have a business model which is quite interesting, where our revenues scale with the increased usage or utilization of the solution. And as everyone is buying into the concept that utilization and bandwidth is just growing and exponentially growing, this is obviously a fantastic potential scaling engine for us going forward. If we then move to the next one, demonstrating another customer use case from the defense vertical. We are working with BAE Systems as a quite recent customer win. As everyone probably knows, BAE Systems is the largest defense contractor in Europe and the 3rd largest in the world. There is a strong push within the defense sector to equip various types of defense material with cybersecurity. There are NATO requirements, there are customer-specific requirements, but the common thing is cybersecurity has to be implemented in modern defense technology. So what we did together with BAE Systems is we arrived at a framework contract, which then led into our first commercial contract for a Western European military customer. We are providing our technology packaged into a very ruggedized and robust defense-specific hardware platform that in turn gets integrated into the combat vehicles and the bandwagons or all-terrain vehicles that are produced by BAE Systems. The first customer contract we won again with the Western European organization was worth 50 million SEK or 5 million euros to Clavister, and has the additional potential up to even 90 or close to 100 million SEK. If we move to the next and look at sort of one of the examples of the go-to-market model, we stick now within the defense segment, just showing you an example how scalable this go-to-market model is. And if you continue to click forward, basically with our partnership with BAE, with our first framework contract, we are able to indirectly address many different customer opportunities. And as you recall from the previous slide, each one of them has a value to us of several million euros. Now, this is only with one type of vehicles. We can complement that to other types of vehicles. And if we go beyond BAE, if we click forward, there are, of course, other system integrators or OEMs that we are already working with or have as targets. A few examples being Saab, another example being Digital Cloak, a system integrator in Virginia, where we approach the US Department of Defense through our partnership. We recently started a proof of concept for the US Marine Corps, and that entails our identity solution. So that gives a quite good picture of how scalable the go-to-market model really is. If we then move to the next and look at our SASE solution. So SASE is another of those fantastic tech acronyms, obviously. What it really is, to sort of explain it in a simple way, is that, well, first of all, it's one of the hottest trends within cybersecurity right now. And to put it simple, basically taking as much relevant cybersecurity technology as possible, package it into one common or under one common umbrella, and deliver that technology as a cloud service. That's really what SASE is all about. The analysts are quite bullish about this type of solution, and they claim that by 2025, so less than 4 years from now, 60% of all businesses, all enterprises will have a strategy in place to implement SASE. Now, what's our role in this? Well, we are taking a SASE solution to market towards the end of this year. We have been building on this solution for almost a year. And if we move to the next slide, one of the key benefits we have compared to many other cybersecurity vendors who deploy SASE is that given our 20-year history and our strong R&D investments, we have a lot of the intellectual property already that make up a big part of a SASE solution. So what this image shows you is the white boxes are already Clavister IPR. There are a few technology areas where we partner, and there might be a few where we need to look at either acquisitions or partnerships. But the key thing is we hold so much of the technical IPR, which means that we can become more relevant to the customers. We can be extremely flexible with our licensing terms. We can provide this not only as a service to specific end customers, we can also license the entire platform to larger OEMs or larger system integrators who would like to run their own service. So the go-to-market possibilities for this service is really amazing. If we then move to the next. We have been operating quite many different business models over the years for legacy reasons, for historical reasons. And as everyone knows, for a software company, the key metric that drives shareholder value is annual recurring revenue. And we have been having quite a lot of our revenues into perpetual one-time fees over the past. But in this year and being launched at 1st of October, we are moving or consolidating all our legacy business models into a single term-based or subscription-based as a service model, where we move as much as possible of the total contract value into a recurring model. So that will, as a consequence, drive our ARR, continues to drive that up. It will have a lot of other benefits as well, higher visibility on our revenue streams, hopefully reduced churn rates, and for our customers, it means a lot of less upfront investment moving from a CapEx to an OpEx-based model. So this is absolutely a key strategic move we are making. Naturally, as in all of these types of transitions, it might have an effect super short term on net sales recognition and on cash flow, but from a valuation point of view, this is absolutely the right thing to do and the right timing as well. If we then move to the next. This is showing actually the trend of how our recurring revenues has been increasing already, even though we have not systematically put the systems and the business models in place until now. But through our work and through the type of products mix we have been moving towards, we have already now an increased recurring revenue, which is quite stable. If we then move to the next one. Again, our future is all about growth. We have since 2017, when we started our transition from R&D heavy tech focus into more commercial focus, we've been driving a growth agenda. And the order intake average growth has been a bit north of 20%. Net sales a bit lower. That's due to a lot of our engagements are with larger customers with longer deployment cycles, where of course revenue recognition and net sales recognition gets distributed over time. So it's important for us to have a close look at the order intake metric as a leading indicator for our business. What will accelerate and drive this growth forward is some of the key things I've been mentioning. It's a more focused go-to-market strategy, bringing very relevant security solutions on a market which is fast growing. Our new SASE solution that allows us to tap into another market actually, or the massive cloud security market. This recurring revenue will support the growth in several ways. It will free up sales resources to drive new customer wins and new logos, and still maintain a good customer attrition rate or customer retention rate. And then on top of that, we are, as mentioned, we're considering potential acquisition targets that are aligning with our strategy. So with that, I think I'll stop there. There are a couple of more slides, but in spirit of time, to keep to the 20 minutes, stop there and take questions.
Great. Thanks, Jan, for a great presentation. I would like to start off with the Bay system contracts. Should we expect that this order contains more hardware sales, and in turn, will this lead to potentially lower gross margin going forward?
As a total blend, it will not dilute gross margins that much. And the reason I'm saying that is that, of course, the initial product deployments have a substantial hardware in it, and that in turn, of course, drives gross margin down a little bit. But on top of that, we have a number of services that are being added, and there is a big aftermarket portion with support and services with much higher gross margins, and that is compensating that. It might be sort of a shift in time over time, but as a blend for the total contract, it does not really change the needle that much on our total gross margins.
Great, thanks. And the SASE solution, will you sell it through partners or will you go directly to the customers yourself?
We will probably see a mix of those. There are certain customers that would expect us as a supplier to be in direct contractual relationship with them, and we're happy to do that, of course. There are other customer groups, for instance, public administration, how it works here in Sweden. You need to have certain frame agreements with the customer, the government customers, etc. And in those cases, it makes sense to go through a partner. And also in some other areas, for instance, other parts of the world, which is not our focus, we might license the technology platform to a service provider who deploys this on their own turf.
Great, thank you. And what would you say is the roadmap to profitability? If the strategy is to keep OPEX flat at this level and grow sales, for how many years do you think you could keep the OPEX level on this level?
I mean, clearly, it's a combination. Given that we are in a such high gross margin business, the main driver to reach profitability is, of course, increased top line. That goes without saying. At the same time, keeping a strict control of cost, and the only cost item that we really will be investing in is additional go-to-market, because obviously that's driving growth, and with this type of gross margins, any additional sales headcount, any additional go-to-market investment is self-financed, at least over a limited period of time. So keeping control and strict cost control, but with the highest focus business-wise on driving top line.
Okay, thanks. And you hired a new sales manager this year, Mats Wenner, with experience from Nokia and Ericsson. What will he bring to the organization? And do you expect that he can help you accelerate the 5G business?
What Mats and also other senior recruitments we have done recently will bring to the organization is several things. First of all, an industrial experience that we need to lift our team as we continue to grow the business. We need to add and fuel with more and more senior personnel. That's clear, and Mats is one of those. The fact that he has a strong background from the telecom business and the networking industry is obviously a great bonus to that. The understanding of how Nokia is working in the past, Ericsson, NEC, of course, that's a big benefit of driving and building the telecom business and service provider business in general. So yes, the answer is we hope that the recruitments we're making, the investments we make in general in go-to-market, we do that for one purpose, and that's to drive and accelerate growth. And yeah, that's what we expect.
Okay, thank you. I think we have to stop there, but thank you so much, John, for a great presentation.
Thank you.
Yeah, goodbye.
Thank you very much.
Hello and welcome to this next presentation here at ABG Investor Day. My name is Simon Granat and I work as an equity analyst at ABG covering IT and tech companies. With us today, we have the pleasure of welcoming Christian Sundin, who is the CEO of Formpipe. And with that said, Christian, please go ahead and present the company.
Thank you, Simon. As Simon said, I'm Christian Sundin, the CEO of Formpipe. I've been with Formpipe since 2006, so quite a long journey for me. I would like to go through the agenda for today. So, Simon, if you can help me with that, thanks. I will have just a very, very short glimpse on Formpipe and what we do, what sort of company we are. But I also spent some time on a short recap of where we're coming from, the recent years and what we've accomplished. And then I will put most emphasis on what we're doing now. And we're actually entering a new era from the start of this year, where we have refocused for growth rather than transforming business model and improving margins. So we are in a very interesting phase of the Formpipe journey, and I would like to take most of my time for describing what we will do with that. So going for the next slide. Starting with Formpipe in very brief, we are a software company within content services. Very generic name, but mainly it's bringing good structure and order in digital information, very much like the ERP systems, but for words and documents and cases. We have our roots in the public sector, where public sector has been front runners in terms of traceability and auditability of decisions, public records, and so forth. That's where we have our roots. And today we're addressing clearly the public sector markets of Sweden and Denmark, and foresee going to other countries with that as well. And then we have approximately a third, and the most fastest growing part of our business is towards the private sector, with an international partner network, where we are actually a slightly different offering there, where we do document management mainly towards the ERP or banking systems, such as Microsoft Dynamics ERP or Temenos banking system, and so forth. We are today about 270 employees and are growing, recruiting, and that I'm coming back to that on why we're doing that. With the majority of the presence of people are in Denmark, Sweden, and UK, but also sales resources, partner support in US and Germany. Next slide, please. I said that I was going to go back memory lane a little bit and what we've been focusing on the recent years. And first of all, we've really pushed for shifting towards SaaS or subscription model revenue or contracts with our customers. And this graph illustrates the effects on that we're coming from yearly ARR numbers on SaaS on about 10 million a year in Swedish, now being well about 50 million in ARR coming out of last year in 2020, and we've continued to grow that significantly during this year as well. But you can also see the trailing down on traditional license sales, meaning coming from levels above 75 million a year in traditional license sales, we're now closing into 30 million on that, and that is of course 45 million coming straight out of the top of our revenue line as a company. So, but as you see, the lines has crossed, and now since the SaaS will continue to grow, and the traditional license sales can never go below zero. So we will soon start to see the real effects of this transition, also on our top line numbers. Next slide, please. Underline even more, stressing the point even more on what we're coming from. Looking on this multi-year plan history, going back, you can see going for example, 2015, we had only 6% EBIT margin, and we only had 156 million in recurring revenue. However, we had a completely different revenue mix back then, with more consultancy and more traditional license sales. So looking on the net sales, the top line, the journey from 350 to 400 doesn't look very impressive. But we looking on the line recurring revenue, which is the strategy we have pursued, driving the recurring revenue. It's from 150 to 250, an average growth rate of approximately 10% a year during this time. So the part of our business that we really wanted to grow, we have successfully grown, and we have been able to combine that with improving margins, going from an EBIT of 6% to going up to 13% in 2020. And that is, of course, a real challenge to take out top line, replace that with recurring revenue, and still be able to improve the margins. So those has been our main objectives during this time, and we've successfully executed on that strategy and those objectives. Next line, please. Next slide, yeah. And that has led us to the situation we are today, and enter this year, that we have more than 60% of our total revenue is recurring revenue. It continued to grow as part of our revenue, and we have grown that with an annual growth of 10% a year since 2016. That gives us the confidence and the stability and the cash flow generating of entering the next phase of the Formpipe journey. Next slide, please. And that is what I'm coming to spend the rest of my presentation on, a new strategy for growth that we initiated at the start of this year. Next slide, please. What we've done is that we've looked on where is the opportunities for real growth here. How can we accelerate the growth we already are, the tracks we really are growing, and how do we support that even better? How do we support our partner network around the world to really make sure that our strong network of certified partners get the help they need in order to drive our sales even faster? And we will do this purely through driving software as a service, SaaS and subscription revenue. And we will set out to complement the organic growth with some strategic acquisitions during this journey. Next slide, please. And we see that our company rests on two solid pillars. One is our roots, our legacy, and our where we come from and our heritage in the public sector, where we have a market-leading position in digitalization of Sweden and Denmark public sectors, and where we are very successful in doing that, and we see that that could be a journey that we take all over Europe, seeing with the acquired businesses all over Europe. We think that we could be the benchmark and the trusted advisor in the public sector space all over Europe for digitalization of the public sector. We see this as a solid, loyal customer base. We see good growth potential in it and good profitable growth potential in the public sector space. However, on a less fast pace than the private sector. In private sector, we see really good growth possibilities, where we see double-digit growth for sure, and quite significantly more than that as well. That the private sector, the 34% we see now, will probably over this period of time up to 2025, 2026, be more or less half of our business will be in the private sector. Even though the public sector will also grow, we see even greater growth potential in the private sector, where we see good opportunities and really strong help from our partnership with Microsoft, mainly towards the Dynamics platform that they are promoting in the cloud and in Azure, and also the banking system Temenos, where we really piggyback on their success of gaining market share all around the world, both in Europe and US, but also in other areas. So we will invest heavily, or we are already investing heavily in supporting the partner networks of Microsoft and Temenos, to make sure that we get in there on every deal they do on those platforms. And we will do this yet again over the SaaS revenue line. Next slide, please. So that leads us to that 2021 will really be a year of investment. So we are increasing capabilities in where we're recruiting, and we think we will launch this during early in the pandemic phase. We set out for these plans, saying that hopefully we will be able to attract talent, and there will be talent to recruit in the difficult times in the world, but also believing strongly in that this is the time not to hit the brakes. Quite the opposite, according to our shareholders. It is time to invest and invest for growth, and we go for that rather than sit to wait for the pandemic to end and to hold on. So we push the throttle instead and go full speed ahead. We'll of course continue to focus on our existing customers as well to do great deliveries towards those, but we're really driving now a top line growth. And it is important to point out this will have a dramatic negative effect on the EBIT margins in 2021, where we're really taking on a lot of more capacity in terms of recruitment. Next slide, please. So what have we set out to do? Yeah, we will, during these years, 2021 to 2025, accomplish an average annual revenue growth of 10%. We will, coming 2025, have increased our share of recurring revenue even more of the total revenue, up to 70%. And since our business model is so scalable and the SaaS revenue are scalable, we know that even though 2021, the EBIT margin will take a hit, the scalability of the business model will gradually over this time take us above the current margins and all the way about 20% EBIT margin in 2025. And we also see that this business model is cash generating, it is scalable, and we will be able to continue to pay more than 50% of our profit in dividend over time here. Next slide, please. This slide is to illustrate how the SaaS revenue in more detail has developed over time. You see, as I mentioned before, below 10 million coming in ARR in 2017, going out on 55 million in 2020. And we can already now see the results of the investments we've done in the increased capacity in our partner network around the world. A lot of the 9 million you see in ACV in Q2 comes from private sector internationally. And that is to a large extent thanks to that we have been better in helping our Temenos and Microsoft Dynamics partners around the world. I'm not saying that you will see 9 million every quarter from now. I hopefully see quarters with even higher numbers on that, but it will be volatile, but we really clearly see the effects of the increased capacity, and we foresee higher ACV going forward than we've had historically on this. So next slide, please. And we've also been really successful in finding talents. We've actually increased with 26 employees already from year end, and we're now about to 72-71, and continue to increase the capacity in order to drive even further growth for us. And we've actually seen that digital onboarding is not as a big challenge as we thought it would going to be. It works quite swiftly for us. There's some things that it takes more capacity of current employees rather than that it's difficult to get new employees on board and being productive. So we see great benefits from the digitalization as well. Next slide, please. So in summary, we have a strong track record in delivering on growth of recurring revenue and executing on a strategy. Now when we're shifting strategy and going for more growth, we will be able to deliver and execute on that as well. We have a well-balanced customer base in the public sector and in the private sector, which makes us comfortable to make this investment in growth. We have a market-leading position, and we expect to see good growth in the market in general over the coming years, and we will gain market share in that growing market. The partnerships with Microsoft and the partnership with Temenos really paves the way for us in order to capitalize on the growth potential that is in there. So we see significant expansion driven by the investment in Lasernet product, and we see a rapid conversion towards SaaS, both in the private sector and the public sector. I think that was all from me. Next slide, please. Thank you.
Thank you, Christian, for that presentation. Let's continue this session with a couple of questions from my end. And starting off with the acquisition topic, which I believe is an interesting topic to address, given that it's often a fairly time-efficient way to grow earnings. And last year, you acquired one of your partners. How does your acquisition agenda look going forward? Are you looking for similar acquisitions in terms of partners, or would you like to acquire product companies? What is the current status here?
Yeah, I would say that we have two main M&A tracks, slightly different between the public sector business and the private sector business. We have an agenda in the public sector space of becoming the European market leader on digitalization of public sector, to help the society to improve in digitalization and be really strong in that. I believe, or we believe firmly, that will come through acquisition of companies around Europe that are similar to Formpipe, i.e. have a strong back-end platform for supporting that specific country's legislation on public sector digitalization. So that is the main, to buy others that are strong on platforms. And then what the upsell opportunities there, that a lot of the platforms are quite mature, they're function rich, they're functioning well for the end customer, the municipality or the central government customer. However, a lot of things can be done outside of those, building apps for specific use cases, like meetings administration of politicians, or construction permits, or things like that. That will be done in much swifter way with applications that is through integration is working towards those platforms. Building those add-on software. For example, we just recently launched a signature product, very much alike the Scribes and the DocuSigns, but the public sector space have higher security requirements and integration requirements and nationalization requirements that those guys, even though they're great signature products, cannot really doesn't really fit the requirements of the public sector. We built that and integrated towards our platforms, and are now able to sell that to our entire customer base, regardless of which platform they're running. If we add on more such platforms around Europe, then that extra module or software could be addressed to bigger customer base. So that's the rationale behind that M&A track of the public sector. On the private sector space, I would say there's another type of product companies that we would like to pursue. It's not necessarily our own partners, like the EFS acquisition, which had a product that we were really interested in, but they were a partner, so they were sort of the ideal candidate, since they both were a software company and knew Lasernet very well. However, there's not that many of those targets that we could pursue. We would rather find some other add-on component to Microsoft Dynamics or Temenos, because that's important to point out here. Lasernet is an add-on software to Microsoft Dynamics. And when an end customer buys Microsoft Dynamics, they normally buy they buy that through a system integrator who implements it, and that system integrator is our partner, and they probably bring along Lasernet plus a handful of other software that makes the Dynamics ERP platform stronger, and those other add-ons would be really interesting for us to buy. The purchase to payment process, whatever it could be, because they will most likely also have a partner network. And then we could cross sell in both ways here. Lasernet through that partner network, and that product that we're then acquiring through our partner network. And that would be double whammy in terms of synergies on the sales side. So that is the type of add-on softwares that we're really looking for.
Thank you. And as you described earlier, about 1/3 of your revenue stems from the private business, while you have 2/3 from the public sector. Are these businesses standing as separate units, or are there any synergies between them? How does that work out in your organization?
It's for sure synergies in terms of product development, purchasing power of offshore capacity and so forth. And there's also a lot of knowledge sharing between the different business areas in our business. Commercially, however, we do sell to a very large extent sell different software to the public sector compared to the private sector. And stating the obvious, in public sector it's public sector customers, and in private sector it's international private sector customers. So the geography is also quite different between them.
Thank you. And you mentioned Lasernet, that it's an add-on, especially for Microsoft Dynamics and also for the Temenos banking system. Are there any other systems that you would like to increasingly work with? For instance, SAP or any other system? Could we hear you talk about more about other systems going forward?
Yeah, I might sound a little bit boring now, but it's not a top priority. Lasernet works super fine with SAP, but we don't have a strong footprint with SAP partners. And we have a strong footprint and help from Temenos and Microsoft in attracting new partners and driving that. And we're still a very small company, bear that in mind. And if we should focus our resources, right now I would say our focus is on Temenos and Microsoft. It could very well be in a year or two that we open up for another platform, and that could also be connected to an acquisition. If we acquire an add-on software, as I described, that actually has a strong footprint in the SAP world, for example, surely we would make sure that Lasernet fits into those partners' portfolio as well. And that could be the starting point for adding on a third track. But for now, we see so great traction on our Temenos and Dynamics channels that we want to keep focus on that rather than be too wide.
Makes a lot of sense. And speaking of, we already talked a little bit about net recruitment, and that you have kept a relatively high pace here in 2021. Should we expect a similar pace going into 2022, or have you made the recruitments that you were looking to do?
We're following our plan, and we will continue to add on more capacity, and we are, of course, continuously revisiting our plans. See, should we increase even further? Should we slow down a little bit on some area? What sort of people do we need, and talents or capacity do we need? We realized that we, in our initial plan, thought that we were going to have a lot of need of delivery capacity, while actually our partners around the world, they're quite happy to do delivery for us. And then we, as a software company, prefer not to have a lot of delivery capacity that generates delivery revenue. So we are a little bit shy on delivery people recruitment, and instead focus more on partner support and salespeople in order to help the partners to close deals. So we are revisiting the plans all the time, but I would say you should expect perhaps not as aggressive recruitment the next year as we've done the last 6 months, but not far from either. So that's the level I would say.
Thank you. Unfortunately, we are now run out of time out of this session, but a big thank you, Christian, for attending today. It was, as always, very, very nice to hear all your thoughts about your business, etc.
Thank you, Simon, and thanks everyone for listening. Please reach out to me if you want to follow up call or one-to-one or whatever. So I'm sure you will find my contact details through ABG. Thanks, Simon.
Thank you.
Hello everyone and welcome to this presentation with House of Control. My name is Øystein Lodgaard. I am the analyst that cover House of Control here at ABG. With me today I have Carl Fabian Flåten, which is the CFO of the company. He'll take us through a brief presentation before we go over to some Q&A. So Fabian, please go ahead.
Thank you very much, Øystein, and welcome to this presentation of House of Control. We truly appreciate the opportunity to present at the seminar, and I'd like to thank everyone attending for your interest in our company. Slide 2, please. My name is Carl Fabian Flåten. I'm the CFO and have held this role for the last 5.5 years. Today's presentation will provide you with a brief overview of our history and our current offering. And I'll share some of our plans on where we go from here and our ambitions for the next 5 years. So moving to slide 3 for a quick company overview. We brand ourselves as the CFO's best friend. Our product vision is to provide CFOs with financial control and enable them to optimize business processes. House of Control offers best-of-breed horizontal software to more than 1,600 CFOs across the Nordics, as we have it here. For those of you who have seen our message this morning, we made another acquisition yesterday, so we're now bringing the total close to 2,000. So we're very happy to report that. The market we operate is large and underpenetrated with limited direct competition. Our subscription-based business model is highly scalable, and approximately 95% of total revenues are recurring. Slide 4, please. We have more than tripled our ARR over the last 4 years. New sales have been driven both by an increasing number of contracts and also increased average deal size associated with a stronger offering. We have also consistently grown the ARR on the existing customer base. Customer success teams have focused on upselling of both existing and new modules, and we have seen positive effects of behavioral pricing models that allow for flexible pricing depending on the customer's usage patterns. Our growth journey continues and has accelerated with the acquisitions we have carried out over the past year. Moving to slide 5 and splitting our ARR into geographies. Norway still accounts for the bulk of our business, but Sweden and Denmark are growing fast. We've also begun to establish ourselves outside the Nordic region, and we are assessing M&A opportunities to accelerate growth in all our markets. Slide 6, please. The customer base is highly diversified, and we see virtually no exposure to industry and company-specific risk. Now, people often ask me how we manage to attract customers from 63 countries when we only operate in the Nordics. And the answer is that we have international corporations do the job for us. Several international companies have noticed that their Nordic subsidiaries are able to provide more granularity in their reports and forecasts and seem to have a better overview of their business. This can often be tracked back to their use of complete control and our other offerings. In such cases, the international companies are usually quick to implement our solution in all their subsidiaries when noticing it, bringing us with them out in the world. Moving to slide 7 to look at where we come from. Now, this is a good illustration of what we meet every day. CFOs typically start to lose control over decentralized contracts when companies reach 50 to 100 employees, and especially if they have several different locations. How do you keep up with all the activities and how do you maintain an overview of all the contracts? And what happens when employees who have signed auto-renewing supplier contracts leave? and what commitments are associated with specific locations and departments for the next 6, 12, and 18 months. And what does that cash flow look like? This is where we come from. Our software originates from a contract management system that provides the CFO complete control over contracts, assets, and obligations. Let me share an example. Imagine that you're a CFO in a medium-sized company with several locations and maybe a few subsidiaries. It's Friday afternoon. You're getting ready to leave the office and take your family on a long-awaited weekend trip. Then your cell phone rings. It's the chairman of your board of directors telling you that the board would like a briefing on the current cost base and an updated forecast and overview of potential short-term cost savings associated with potentially closing one of the locations to understand how quickly overhead savings can be materialized and how quickly this can have effect in the cash flow. Now, they already had some discussions amongst themselves as they are concerned about the current economic climate, so they would like to meet Monday morning. Now, if you have our complete control solution, the touch of a button will give you this report. If you don't, I think I'll have to disappoint your family and cancel the trip. Now, we've come a long way over the recent years and now offer a lot more than contract management, as you'll see on slide 8. Our main product is still the complete control solution, which offers an easy financial and operational overview over all the company's contracts. This accounts for 59% of our current ARR. On top of the complete control solution, we've developed 23 supplementary solutions on areas such as rent, ESG reporting, digital signing, and so on, which combined account for 17% of current ARR. These solutions represent customer-driven innovation. If you receive a request for additional functionality that could be relevant for a large share of our customer base, we typically develop a solution and bring it to market through our customer success teams. Let me share an example on this. Our rent solution. This was developed on a large Nordic hotel chain using complete control, asked us if we could help mitigate pain points related to complex and variable rent agreements for their hotels some years ago. These rent contracts have several components. A minimum amount component, a revenue-based amount component, amongst others. And in some cases, there are also central support activities like marketing support. Now, this proved to be challenging in budgeting and forecasting respect. We fairly quickly provided a solution, which they are very happy with to this day. And we now have several hotel chains as customers on this. But more interesting, the rent solution has also been adopted by many retail store chains and others facing variable rent agreements. The last product area consists of our solutions for IFRS 16 compliance and business process solutions that integrate with incumbent business systems to support efficient operations. These solutions account for 24% of current ARR. We developed and brought our IFRS 16 solution to market in 2018. Other solutions in this category currently originate from the acquisitions of Din ERP, Effectplan, Business Analyze, and as of this morning, Agreement. Moving to slide 9 to summarize the journey. Starting from contract management back in 2008, continuous product development and the acquisitions we made over the past year have added business process systems, forecasting and budgeting systems, and most recently, analytics, reporting, and business intelligence dashboards with the acquisition of Business Analyze. With these elements in place, we can take a broader role in our partnership with the CFOs and offer a complete overview with valuable insight and provide actionable intelligence. We like to say that we are on a journey resembling that of Coupa in its early days, and we aim to be the first application a CFO logs into in the morning and the last he or she logs off. Slide 10, please. Overall, our acquisitions have more than doubled our addressable market. This opens opportunities to grow into a Nordic market that's around 60 times larger than our current size. Moving to slide 11 to look at how we approach this market. House of Control is an efficient sales machine with a fantastic commercial culture. Our in-house call center consists of more than 25 meeting bookers centralized here at Høvik, creating sales opportunities for our hunters in all our markets. This team has generated more than 4,000 meetings so far this year alone. We treat our hunters as consultants in the sense that we fill their calendars with meetings to maximize utilization. Sold contracts are immediately handed over to customer success for processing and onboarding. This ensures that the hunter maintains his or her focus on securing new accounts. It also ensures that all customers are onboarded properly and get an optimal start on their customer journey. It also enables us to tailor direct and efficient remuneration modules, ensuring that our employees are incentivized to work on their specific task. For example, a leads generation meeting booker doesn't receive a bonus for booking a set number of meetings. They receive a bonus when a hunter actually closes a sales opportunity on one of the leads they have generated. Now, this arrangement ensures that the booker is incentivized to book high-quality meetings with qualified leads instead of booking a lot of poorly qualified meetings that could potentially reduce the hunter sales efficiency. Slide 12, please. And our continued growth estimates are built on 4 pillars. We see several avenues to continue our growth journey with a large untapped potential in the Nordic market that's 60 times larger than our current size. We see a strong potential in cross-sales to the customer bases we have acquired over the past year, and a large upselling potential in the existing customer base with the products and solutions we have acquired. Now, we added a new company to our portfolio with the acquisition of Business Analyze last quarter and a Swedish company agreement this morning. And we will continue to support our organic growth with more acquisitions going forward. We have strong momentum in both Sweden and Denmark, and we see several attractive European market opportunities. Our ambitions for the next 5 years are pretty bold, as you'll see on slide 13. We expect to maintain an annual organic growth rate of 30%. Now, this will increase our ARR portfolio from 169 million at the end of the second quarter this year to more than 500 million by the end of 2025. Increased upsell, targeted price increases, and a churn rate below 10% contribute to a positive development in net retention rate, and we predict this will move from today's 100% to 110% at the end of 2025. The EBITDA margin will increase with scale and move towards 40% by the end of 2025 as the current growth costs are being absorbed in the larger portfolios. And last but not least, we will fulfill our vision of being the CFO's best friend. And with that, I'll be very happy to take some questions, maybe with slide 14 in the background.
Thank you very much for a good presentation, Fabian. So I'd like to start where you ended off. So with your target of reaching 110% in net retention in 2025, could you say something about what are the key initiatives that you will implement in order to reach this?
We've been working diligently, I would say, since Viking Venture came in back in 2015 to establish the customer success team, and we did that, in 16 or 17. We have really good pace there now. It's proven to be crucially important to reach the retention rates we are looking at currently. And remember, we had 98% last year. We are now seeing 100%, an increase of 2 points in what we define as the core household control product. So we're already seeing the effects of the targeted work that's being done in customer success. And now, especially with the acquisitions that we have done over the past years, we are now getting into the DIN ERP acquisition last summer. We launched those products, so they were launched this year. We're starting to see some effects. We now have customers in all the Nordic countries on these products, and we expect also to see continued upsell as more and more of these acquired products are ready to be sold to the existing customers through customer success. And obviously, very, very important for us, as we've said many times, to control the churn and have that churn rates below 10% is something we're working very, very targeted on. Over the past year, we've been able to increase prices on average 10% on renewals. Obviously, half the portfolio is up for renewal every year, approximately for an eternity. So that will yield a 5% increase. And the effects of all this, we are confident that we will reach the 110%, but it won't be done tomorrow. It will be done gradually, like we now have done it over the last 6 months, improved it by 2%, and we will continue to gradually improve it as we move towards this end of 2025.
Thank you. And M&A is also an important element in your growth strategy. So when you do acquisitions, is the primary target to acquire a customer base or new products?
Well, we are looking for both. And let me just say this, I think today is probably the first time I am very happy to bring outdated presentation, as obviously the acquisition we did yesterday and announced this morning hasn't been reflected here. So, that shows that we are moving on a quick pace on this. We are interested in both acquiring more products and expanding the product offering, as we are saying, to become the CFO's best friend and make sure that we can offer a complete suite that meets as many as possible as his or her main pain points, let's call it that, to attract them to our systems. We are very interested, of course, to acquire, let's call it, hot customer bases as well, that we can do upsell on, because it's a lot easier to sell something to an existing customer of a company we acquire than to do the cold calling on ice cold prospects. So we are targeting both, and we are targeting them in both the countries we are and also countries where we are looking to start operations.
And when you do M&A, what kind of multiples do you typically pay?
Well, that depends. And as we've seen, we communicated this morning 3.5 on this last one, and then we have been around 3, 2.8, 3. And that's the multiples we have seen now historically. We are prepared to look at higher multiples as well, obviously, since these are all very favorable to us. But it's a consideration where we look at, number one, how large is the ARR portfolio in itself, and then number two, how quickly has, let's say, the current owners or the current management been able to accelerate that? What growth rates are they looking at? Obviously, we are looking at churn as well to see there, because we know how important it is. And then we are considering what additional synergies we could bring to the table by introducing our sales organization and the product team and help this company reach their ambitions faster. So then we get an estimate of the growth we can expect. And then we obviously start our business modeling, and based on that, we derive at a set of multiples. Yes.
And just to clarify, that's 2.8 to 3.5 times ARR, right? So that would be significantly below your own multiple that you're currently trading at.
That's absolutely correct. I think we've been fortunate in those. We think those are good deals, both for the sellers and for us. And obviously, we have seen, as we have said for a long time, we have been looking to do acquisitions. We haven't done that many, for some time now. We wanted to do more, and we've seen that there has been some really high expectations, I would say, on the founders and on the managers and the shareholders, where they were expecting a lot more. So obviously that has caused us to cancel or postpone something. But the levels we are looking at now, we are happy. We think they are favorable, and there are also earn-out elements in these deals to further incentivize the management and the owners to build it stronger and bigger with us in the years to come.
That sounds like smart. And you of course, as you mentioned, expanded your product portfolio significantly over the past year through M&A, also through some in-house product, new product innovations that you have made. Have you seen a lot of effects from this already, or does the majority of the upside here lie ahead of us?
Well, we have seen, let's call it the continuous development we have done all along in Complete Control, and the money we have spent on that has definitely helped us improve the solution. So that has helped and paid off with the respects of a loyal customer base. The acquisition of DIN ERP, obviously there are good products there, but I think foremost, they had a fantastic development team, 35 developers, extremely good at integrations. That opens a door for us to start integrating into other systems. And we have relaunched some of the solutions that they were offering on an on-premise basis. So we started doing that at the start of this year in Q1 and Q2. We started seeing effects where we were selling these products. And obviously, Effect Plan will be the same. That's integrated into Complete Control. We're now starting to see the effects. We're able to bundle, and we're starting to sell those solutions. And obviously, Business Analyze that came aboard in April, we are seeing really good results there. The second month here, when we employed our sales team, they noted an all-time high new sales record in Business Analyze for their own records for 11 years of history. So yes, we're definitely starting to see it, but it will take some time still for it to become very, very material. But we really think there's a lot of effects coming now, because it takes some time. There's some turnaround on the products, and then there's a 3-month sales cycle. So yeah, we're getting close to a perfect storm. Let's call it that.
Mm. And I know you also use the Business Analyze product yourself as a way to track the sales development process and the pipeline for new customers. I know you have very good data on your pipeline going into the second half of the year. Do you see a good pipeline going into the second half of the year? Are you tracking well along those targets that you have set?
Yeah, we absolutely. And let me first say, Business Analyze, as you said, we've been using them for years. I was totally addicted. We just had to acquire them. It's just a fantastic solution. So And we are seeing, as we saw towards the end of, or the second half of last year, the momentum really came up. We saw that continue in Q1 and Q2, and all our early indicators and the number of booked meetings and the sales activity and the calls we're doing really sets us up for, I think, a very good quarter. And the second half is normally our strongest sales quarter. So we would expect to see some really good numbers. Also noting Q1 this year was fantastic. And that's something that's new to us, because in Q1, usually the CFOs and their team are very busy with the year-end close and all their activities and the audit. So we usually have, let's call it a slow sales or quarter in Q1. We saw this year a 150% increase from last year. So fantastic momentum, and it continued in Q2. So we are ready for the fall season, and it's hunting season now, So.
That sounds really good. Thank you very much for presenting to us today, Fabian, and thank you very much to everyone who listened in. Have a good day.
Thank you. Bye.
Hello and welcome to ABG Investor Day. My name is Simon and I'm an equity research analyst here at ABG. I have the pleasure of welcoming Andreas and Jonas from IMINT. They will hold a presentation of the company, and after which we will have a short Q&A. The floor is yours.
Thank you. Thanks for everyone tuning in. So I'm Andreas Livendal, CEO at IMINT since the last 10 years. And with me, I have Jonathan, our CFO as well, to help me out. So 20 minutes goes quick. So let's jump right into this. And we'll not cover all the slides material you got. We'll cover the initial slides and spend the time there and hope for some good questions at the end. So next slide, please. We start with this cliffhanger because this is a sort of milestone event in our new journey as a high growth company. This is now 3 years back. Richard Yu, the general manager of Huawei devices, introduced the Huawei P20 Pro when Huawei decided to battle Apple and Samsung for leadership in the smartphone domain, and they were very proud of the camera and especially on the video quality in the new phone. And they showed impressive demos how they were running circles around the iPhone at that time. And of course, now we all know that the secret ingredients behind that sauce was this small Uppsala company, IMINT, and the Vidhans software. So next slide, please. So IMINT is our company name. We are more known in our customer market for the brand Vidhans. This is a bit confusing, but that's just the way it is. We are a software product company, two equally important aspects of our company identity. So software is all we do. We work a lot on complex hardware, but we only deliver software. We never touch hardware in the supply line out to customers. And we are a product company, which means that we not only software experts, but we bundle all the expertise, all learnings. We always strive to make that a packaged product that we can build once and sell many. And we are really the software that creates new capabilities for camera-powered devices, especially those that are moving or handheld or worn on your body. With these challenging video environments, we are the real experts. And especially in the consumer domain, where we have our biggest market today, it's really about liberating storytelling for normal smartphone users to tell compelling stories using video, which is actually quite hard if you've tried it. So we try to really make that as easy as possible and having end users feel proud of the result. Next slide. This is the classical one-pager on our company. So we are now going on 14 years soon, founded in 2007 as a spin out of Uppsala University, a research group called Center for Image Analysis. Initial work in the industrial and defense domain for video stabilization for drones, actually. So in a way, we're now returning back to our roots. 5 years plus now as a listed company on Spotlight, December 2015, we did our IPO. Very engineering heavy company. Many of us have Master of Science degrees or PhDs, so it's really a deep tech type of company. As you can see on the world map, head offices in Uppsala, around 35 people sitting here, and then we have our second office in Shanghai, which is sales and customer engineering, and then we have sales representatives in Korea, Japan, and Taiwan, although the Taiwan guys actually sits in Singapore. Our core expertise is in imaging, of course, but it's really the hard part of imaging, which is the real-time analysis and sensor fusion. We have sensors like motion sensors, combining that with camera sensor data in a fast and efficient way to create a virtual model of any moving camera system. That is really the technology backbone of our company. We bundle that expertise together with our expertise now in having those infused in chipsets that runs in smartphones and other devices, and we package them as products. And today we have most of the largest smartphone makers as customer in the Android spectrum. So that means we are not dealing with Apple, but all the other guys are on our customer or prospect list. Next one. So current target segments. Now we are expanding beyond smartphones. Smartphones is still our main market. It's also the market that is driving our technology and new product development, because that is really a leading market also in terms of the technology envelope. But we are now getting more customers and see a lot of more interest in adjacent markets. And you have some examples here like action and body-worn cameras. Here you have both the consumer market, but even more interesting, probably the professional market, like police body cameras or surveillance cameras. Smart glasses, smart watches, wearables market is also a dual market where you have high volume consumer market, but also more and more now growing an industrial market. And we have a few interesting customers in the remote maintenance segment where you provide frontline workers with smart helmet mounted displays and smart glasses, and you can allow for a remote product expert to guide remote services. Drones is coming back. As I mentioned, that was our roots when we started, and now we see a lot of interest from the drone market as well, and that's obviously a good example of harsh filming environments with moving cameras and a need for really good video quality. And expanding this further beyond, you see a growing IoT market where cameras is really cheap and versatile type of sensors to put in a lot of different devices. Surveillance and security is also a natural camera-driven market. So these are the key markets, but we are also working on longer-term partnership, both with camera module makers, chipset makers, and so on. And these are more explorative ways to find new channels to the market. So these are our longer-term investments that we have. Next slide. Here's a bragging slide. As I mentioned, we founded in 2007, and the first chapter of the company life was a classical research-heavy startup, getting sponsored by government grants, happy early investors, and defense research institutes. So we had customers in Norway, Sweden, South Korea, US, and so on. And we did a lot of interesting proof of concept projects that learned us a lot, both in terms of product development and features, but also, of course, having really hard requirements from hard type of customers. So a really excellent primary school for a young company. Drawback with this early market was that the product life cycles and time to money was very long. So we decided to look for more rapid moving markets around the year 2013 and 14, and we settled on the smartphone market to really make a difference there. The timing was perfect in terms of the hardware evolution in smartphones, and also how they became more and more camera-centric devices, replacing the digital cameras that we used 10 plus years ago. And now everyone is using the smartphone to take pictures and shoot videos. So in these years, since we decided to go for the smartphone market, we have seen a very rapid growth. So landing close to 50 million SEK last year, starting from basically scratch in 2015. Have most of the smartphone OEMs as customers. And now I think we have exceeded 500 million devices. This slide says 400 million, and that gives an indication of how quick we are growing now. So in the last quarter, we estimate that more than 50 million units with our software integrated was shipped to consumers. And more equally important is, of course, the brand and reputation that we have earned by working with these giants. And now we are a well-respected and established brand in the smartphone domain, and that is now spilling over to new type of customers. So we have earned the credibility of working with these giants, and now we see more and more traction in other domains, as I mentioned. We have 4 consecutive quarters of positive earnings, and a really healthy growth rate. So next slide. Here's many years back our revenue slide per quarter in our customer currency US dollars, and as you can see, our last report on Q2 was an all-time high in terms of customer currency. So there are a few bumps. It's not a straight line, but the overall trend is really positive for us. So the next one. And here we're looking at half year because they are typically annual cycles in terms of smartphone volumes and how we earn our money. So you can see the growth for full years 18, 19, and 20, and our earning or our revenue so far in 2021. And we have kept cost at a fairly steady level over the last 3 years. And here you see the merits, of course, of being a scalable software company, because once you get top line up and grow there and can keep cost steady, you see a really strong improvement in margins. So we're now having really healthy profit levels. And we can take the next one. Here's a busy slide that I'll probably spend my last 5 minutes mainly on this one, because this is trying to capture the business model and the business environment we are in from a sort of intelligent investor audience as yourself. So if we start at the top, the product, we're a software product company, and the key benefits and what builds barriers for competitors is really the extremely optimizations of our software and how they are built in a clever modular way. So we have one underlying Vidhans platform that does mathematical analysis on the sensors. And on top of that, we spin products or end-use products at a good margin. And they are very entangled, and that creates stickiness, and they are really optimized for the chipsets to be very lean on the battery. And also in terms of quality assurance and how our customer integrate those products, they hold together. It's a very streamlined process of adding our functions to new smartphone, validating that it works and calibrating it to premium performance. So we spent a lot of our engineering time in that process, actually, not so much on the algorithm itself, but actually the process of getting it into a phone in a smooth way with high quality. And in addition to the actual functions, we provide these tools for calibration, tuning, and integration that also creates stickiness. And it's actually also an excellent sales platform. If we have new products, we just add them to our software development kit, and our customers can very easily evaluate new functions from us. And if they decide they want it, they just sort of enable it, turn that flag on, and we send a bill. The underlying value that our products provide, I mean, is of course premium video and image quality. And that has a real strong value both in the consumer market and in the industrial B2B market. In the consumer market, that's because, especially for smartphones, it's more or less cameras that sells new devices. It's extremely camera centric. That's where you see main features. That's where you see, when you see launches of new flagship phones, more than half of the presentation is geared towards photo and video capabilities of new devices. So that is really driving not only the smartphone market, but also the camera module market and sensor markets. So we're really in a nice spot where a lot of hardware investments are going. And the software that we provide sort of unlocks the potential of these hardware investments. The market, if we go to the right, from our perspective, 90% or more of our revenues are related to the smartphone market. In the smartphone imaging market, if you take all type of software that goes into a smartphone, including patents for codecs and so on, we think we are just below 5% of that market. It's our piece of the wallet. So there's a big growth potential, especially if you expand it not only to video, but also to still imaging. So we have a big growth potential in the existing market, plus that the imaging market in itself is steadily growing because of the camera-centric nature of smartphones. We see that we have longer term and really strong growth opportunities in other camera markets. I mentioned one example, and that is smart augmented reality glasses and other smart glasses, where you see both consumer and industrial high growth forecasts. And I think the COVID pandemic has really propelled the adoption of remote maintenance and remote services markets. Of course, if there's really good signs that we are in a really good spot, other companies realize that as well. So we have, of course, competitors. To mention two of them that are independent software companies is a Chinese company called Arcsoft, many times larger than us, high growth company as well, and sort of a legacy competitor called Morpho, that is a Japanese company. They can be worth checking up because they are also both public companies. And of course, we see alternatives that some customers want to do things in-house, and we also have the chipset providers that provide basic functionality that overlaps with some of our products. In terms of the money-making machine, 90% or more is from IP licensing. And the models here vary, and that makes it hard to give sort of an average sales price for us, because sometimes we have straight royalty models. Sometimes we have royalty models where they get discounts if volumes climbs over the year. We have models with fixed annual fees, and we have hybrid models where they pay royalty up to an annual cap per IP type and so on. So it's a mix, and we have deliberately wanted to create a mix. We have more vision into the future and more balanced type of revenue streams. So we're not really very dependent if the overall smartphone market grows 5% or declines 5%. So we're pretty robust in terms of quarterly changes in overall smartphone volumes. We have recurring revenues from support and maintenance agreements, tools, licensing, and that share is small, but that is growing. And especially since we move into more industrial customers, we see more old school kind of deals where a larger portion is based on long multi-year maintenance agreements, including updates and so on, which I think is healthy for us. And finally, sales, conduct them mainly through direct key account sales to the smartphone market. I mean, there's a limited number of really huge customers that we all can address directly with really competent sales team. When it comes to broader market penetration, like in wearables, we're working more with marketing, both inbound marketing, making a lot of announcements, press, working with the press and so on, both using a US and a Chinese PR firm, and also now more and more sort of account marketing, where we look at certain segments where we have initial traction, and then we knock on every possible door that we can find, and hoping to find the right opportunity when a new product is under consideration, because then we have a perfect timing for them to evaluate our solutions. And I'll actually stop here because that is 20 minutes to the second, and I think I covered most aspects. And if you flip through the material, you will find more fine-grained details on our portfolio, our market shares, customer references, and so on. So I'll leave it up for Q&A.
Great. Thank you, Andreas. First off, you mentioned some of your competitors. What would you say is your biggest competitive advantage?
I think it's the agility and our focus. So we do today products that are related to moving cameras and all the things that are connected to that. Video stabilization is sort of the key thing, but there's a lot of add-on functionality that strengthen that niche within a niche. And we really have sort of cemented that position. And our customers know that we are world leading. So it's that focus. And I also think that being a small European company working with big Asian customers, from the onset, we've tried to have a very a digital delivery method where we can't really put 5 guys on site for every customer project. So we really had to invest a lot in our tools and methods to make a really efficient integration. And once customers adapt to that, they see the benefits as well. They reduce risk and have more self-reliance in that way of doing things.
Thank you. And how large could the industrial wearable market segment be for you? Can we compare it to the mobile segment in terms of market size?
Nobody really knows, to be honest. I think you see a lot of wearables that hasn't really taken off into high acceleration yet, but a lot of crystal ball experts point to that. We think conservatively that within 5 years, maybe non-smartphone revenues is around 30 to 50% of our total revenue cake. Some segments, I think, like smart glasses, can really have an interesting growth rate over the next 5 years.
Okay, and if we think long term, could the industrial segment be larger than the consumer segment?
Definitely. That if you take the 5+ year perspective, and that's absolutely in a sort of long-term strategy as well, to be adaptive to these new markets and new opportunities. And as we've done with the smartphone, you have one door-opening product, and then you get intimate with your customers, and then you understand more about what will happen around the corner, and then you build those products so they are ready when they need it. So it's a lot about agility as a small company.
Okay. And in terms of profitability, could that differ between the segments?
The key, I think, not really. I think the business model can vary quite a lot, and you can have sort of other ways to monetize on the real value for industrial customers because they are much more mission critical kind of products. But the key to profitability for us as a company is the scalability of having one platform that you sell to many different segments. Then you, of course, optimize each business model for that segment. But the real benefit of high profit margins comes from one software platform.
All right. And my last question, how important is profitability in your current strategy? Could you sustain this profitability while growing and venturing into new business areas? Or how should we think about profit in the future?
Right. I think you should. The ambition for us is to keep north of the 0 line. And as we see, even in different scenarios, we see it sort of very unlikely that we should dip on that curve. However, we said, especially now with new markets emerging, that over the next 2 to 3 years, growth is more important than profit. And over the 3 to 5 years, we think that the opportunity for really good margins are excellent, but with a much higher number on the top line revenue. So I think that is the best way to optimize this, to really make sure that we invest so we don't miss growth opportunities over 2 to 3 years, and then tune for maximum profitability year 4 and onwards.
Thanks. I think we'll have to stop there in interest of time. Thank you so much.
Thanks a lot.
Thanks.
Super good afternoon and welcome also again. My name is again Laurits Louis Kjærgaard, equity analyst at the ABG Copenhagen office. Next on the stage we have Kåre Wig, Group Executive Director and CFO of North Media, and also Henrik Løve Jensen, CEO of North Media Online. The company will present for 20 minutes and then we'll have a Q&A session afterwards. Thank you very much for your time today, gentlemen, and I hope all the participants will enjoy the presentation. Thank you.
Thank you, Laurits, and good afternoon to everyone, and welcome to this presentation of North Media in Denmark. Please go to the next slide for the agenda. My name is, as Laurits just mentioned, Kåre Wig. I'm Group Executive Director and CFO, and with me today is also Executive Vice President Henrik Løve. Henrik Løve is in charge of our digital platforms. We have prepared a 20-minute overview of North Media and thus many things to cover. So let's go to slide number 3. So North Media at a glance. We facilitate transactions between businesses and consumers. We provide platforms to connect retailers with consumers, landlords with home seekers, employers with job seekers, and distributors and home care staff with private households. We focus on Denmark, a market providing excellent conditions for all our activities, but we're also active in Norway, Germany, and Sweden. In Sweden, we run the home rentals platform Bostadsportal. A common feature for all our activities is that we handle data and large volumes uniformly, quickly, and securely. We constantly optimize our businesses to further take advantage of these scale benefits. As you will appreciate from the slide, we have 2 business areas, last mile and digital services, combining the characteristics of a value business and a growth business. The business area last mile is a mature, stable, and market-leading business, well set to continue to generate substantial earnings in the years to come. FK Distribution distributes more than 1.3 billion leaflets and facilitates more than 100 million digital views of leaflets. The second business area, digital services, that's the headline for 3 database businesses with a potential for double-digit growth, higher earnings, and scalability. 2 of the digital services are already profitable and generating double-digit EBIT margins, and the third business is well on the way. Next slide, please. We have a strong and growing capital base, close to 750 million DKK by end of Q2. And to maximize returns, we place parts of the capital resources in blue chip securities. This capital structure ensures maximum flexibility and independence for the long term. It allows us to pursue strategic ambitions, including ambitions, acquisitions, and investments. And the financial strength also facilitates distribution of stable dividends to the shareholders. This year, we paid out 5 kroner per share. Provided our guidance for 21 is met and our ambitions for 22 and 23 are fulfilled, we have the ambition to continue to pay dividends of 5 kroner for the years to come. This equals a dividend yield of 4% based on the current share price. Dividends are the focal point of our value creation to shareholders, combined with occasional share buybacks. And the share price? Well, last year the share price rose by 80%, and this year the share price is up some 58%. Our main shareholder is the company's founder, Mr. Richard Bunck, and the free float is approximately 35%. The shareholder base is growing. Approximately 15% of the shares are held by international investors and particularly Swedish investors. Next slide, please. The strong capital base is a product of solid earnings and cash flows as underlined in our recent Q2 results. Consolidated revenue in Q2 was 259 million DKK, and revenue was up 2% over last year, where we saw some impact from the close down of Danish business life and society amidst the corona pandemic. Last mile recorded 1% growth, while growth in the digital services was 13%. Group EBIT came at 68 million DKK, and the EBIT margin improved by 4 percentage points to 26.1%, driven by efficiencies, cost savings, and better product price mix. 3 of the 4 businesses are profitable. FK Distribution and Ofir delivered solid margin improvements, while BoligPortal sustained its high margins despite introduction of freemium products and higher marketing spend. Net profit from the group, excluding return on equities, was 51 million DKK, a decent improvement over last year. Including return on equities, net profit in Q2 was close to 100 million DKK. Overall, results were largely as expected, and we made good progress with our strategic priorities. Now, let's dive into the story behind these numbers, starting with FK Distribution on the next slide, please. Q2 revenue in FK Distribution was up 1%. Distribution volumes were stable and prices were slightly higher than last year. EBIT in Q2 was 62 million DKK, an improvement of 8 million DKK, driven by cost savings from ongoing optimization of operations. A landmark event was the expansion of a contract with Deutsche Post, where we more than tripled volumes. We started packing leaflets for 480,000 households in northern Germany on July 1st in an eco-friendly packing solution. Now, this is no game changer in financial terms because the real money lies in the door-to-door distribution, which Deutsche Post continues to handle. This year, Deutsche Post will account for around 1% of the total revenue in FK Distribution. But the agreement is a seal approval of FK's effective packing setup, and we hope the agreement could be a stepping stone for additional international business. Initially, we're exploring the potential for packing up to 2 million households in Germany. 6-month revenue was down 3% to at 431 million DKK. Q2 was solid, while Q1 was softer because border shops, shopping centers, and minor customers rescheduled campaigns during the Danish COVID-19 lockdowns in January and February. Half-year earnings were 124 million, and we succeeded lifting EBIT margin by 2.3 percentage points to 28.7%, despite the lower top line. So all in all, satisfying results. Let's go to the next slide, please. Packing and distributing leaflets, local newspapers, and direct mail in Denmark remains FK Distribution's core business and accounts for more than 90% of revenue. The remainder is digital offerings and logistical services for third parties. For the past several years, printed matter volumes declined by 8% per year, approximately, driven by retail consolidation, increased online shopping, and mergers of local newspapers. This year, volumes are down by 4%, reflecting that we expect a lower structural decline in volumes going forward. Large supermarket chains, electronic chains, builders, merchants, and other large retailers continue to rely strongly on leaflets to drive customers into stores. In fact, volumes from the bigger customers this year are either unchanged or even higher than last year. And we have recently extended our existing agreement with one of Denmark's leading retailers, Salling Group, through 2024. Oppositely, smaller customers reduce volume. They may be more exposed to structural changes in retail, or they may have been hit harder by COVID-19, forcing them to reduce marketing spend. Moving to full year outlook, we narrowed the guidance range in May and upgraded guidance in August. We see full year revenue between 865 and 880 million DKK and an EBIT result of 235 to 245 million DKK. Please go to slide 8 with Henrik and BoligPortal.
Thank you, Kåre. BoligPortal is the leading property rental platform in Denmark, and we have an emerging presence in Sweden. Right now, we are refining our business model and we are introducing more subscription-based products and services. And we're also giving away certain products for free to add more landlords and rentals to the new platform. I'll dig into the revenue streams a little later. And as outlined in our annual report, these changes were expected to leave a mark on performance in the first half year, and they did. Growth was 1% in Q2 and 3% in the first half year. This is somewhat below the growth rates that we've been grown accustomed to in BoligPortal, and which we eventually expect to return to once we have refined the business model. Despite these changes, we were able to produce a decent profit margin of 35.5% in Q2, while the profit margin in the first half year was slightly down to 31.8%. This corresponds to an EBIT result of 13 million DKK, which we do believe is a good result. Next slide, please. A few words on the changes we are introducing to BoligPortal. Basically, we're in the process of expanding our addressable market by adding 3 new revenue streams with significant commercial potential. And that's on top of our current marketplace. Together, they hold the potential to secure BoligPortal a larger and more stable and predictable income and cash flows in the future years. The marketplace remains our focal point. We match home seekers with landlords, and all housing units on the platform are fully validated. We're using data from the marketplace to develop and launch new subscription products and services. The first new revenue stream is centered around data. We know the market inside out and have more than 110,000 rental moves a year in Denmark. That accounts for 50 to 55% of all the transactions in Denmark. We know where demand is, we know what potential tenants are looking for and what they're willing to pay. And we have the same insight into the supply side. So currently we're launching a new subscription-based online solution combining all data on demand and supply with information from public registers. And one of the first subscribers is the Danish Central Bank, and we believe this solution will be in demand among developers, real estate companies and managers, banks, contractors, etc. So we help them make wise decisions when it comes to property investments. The second new revenue stream is subscription-based services designed to help landlords administer their properties and portfolios. The services span advertising, market data, and rental management solutions. Basically, whatever the landlord needs to run his business effectively. And the third and last new revenue stream is centered around service providers. We offer solutions to tenants who found their new home on our platform. We offer access to electricity, insurance, and internet providers by now. And we see good traction and high conversion rates from the tenants here. And all the service providers pay us a fee for each reference that they get. So we strive to have more landlords and tenants on our platform as part of the combined ecosystem. And this is also why we're giving away certain products for free when we launch new revenue streams. We're slightly behind our plan, and we've lowered the guidance for this year accordingly. We now expect the full year revenue to come out between 90 and 94 million DKK with an EBIT result of 29 to 31 million DKK. Despite the slight downward revision, we continue to target top line and earnings growth compared to last year. And we expect double-digit growth to return later this year. Next slide, please. If we look at our job platform, Ofir, we had an excellent Q2. Revenue more than doubled. Q2 was actually the 4th consecutive quarter with high double or even triple-digit growth, as you'll appreciate from the figure to the right. Ofir has invested heavily in its infrastructure and data platform to develop a comprehensive job universe where vacancies are being posted on several job portals and social media channels, supported by our large candidate database. This approach allows us to target both active and passive job seekers in a unique way. Ofir has outgrown the market in recent quarters, and we continue to strengthen the market position and service offering. Revenue growth in the first half year was 84%, and progress was driven by higher volumes of job postings at better prices, whereas income from software licenses continued to drop as expected. The half-year EBIT result improved to a profit of 3 million DKK, corresponding to an EBIT margin of 18%. And this is the best ever result for Ofir. This year we originally targeted 36,400 job ads, but we may now be looking at around 40,000 job postings. Based on this forecast and the better than expected results, we updated the full year outlook in August. revenue is now expected between 31 and 34 million DKK. That's 50 to 60% growth over last year. EBIT outlook has been raised to 3 to 5 million DKK, and Ofir has now entered a phase of profitable growth, and we are still far from realizing the full potential. Next slide, please.
Thank you, Henrik. And just to recap, this was two of the businesses in digital services, bolaget and Ofir, and I will now cover the third business in digital services, BK. BK supplies digital access solutions to two customer segments. Home care serves municipalities in Denmark and Norway and accounts yet for most of the revenue in BK. The second segment, stairwells, represents the growth potential in BK. Stairwell caters to home deliveries of groceries and parcels, as well as property administrators and others with legitimate business in secured multi-story buildings. What we do is we install a chip, we call it Smart Relay, in the entry phones of the secured stairwells. And this allows our customers to enter the building and deliver goods to the end user's doormat, even though the end user is not at home. Smart Relay is now installed in 25,500 stairwells in Greater Copenhagen. This equals to 57% coverage, and we target 60% coverage by year end. While we are not satisfied with the speed of new installations, the existing coverage is sufficient to support expansion and attract important customers. In the first half year, BK implemented an agreement with one of the leading online supermarkets, namely .com. In the first half of 2021, revenue was down 18% due to customers' postponement of planned projects. Last year, we onboarded 3 municipalities. This year, we had planned to implement expansion of 3 existing municipal customers, but these implementations were postponed, leading to this lower revenue. Uncertainty about implementation impacts full year guidance, and revenue is now expected between 26 and 30 million DKK, with an EBIT loss between -7 and -6 million DKK, thus in line with last year's result. Next slide, please. We are now around 6 months into the new 21-23 strategy, which we launched in February, and we can start adding check marks to some of their priorities and ambitions. FK Distribution extended its cooperation with Deutsche Post. Packaging for adjacent markets is one of the efforts targeted to offset the modest structural volume decline. Other efforts include new products, developing new offerings, and strengthening the digital activities. Scaling and potential internationalization remain important strategic layers for our businesses in digital services, supported by potential acquisitions. All 3 businesses reported progress with the scaling agenda this year. Bolaget is in the process of expanding its addressable market by rolling out the new platform. Ofir has a solid growth in private sector jobs and continues to strengthen social media and data research capabilities. BK added 1 important client in the stairwell segment on its way to gain critical mass. Our ambitions for 22 and 23 are intact. We continue to target 3% organic growth driven by digital services, while the group EBIT margin is expected around 24% in 2023, excluding acquisitions. Next slide, please. Regarding the outlook for 21, we adjusted the forecast in May and just recently in August. We now expect group revenue to come out between 1,015 and 1,035 million DKK, is more or less on par with last year. We now see an EBIT result of 250 to 265 million DKK, hence earnings are expected to exceed last year's record result, driven by progress in both business areas. The guidance upgrade in August reflects higher visibility for FK Distribution's demand post-COVID, Ofir's better than expected results, as well as the minor downward revisions made by bolaget and Ofir. The outlook is subject to COVID-19. Currently, the pandemic is well controlled and doesn't materially affect Danish business life. We assume this will also be the case in the second half year. Next slide, please. And finally, a few takeaways from this presentation today. North Media has two business areas, combining value and growth, predictability and potential. We expect full-year revenue to exceed 1 billion DKK, and we expect an EBIT result of more than 250 million DKK. We are thus well set to improve earnings for the fifth consecutive year. The new strategy is well underway. We have the financial resources to support our strategic targets and aspirations. And it remains our goal to produce attractive shareholder returns, including a dividend of 5 kroner per share in the years to come. Next slide. And this marks the end of our presentation. We are now ready to take your questions.
Thank you, Kåre and Henrik. Maybe perhaps a question on the slide where we left up. You have 800 million in a positive cash position, which creates some flexibility, but around 200 million of that is earmarked acquisitions. Could you talk a little bit about the companies that FK Distribution, well, actually not FK Distribution, it's more targeted towards North Media Online. What type of companies that you're looking for to acquire?
Yeah, Henrik?
Yeah, our main aspiration is to find companies that match the companies that we already have. So basically, we would like to find companies that can fuel the separate strategic goals for our online companies. So it would be within the areas that we operate in by now.
And that could also be international companies?
We are looking in Denmark and abroad, yeah.
Okay. And if we look also on your dividend policy, obviously you're increasing your earnings in your guidance by about 4% relatively to last year. You're targeting around a 3% year-on-year organic growth for the next couple of years with a stable margin. So that would indicate perhaps a 3% increase in earnings also. Is there room to also increase the dividends accordingly over time next to, let's say, the rates of that you've communicated? Is there leadway in these dividends if you do hit your targets?
Our target right now in the long-term plan 21, 22, 23, as I mentioned before, is that we plan to pay out 5 kroner per year for these 3 years. That would be 4 years in a row with 5 kroner per share. That's the target we aim at right now with the ambitions laid out for the coming years.
Even if you grow 3% or for all of those years?
Yes.
Okay. And perhaps just a last question. We talked a little bit about the Boligportalen, and that company has been in the media recently with your scaling of activities and your freemium model. Could you talk a little bit about just sort of your rationality behind the freemium model and this penetration of market that you want to pursue? And also accordingly with that, what we see is that there is sort of pressure still on the rental market in Denmark, but also on the job market, which Ofir is exposed to. Could you talk about how you're perhaps helping solving those issues in both Boligportalen and also in Ofir on the workforce?
If we look at the general market trend, I think that the job market is somewhat better off than rental market right now. The job market in Denmark is very hot right now. We see a record number of job listings. So of course I'm happy that Ofir beats the market growth for now. When it comes to the rental market, we see a slight downward trend in the market. If we look at the number of transactions, we don't see the same mobility as we did a year ago. So we have, I think we have a slight downward trend on the rental market. But it's also important to understand that the rental market is a more stable market than the for sale market is. If we look at the raison d'être behind the freemium model that we run in Boligportal. Basically, what we strive to do is to have as many properties on our platform as possible. And then if we offer something for free, we harvest data, and when we harvest data, we are able to sell more data products to the property investors, and we are also hopefully able to generate more rental contracts and have more revenue from service providers on the side. So that's basically why we do it that way.
That's a very clear explanation, Henrik, and we look forward to look at how the numbers perform once it's completely rolled out. But I'm afraid that's all we have time for today. As a friendly reminder to the participants, we have investment coverage on the introduced platform on North Media, and feel free to reach out if you have any outstanding questions. I know that Kåre and Henrik are always happy to discuss their company with new investors, so don't be shy to reach out. So by that, thank you so much for joining us today, Henrik and Kåre, and to all the participants. Have a great rest of the seminar.
Definitely. Thank you.
Hi and welcome everyone. My name is Erik Moberg. I'm an equity analyst here at ABG covering the gaming sector. And with that, I leave the word for CEO Björn Mannerquist of MOBA Network.
Thank you. We can dive directly into the next slide where I will present MOBA Network. We are a gaming community company that owns and operates some of the world's largest gaming communities, both web-based and on YouTube. We made a significant acquisition at June 1st this year of a company called Magic Find, which increased the number of communities we run from 10 to 20, and we also added Union for Gamers, which is a massive YouTube network that generates billions of views each year. So as you can see on the slide, we have our network community brands that all focus on individual games for the fans of those games, and the YouTube network that was added. So in total, 20 communities. We reach a massive global audience. In total, for our web-based communities, we had over 600 million visits in 2020 and served over 20 billion video views. Since we have made a significant acquisition recently, we have produced a pro forma figures for 2020 for the entire company group, which shows revenues of around 380 million and an EBITDA of about 40 million. Next slide. So a short summary of the timeline of our company. We founded this company in September 2018 with the acquisition of our Canadian subsidiary Critical Click Network, which runs 10 of our community websites. We then continue to build on that platform and have launched a number of new communities on that platform. The first one was released in Q4 of 2018. We then prepared the company for an IPO. We raised a direct share issue of about 30 million in the early 2019, and we then moved on to conclude another share issue in November of 2019, and then IPO'd at Nasdaq First North in December of 2019. In 2020, we focused a lot on our business development, and we launched our internal sales division, MOBA Services. We also launched a subscription program for our community members called Prime, and we made, at the end of 2020, we made an acquisition of a really well-known gaming publication called MMORPG.com. And in 2021, as I mentioned before, we continued our growth journey with the acquisition of MagicFind. So next slide. I will go over a little bit on how we see ourselves in the market. So we can move to the next slide. So the gaming market, as we see it, is divided in verticals. We have been operating in what we call the gaming services vertical with our web-based community websites. We have been constantly looking into what we think is very closely related, which is the broadcasting and the streaming vertical, which is extremely massive within gaming, and had a target of entering that. So with the acquisition of MagicFind and Union for Gamers, which is our YouTube network, we were able to join that vertical as well and broaden our product portfolio. So next slide. The way we exist in the value chain is that we attract gaming fans from all the verticals within gaming. So fans of esports and gaming in general are likely to become fans of our products if they play specific games such as League of Legends, Smite, World of Warcraft, or even Minecraft. We also get fans from the different game developers who stand behind the games. They constantly work on their product, the game. They launch new updates that makes the game more interesting and creates more players for that specific game, and those are also likely to come across our brands as they develop as players. Influencers and professionals who have their own big communities are creating interest for the games that are also attracting new fans for our brands. And now with our own streaming vertical, we are able to expose our brands much more in the video vertical. So next slide. Our strategy consists basically of two major strategic pillars. We focus a lot on organic growth of our existing assets. Since we are a community-based company, we listen to very closely to what our community's feedback of our products are, and we make sure that we develop our platforms and brands to the wishes of the community. This creates organic growth because we keep on developing our brands and platforms to better suit the existing communities. The other pillar is our acquisition track. We have been successful in acquiring and then integrating and developing the acquisitions we have made to date. So what we are looking for are strategic acquisitions that tick all of our boxes, and then that will boil down to our group-wide synergies that we are constantly developing. For instance, our launch of our sales team that can be applied on our entire product portfolio, and new acquisitions are easily integrated into that. So next slide. What we do when we develop our communities is that we focus on large and established underlying games, such as League of Legends, Dota. We now also have communities for World of Warcraft, Minecraft, and other really well-known games that have had a long lifespan and a massive fan base. So that's what we focus on when we are looking for products to either develop or to acquire. Next slide. User-generated content is really the cornerstone in our entire company. Our websites are mostly driven by user-generated content. Our users either produce content by community discussions, such as in forums or discussion threads, but we also have a platform that serves as a self-publishing tool for our members, where they can publish game guides for our big audience. So we have thousands of content creators that produce content and that we allow them to publish on our brands, which are then consumed by millions of gamers and fans who enjoy the content because it develops them as gamers themselves, and they become part of a lively community where we have a great atmosphere and discussions. So we are able to generate quality content at a low cost, and the community will then surface all the most high quality content based on our algorithms for voting and other things. We monetize these community websites by ads, both direct and programmatic. Next slide. User-generated content, it's the same thing for our YouTube network, Union for Gamers. So we have about 1,000 content creators that run their own YouTube channels and create their own content. It could be gameplay, it can be just mix-up of different funny scenarios that they have encountered in different games. So they generate the content and have large followings that creates millions and even billions of views per year for the video content. These videos are also generated, monetized by programmatic advertising. The next slide. Since our acquisition of Magic Find, we have a broader and more attractive product offering for our customers, which are ad buyers. So we have increased our ad inventory with the added 10 community sites. So now it's a total of 20. So we can offer our direct clients a much bigger ad inventory. Our programmatic ads are also much larger size, and media buyers can buy in much larger scale from us now. Now we also offer video ads through Union for Gamers, and we are able to offer brands the opportunity to work directly with the content creators on YouTube, where they can promote a product or a game. So a lot more to offer as a whole right now. And we see significant potential in each of these categories. And we work really hard and make long-term investments into realizing all the opportunities that we see here. So next slide. Some financial highlights from our freshest quarterly report for the period of April to June. Our sales increased by 317% and amounted to over 31 million. And our adjusted EBITDA increased by 53%. We had really strong organic growth of 30%, plus the acquisition of Magic Find, which is only consolidated for 1 month in the reported quarter. Some of the other highlights of the quarter was that we were able to carry out directed share issue of 110 million crowns to finance the acquisition of Magic Find. Together with Magic Find, we also launched a new company called Creator One. Creator One is a company that works with content creators, direct partnerships with brands. We also reported that in July, our preliminary numbers, revenues increased by 898% and amounted to 23.5 million, with an organic growth of about 20%. Next slide. Our growth development has been really strong over the last 3 years, the first 3 quarters. We have been able to increase that by 188%, while being really profitable and growing EBITDA 75%. Next slide. Looking forward for us, we will keep on reinvesting in resources and development to support our continued growth and realize all the synergies and other opportunities that we have at hand. Where we will focus on developing new formats that are attractive to both our community and our strategic partners. We focus a lot on the continued optimization of our sales process with the aim of getting maximum return on our ad inventory, the content creator partnerships, and our global audience. We believe that we're not even close to reaching our potential here. We continuously keep scanning the market for great acquisitions and people that tick the boxes that we set forth for acquisitions. And we are overall working to maintain and develop our position as a world-leading gaming platform, and being willing to invest in new products and attract great new people. And that was my presentation. So I leave up to QA.
All right, thank you very much. I will proceed with some questions here. Obviously, you touched on your M&A agenda there, but if you perhaps could walk us through a little bit more on what sort of criteria you have when you evaluate an M&A target.
There are several things. If we look at financials, we are a profitable company. We want to acquire profitable companies. So that's one thing. More importantly, we look for synergy effects and being able to integrate, hopefully, great new people into the company that can help us grow overall. So I would say the synergies and the people behind our acquisitions are at the top of mind for us when we scan the market.
Understood. And just in general, in the overall pipeline current of potential targets, if you compare now versus 1 year ago, what is your view on this, both in terms of the quality of the potential assets you see as well as sort of the current multiples in the landscape?
So I would say the pipeline is growing because we have now successfully completed a number of acquisitions, and our brand is growing in the gaming vertical. So we get more M&A leads these days. The quality of potential targets are, I would say, on average, really high. There are a lot of interesting products and ideas that people have been putting together. So there's a ton of stuff to scan out there, and it's really interesting and exciting to do that. And the multiples is really hard, I think, in our space. This market hasn't really been consolidated. There isn't a ton of companies that do a bunch of acquisitions. So, and founders of great products are typically not that business savvy. So multiples can be all over the place. We have been able to acquire our targets with what I would describe as extremely attractive multiples. But I wouldn't say that the market is so mature that there's a red line in the eyes of the potential sellers, at least.
Understood. And obviously touched on this earlier on the presentation, but you completed one really transformative acquisition in Magic Find. And if I just look at your past acquisitions, you've been quite successful in making the switch towards more direct sales. How quickly do you think this process will be in regards of Magic Find and integration, so to speak?
Since Magic Find is basically a two-part company where they have the community websites, which is basically exactly the same model as we have been working on traditionally. So the process in the direct sales area in that regard is already ongoing. On the YouTube side, we have as a goal, and we mentioned that in our latest quarterly report, to be up and running with direct sales during early to 2022.
Understood. There's some good color right there. And then just in general, obviously, I assume you saw a little bit of a boost in traffic, etc., during the pandemic. I'm just curious to hear here what you currently are seeing in regards of any sort of negative reopening effects here during the fall or anything like that.
Yeah, there was a massive spike in traffic, especially, I would say, from the period late half March, April, and May, and then it sort of slowly went down little by little. That's not really a concern of ours, I would say. Traffic is great. We still have great levels of traffic. During the traffic spike, it was really hard to monetize all the extra traffic. So it didn't really matter that much to us. So we've been able to increase our average ad impression revenues now, since I would say things have gone back to being quite normal. We haven't really seen any negative effects of reopenings in that sense. So the ad market is more stable, and we have many millions of hundreds and millions of ad impressions to monetize each month. So we haven't worried or paid so much attention to the pandemic effects, actually.
Understood. And then just on the general exposure here, could you perhaps give us some flavor on now when Magic Find is fully integrated, etc. How much does the largest game constitute of total revenue?
Now with Magic Find, it's I would say the largest game is not more than maybe 20%, since we've broadened that a lot, especially on YouTube, where our content creators cover, thousands of games. So our exposure to certain games has gone down by a lot lately.
Got it. There's some good color right there. Our time is running up here, but thank you very much, Björn, for doing this. Much appreciated.
Thanks for having me.
Welcome back to ABG Investor Day. My name is Adrian Glani and I'm an equity research analyst here at ABG. Our next presentation is with I-Tech, and with me today I have the CEO, Philippe Chaban, who will hold the presentation, and after that, if we have time, we'll have some Q&A. With that being said, Philippe, I will hand it over to you for your presentation.
Okay, thank you so much. I'm very pleased and happy to be here at this Investor Day. We will now listen to the story of I-Tech, which you already from the beginning of this slide can understand is a company operating in the industry of global shipping, and most specifically on the coatings that are underneath the waterline. Please switch slide. I-Tech is a listed company on Nasdaq First North in Stockholm since 3 years back. It's a biotech company operating in the fine chemical industry or even in the traditional chemical industry in terms of being a supplier to the global paint makers, traditional coating manufacturers, i.e. The technology has been a startup for many years, but it's now an available and established technology, so to say, and it's surrounded by a lot of extensive patents and regulatory approvals, which is a key thing in this industry. As having said, it's a company oriented into the shipping industry. It's easy to and fair to say it's a global market we're looking towards, and it's a pure export company. We have a lot of proven evidence that the technology makes a difference. We have a take-up among the leading paint makers, but there is still a lot more to do in this area. We're located in Gothenburg in the premises of AstraZeneca BioVenture Hub, which are purple in this site map of one of the AstraZeneca R&D sites, the biggest one, I think, located in Mölndal again. Next slide. So just to give a glance of where I-Tech is in the value chain here, we outsource production, which is a quite high-tech, complex production of APIs, which is then pharmaceutical grade manufacturing sites. I.e., we use the same kind of suppliers that large pharma manufacturers are using. We control the IPR in this domain, meaning patents, tech pack, and know-how. We then run on agreements with 2 different suppliers who then ship and pack the material in the type of boxes and containers you have in the middle of the slide for global shipment, meaning we do not really see the material here in Sweden unless we bring it home for inventory purposes. The customers we then supply are exemplified by Hempel, Jotun, and Shikoku Marine Paints, all being leading brand names in the marine coating industry. Global regulations are also key. Also, we control regulations in all key nations, which are on the map in the central frame of the picture. All green are countries requiring specific registration and are important for shipping. Those in reddish are also important, but mainly for the leisure boat market. And there we have only initiated regulatory approvals in the United States, but not in the others. All the gray areas are possible to operate in for I-Tech. So most of the world is under our domain. Next slide, please. So what are we doing now? Well, first of all, what we do is keeping barnacles away from hulls. They attach easily to any surface that is submerged to any oceanic water, and they then start to create a shell or build a shell, which then becomes a roughness issue on the hull, and then it causes extra drag, and that leads to extra fuel consumption. How we do it is by using a specific molecule called medetomidine, or Selektope, as we say, that is incorporated in marine coating to actually deter or repel the barnacle larvae from the surface. So barnacle larvae coming in contact with this molecule gets hyperactive for a certain time, leaves the surface, and moves away. The effect is tremendous. It's high efficacy and high potency relating to this molecule. And you can see the square on the ship, which is then containing Selektope, compare them to the main hull, which is not. The ship has been laying idle for a long time, so this is not as bad as it should be in a normal on a normal trading ship. but it exemplifies the tremendous power in this molecule. So the molecule goes into the paint, creates this amazing effect on barnacle larvae, which is then a receptor-stimulated effect and not anything else. Next slide, please. So the purpose of all this is to reduce fuel bills, and various academic related research teams have quantified this. In this case, it comes from Schultz in US, linked to the US Navy, who have tried to put the magnitude on the resistance or extra drag that fouling in general causes. And as you can see on the left-hand side, the bars are not as high, meaning it's slime and so-called soft fouling we're talking about. And then when you come to the higher bars, it's correlates to the presence of calcareous fouling, meaning barnacle fouling. And the larger or more extensive the fouling is on the hull surface, the worse the drag gets. And you can see it goes up to even 80% extra drag in a very, very worst case condition. Sometimes this worst case condition is visible on pleasure boats who lay still all the time. For ships, it's maybe a very extreme case. Meanwhile, then some of the middle bars are more representative, and then causes yet a huge impact on the fuel bill, and is very likely the difference between profit and loss on the journeys. To give you a glance of the magnitude of fuel used, you can see a VLCC at least at 100 tons per fuel per day, depending on speed they travel. And if you add 30% drag to that, which is then 30% higher fuel consumption, it's a significant increase per voyage per day. I.e., it is a very good advice to use best possible anti-fouling coatings for the revenue of saving fuel. Next slide, please. Apart from the obvious facts that are put on table that fouling has a big impact on the fuel consumption, recently IMO has signed in for 2 different indices that will actually force ship owners to be more careful on how ships are operated and designed. We call it a 40% reduction in carbon intensity plan, which consists of 2 indices, EEXI and CII. Both are telling the ship owner and then the freighter about how efficient the ship is designed, the EEXI, and how efficiently the ship is operated, CII. A good anti-fouling coating will make a big difference on the CII, and as you can see from the graph, there is quite some fuel-saving opportunities relating to the hull. Should be said that industry general speaking number on the saving potential on transferring the full fleet into the best possible anti-fouling coatings translates into a figure of around $30 billion worth of fuel. That is the journey that has to be done, and Selektope is a technology ingredient to drive, or help at least, to drive the anti-fouling coatings into the direction of saving that kind of money. Hence, it's not possible to neglect the importance of the underwater condition. Next slide. To give you just a short overview of the CII, Carbon Intensity Index, which is then how well the ship is managed, operated, versus the design optimum point. There will be gradings, as we see in many other products today, on how efficient the ship is compared to then a certain standard classified in the CII. It is then important for a ship owner to have a ship in a as efficient class as possible to then get the best possible charter contracts. And this will be the final switch in this industry, where efficiency technologies will be well worth investing in, even if you're not owning the ship, or if you're owning it and not operating it. Before, there was a difference here where those who owned and operated had a big impact on this and really invested, while the others didn't really take care for the fuel bill and hence didn't invest. This will change, and we will have a great impact in this industry from this kind of indices. Next slide. The market is huge, as you can imagine, by all seeing photos from various ports such as Singapore or Los Angeles, where a lot of ships constantly are waiting for unloading, offloading. In fact, there's around 54,000 registered vessels, about 2,000 deadweight ton. That is a significant number, and they normally have to go into dry dock every 3 to 5 years, depending on how old they are. We think there's an average opportunity of 10 to 15,000 dockings per year. That includes the smaller ones at 2,000 deadweight tons, should be said. All of those needs to get a new coating at new building and at every dry docking opportunity. Output from new building is around 1,500 vessels per year, a normal year. That has been quite much lower the past year. There's another type of ships which we may classify into so-called industrial ships that are tugboats or supply ships and coastal ferries and so on, who also has interest in all kind of efficiency measures, but are a much smaller surface, but they are quite many in number, wherefore that is also of interest for everyone in the coating industry. Finally, there is a huge number of leisure boats. For Selektope, this is good information because these lay still at idle most of the time, and that's when fouling occurs. So hopefully, together with the prominent paint makers, we can get a grip on this market, and steps are being taken into the United States and Japan to target specifically this kind of vessels. But nevertheless, the big ships to the left will be the engine of the growth in this company and for any manufacturer, coating manufacturer. Please switch slide. So how is this industry? Well, from Corona, it was quite bad, obviously, as goods were not shipped the way it was the years before. Things came to a stop, and you probably remember a lot of ships idling all over the place, and we still see effects of containers being on the wrong place in the world and so on. New building was really bad last year and up until recently, but now a shift is being observed. So the first 7 months, new contracts are exceeding the number of new contracts signed for the full year 2020, as an example, and is expected to rise further. That shows optimism. And as a contract is signed, one can count on output, i.e. delivery, somewhere around 2023, 2024 timeline, depending on capacity. Also, earnings are showing a better trend, certainly for the container business. I have to say that some ship types still suffer a lot and are not represented in this upward trend. But bulks and containers seems to be coming out of the worst phases, where containers are really in the upstream of earnings. In terms of charter time and charter time rates, also containers are up, which is aligned with what you hear in global media about containers being in the wrong spot and a lot of congestions on that side. All in all, this shows optimism as some are making money, loading up for investments in efficiency technologies as per these new requirements on classifying ships into different efficiency indices. So it's good news that they make money again and that new building is coming back. Next slide, please. So where are we in all this? Well, we work through the paint makers who are customers. We work with most of them very actively. I should say there is about 5 or 6 who completely dominate the global shipping market. Not said that is true for the small leisure boats, but for the global shipping. There's another 3 that are important, certainly in certain regions. So we say normally 9 are quite important, 9 customers. Most of these we work with and have progressed quite far. As we mentioned in Q1, we have about 6 large paint makers contributing to our top line, all placing orders to indicate full-scale testing or some sort of pre-launch if they are not already launched. So I-Tech is in a good position in broadening its customer base after many years of work, both on our side and on the customer side. And as this is a slow-moving development process, it will still require time before we see the full effect of the ongoing work. Next slide, please. So what has happened on the customer product portfolio since last year at the same time approximately? Well, it has expanded considerably. Almost double as many products are now on market than at the same time last year. Almost all of them come from Shikoku Marine Paints, as you can see here, who are launching and promoting products in all different kind of vessel segments, including the leisure boats, specifically in Japan in this case. That, although products being new, that puts us in a position where we would expect a good basis for continued growth once products get recognized in the market and once we see a full uptake after the COVID, which is still an issue in Japan with local shutdowns and staff issues in yards and other industrial entities. It should be said that other paint makers who I mentioned contributed to the top line in the first quarter are not visible here because they simply are under confidentiality work when it comes to their products. So there's a lot more hypothetical products out there than what we can display. Next slide, please. Just to give you an idea why these products are different when they use Selektope. Selektope containing products are used to drive up the static performance, extending the idling guarantee. That is the essence of what the technology does, either with copper oxide hybrids or in standalone or without copper oxide formulations. Some of these formulations, specifically the one up to the right, is also proven to have a very strong effect on slime and general hull performance, where Selektope is a vital ingredient, in this case, replacing copper oxide. Putting this kind of coating into the tier of the absolute best performing coatings on market. And the first ever of its kind being then full copper-free steel self-polishing. So let's see where that goes. But again, Selektope plays very well with copper oxide, and the important message is that it drives up performance, certainly in terms of idling days. Next slide, please. So a few words of the quarter. It's some positive key events have occurred, although it's a tough business cycle, meaning we're still suffering from customer inventories being a bit high after the pandemic. Big breaks were put on, and we still see effects on that. That's why the revenue decreased by 21% on value and 11% on organic. Consequently, EBITDA for the first time for quite some time now fell on the negative side, -1.2. And the EBIT result was -3, which then is a consequence of implementing the incentive program to staff members mainly. So one-time effect there. Apart from the COVID, we also see high raw material costs that are pressuring the margins of our customers and making it more difficult to sell high-end premium products with a margin than maybe the more mainstream products in the middle segment. So maybe that has an effect as well in delaying the return to growth, which we saw up until Q2 2020. Also good uptake still on other customers, except the leading one, Shikoku. We think that's very important to see and to hopefully continue to see that in the quarters to come. New products have been launched, which is a key highlight and builds confidence that the underlying baseline is growing so much stronger in believing in a return to strong growth figures. Next slide, please. In numbers, we reached a sales of 12.8 versus 16.2. You saw in the previous slide that decline, but for the first half year, the difference is not that big. So let's see how much we can recap on the second half of this year to maybe hopefully exceed where we were last year. Gross margins is a positive highlight with moving up to 50% compared to somewhat below 50% last year, and even that same quarter as well as the full year last year. So let's see if we can keep that on this level, potentially growing with higher volumes in the future even. Other comments on this slide is that operating cash flow is highly negative, mainly due to inventory buildup because of COVID risk mitigation. So we bought out inventory and relocated in the world for supply capabilities to our customers. So that's why we have a negative cash flow here, and I think that's an important message. It's nothing else. It's not the extended burn rate per se, although we are investing a lot more now than before, but the major part of this comes from the inventory buildup. Next slide, please. Just to give you a final show here of products that recently have been applied on the ships. So this is a new build series of 8. The first one went into water recently in June, July, using one of the Selektope products highlighted before. Full ship coated with Selektope technology coating, and it's also propelled by methanol engines, so it's an innovative approach and fully in line with what IMO would need to see to classify it as one of the most efficient ships around of its kind. And we're very proud to have Selektope technology on these 8 ships. Next slide. So this final slide, just moving back to the discussion of what is driving the industry. Right now, it's obviously reducing emissions to air, which is obvious, knowing that shipping is 2.6% of global CO2, almost equal to the nation of Germany. A lot of fuel to be saved, and a lot of goods, 80% of all goods shipped are on a ship at some point. So it's very important that the shipping industry still works and is reducing its environmental footprint, because it's completely essential to sustainable transportation also in the future. Another topic we haven't touched is the direct effect of foulings. That is, except for saving fuel, it actually has been determined a possible vector of transferring invasive species. Before it was ballast water tanks, which is still obviously a concern, although a lot of progress have been made. The next thing is clean hulls, because if the hull is not clean, it's being fouled, then it has been shown to bring forward new species into different ecosystems. Therefore, some nations, such as California, New Zealand, Australia, and certain countries in Europe, are quite picky on gaining evidence from each ship making a port call that it's free from fouling, or at least it has a low risk of having severe fouling. If they cannot prove that, they will not be able to enter the port, and hence they will have to move out to open ocean and find some sort of cleaning service that takes time and costs a lot of money. So this is actually one of the most interesting drive forces to move the paint segment from low grade, which is quite a big portion of the total sales today, to the premium grade, where I think most of the paint systems will move into very soon. Finally, obviously, there is a need for various types of materials in the coating, but using as less materials as possible to achieve a specific objective is obviously a better choice. So hopefully we can contribute to reduce metal oxides in these coatings considerably over the years to come. Metal oxides can then be used in much more applicable areas where recycling is possible, in contrast to when used on ship sides where it cannot be recycled. That was my final slide. So I thank you for your attention and look forward to questions.
Okay, thank you, Philip, for your presentation. I'll start right off with some questions here. First of all, you mentioned that the anti-fouling market amounts to roughly $300 to $500 million US. Are there currently other actors with other technologies competing for market shares with you here, or are you the first in this space?
First of all, that market figure, $350 to $500 million, is what we are capable of doing if Selektope was selected into every liter of anti-fouling paint used. The market for anti-foulings as such is somewhere around $2 to $3 billion worth. So this was the I-Tech potential. Other ingredients are there as well, and some of them need to be there together with the Selektope technology. But of course, there are other opportunities that are trying to steal this market share or take a bigger, and that could be the silicones, which is non-bicidal anti-fouling coatings. But honestly, bicidal coatings are dominating today and likely will be dominating. And in that space, Selektope fits in basically any combination. So we actually don't see that much of a competition there. We see only opportunities in being combined into coatings to further drive them up in the performance spectra.
Okay, and you mentioned as well that you have a significant uptake among some of the largest paint manufacturers. So could you give us a reasonable guess to how much of their current sold products are containing Selektope, and how high do you think that percentage could potentially go in the medium to long term?
Okay. I said we're just scrapping on the surface. Shikoku, who has gone the furthest in using this technology, have a few percent of the products with Selektope. I'm actually not sure how much, but there's still a lot to do. They have more products now, as I showed you, but I haven't seen those effects as this brand new products. But there's certainly a lot of things to do there. For the other paint makers, it's really on the low side of this, hardly of the percentages. I think Selektope can be 10 to 15% market share in each customer, as it will hopefully have a strong position in the premium self-polishing anti-fouling coatings. And that would be a moderate estimation, but that's at least a first target. It will take some years to get there, though, as you can understand.
Okay. I'll try to fit in one more question, as we have a few minutes left here. If we take a look at the unit economics, how high would you say the cost to produce Selektope-containing paint is compared to normal competitors? And also on the other side of that, how does the pricing differ?
So if I understand you right, the first question was how much Selektope paint that could be produced. Was that right?
What does your cost of producing look like compared to normal paint? And then on the other hand, the pricing that you can take for that paint as well.
Okay, so we don't produce the paint, right? We produce the ingredient technology Selektope. That is one of a few active ingredients, so-called bisides, used in paints. On our side, there is a certain cost of goods contribution, of course, similar to what other ingredients, certainly copper oxide, have in the coatings today. So it's similar to that, meaning if you just add it in, there will be a cost increase, and there will subsequently be a possibility to increase sales price because you're actually offering higher static performance. Now, that has been proven to work in a range of products, but it also requires quite some evidence because it's a high tricky sell when you're up in these cost levels. There are other products on market where Selektope replaces other agents and makes a less impact on the cost of goods. In that case, the gross margins appear, to our best knowledge, actually increase for our customers, and that's where we want to be. And we are investing a lot in trying to help to guide how to reach increased margins while using Selektope.
Okay, thank you so much again for your presentation and also for your answers. Do you have any final remarks before we round up?
No, just happy to be here again and hope to see you live soon.
Yeah, same.
Hello and welcome to the next part of the ABG Investor Day broadcast. My name is Torjus Loftheim and I work with Shipping Equity Research from the Oslo office. Next up to present is Concordia Maritime, a tanker shipping company with a fleet consisting of 10 product tankers and 1 Suezmax tanker. The company has been through a tough process the last year, but with the increased anticipation of an upturn in the tanker market, it will be very interesting to hear what CEO Kim Ullman thinks about the future and Concordia Maritime going forward. Kim, the floor is yours.
Thank you. Thank you very much for that introduction. And yes, this is a good opportunity to present Concordia Maritime after a couple of turbulent months, I have to say. Next page, please. Next again. That's the one. Okay, let's be conventional and go quickly through the key facts of the company, you know, who we are and what we do and where we are in the value chain. So we're listed in Stockholm, been there since 1984, and Stendörren Group is the majority shareholder. Our current market cap is only 332 million. It's been severely under pressure, of course, after a number of bad years. And we are, as the moderator said, a tanker shipping company, and we're operating in the entire world around various routes. And we own 10 product tankers and 1 crude tanker. Next slide, please. And to simplify things and even quicker about our, take a look at our business model. You know, down at the left-hand side, you see the round ball, if you will, where he said purchases of vessels. That's of course very important to make sure that you purchase the right ship at the right price. Then you have to operate the vessels. You operate it in the market, in the tanker market, and you can do that in various ways. You can do it on the spot market or different kind of period markets that we can fix out for a number of years, for instance. And then the not the very important part, which is of course the sale of vessels, which is also part of the business model. So we come back to the sales of vessels a little bit later on in our presentation. That's the business model. If you change to next page, please, you can see, okay, where in the value chain are we? If you go from left to right, you can realize and see that people are extracting oil on land, at sea, or wherever it is, and it needs to be transported. And if it's not transported by pipeline, it's transported by big crude oil tankers. Then it goes to a refinery and you make products out of it. And then you have product tankers carrying these refined products. So these ships are a little bit more sophisticated than the crude tankers. And then it goes to consumption on the very right-hand side, and still 70% of the consumption of oil goes into transportation. And today, currently, we are nearly or close to 100 million barrels of daily oil consumption. Okay, next page. Next page is just a nice picture of the ships. It's the 10 P-Max product tankers that I'm coming back to in a bit, and a crude tanker. And we also participate in a number of in-chartered Suezmax tankers. Next page, please. Next slide. So the P-Max concept is, and I've been showing this for many, many years, but it's important to realize that the P-Max vessels are slightly bigger than the standard, what we call medium range MR tanker, which is also a product tanker. And we're transporting the same things, but we can, if it allows, if the market allows, load 30% more cargo. So which makes it a little bit more flexible, and it could be quite competitive on price when it comes to freight per unit by this extra loading capacity. So then it's up to us to make sure that we find niche trades where this extra capacity can be utilized. So if transport economy on the one hand, next slide please, if you turn the ship around, you realize that it's a wider ship, and it's a ship that has 2 engines and 2 rudders and 2 propellers and has a safety feature in it. Okay, next slide, please. Currently, I said these special ships needs to be placed on niche trades where the extra capacity can be utilized. And currently we have at least 6 out of the 10 in those types of trades. Next slide, please. We have recently gone through, over the last 2 years or so, quite a heavy investment program. We invested up against $40 million in dry dockings of 10 ships, 10 of our ships, where we also have had installments of statutory systems for handling and purifying ballast water systems, treatment systems. So the ships are now almost all of them done and out in the market, being just newly docked, just ahead of this expected upturn in the market. Next slide, please. So the earnings side, we need to make sure that we see a reflection on the earnings side against what we have invested in when it comes to a little bit more cargo capacity. And this picture is trying to show the fact that against a market index, a worldwide market index, we're at least above these general worldwide market indices. Next slide, please, which is just a flip over slide. We are now going to talk about the tanker market and its effects on Concordia Maritime. So let's stay with the next slide, this 13 that you're stop there. 13 is fine. The tanker market over the last number of years. 2015, if we follow my line of thoughts here, from left to right, it was a strong market. We had $25,000 to $30,000 per day at the peak during that period. And you can see the green line going through where it says break even for this similar type of ship, this MR type ship. And this is a general market picture. So it's not our returns you're seeing here. And so, okay, we had a good market in 2015 and started to go down in 2016, and then 17, 18, and 19, we had quite bad years, very bad years, well under the break even, as you can see. The reasons for that, we had high inventories, we had production cuts in oil, and we had a lot of ships being delivered. We saw this coming, and at this stage, we made sure that we had liquidity enough to weather the storm by selling 3 ships on sale leaseback terms, and that took us through these bad years. Then we expected the market to come up in 2019, and I know that we have been saying this for quite some, or at that time we were repeating that, and in all fairness, the market did not come up in the middle of 2019, but as you can see, towards the end of 2019, it actually improved quite dramatically, or at least quite considerably. And it was a structural upturn that was expected at the time. Then 2020, 2021, we all know what happened at that time when COVID came. So this is the big picture from 2015 to 2021. If we just then isolate 2020, 2021 in the next 2 pages. So if you turn slide, please. Are you on slide 14 now? Thank you. Slide 14 is showing first the fact that we had a very short spike just after COVID had entered or had appeared. And that's a very strange thing, because we had Saudi Arabia lowering the oil price, increasing the oil production. Prices went from $60 a barrel to $20 a barrel. So in spite of the fact that we had just COVID starting and consumption was going down, people were stocking up like there was no tomorrow, and they filled up their inventories. And during that short period of time, of course, the rates shot up very drastically, as you could see. So, but then if you turn to the next page, please, we just realize then the rest of it was just a big hangover that we've been talking about for years now. That, there was a weak market, very weak market, because all the inventories were filled up to the brim. Demand had gone down because of COVID, and OPEC needed to adjust their production to match the lower demand. So there was basically very little oil to be transported by sea. And this was reflected in the tanker rates. So you can see it's below $10,000 a day. Okay, next page, please. Okay, same thing again, just showing in another way how quickly the oil consumption in the world deteriorated in 2020. Next page, please. No doubt this has had an effect on our financials. We showed a Q2 result of minus 88.4 Swedish. And against and that was the first half of the year, the first 2 quarters in total was minus 200 million, compared to, with that spike of last year, we had a profitable quarter the same period last year. Okay, next page. So with the fact that 16 to 20, there was a weak market, 2021, we had still the bud market and large investments, and 2021 has started and really been poor for the first 2 quarters. We had financial challenges that made us come into a position with financial challenges. We communicated this to the market in our first quarter report back in April. Next page, please. And what we did announce at the time was the fact that we needed to talk to the banks, we needed to talk to the main owner, and we needed to come to a solution. And we have come to a solution, and we are presenting the actions for what we call a restart, if you will. We have a term sheet agreement with lending banks, where we've lowered the rate of amortization and new covenants. And we also need to have, with this new term sheet, with the bank's consent in order to pay dividend. And with this also comes a secure time charter of 5 years for all the P-MAX class vessels to Stena Bulk at $15,500 a day, with a profit sharing. So whatever the ships earn over and above 15.5, we share 50%. And we have also the possibility during the time to sell the vessels in spite of the fact that they are on charter. And in order to, so with that, we have, of course, we have our downside protected and we share the upside. We have started to sell vessels in order to increase our net liquidity, which was also part of the deal with the banks. Next page, please. Same page, all it says within, this little stamp there, that it was unanimously approved by the AGM in August. Next page. Next page is just showing that we still not that one actually, you're still on page 21, please, thank you. It requires, amongst other things, still approval from the bank's credit committee. So we're not entirely done yet, but we expect to be done with this whole thing from within September. Now, next page, please. All of this is in order to strengthen our financial position, and we are well on the way to do it. And as I said, we just have a few weeks before we wrap it all up. Next page. is showing the fleet list and the status. And now, of course, the red bars are, showing or describing the fact that the ships are on fixed time charter. They have a fixed income, and we do profit sharing on top. Then we have still one Suezmax tanker, and we are still a few more months participating in some charter ins on the Suezmax tankers, which is outside of the bank agreement. Next page, please. This is just another way of showing or illustrating the same thing. Take a look at the market from 15 to 21. There's been spikes, there's been bad years. We have had an average, this is again the market in general, of $11,000 a day. We're now going into a 5-year time charter at 15.5, and we share the upside with 50%. Okay, next page, please. This is just to show also, taken out of Clarkson Index, a long-term price trends, how bulkers and tankers are fluctuating in the market. The spot market, the general market goes up, the prices go up, and vice versa. And even if it looks like the tanker line is on the high side, but this is an index that goes back to year 2000. So I would say that we're now at the pretty low end of the valuation of ships. And there is, you can see historically there's been a fluctuation between 100 and 150. Okay, next page, please. Okay, so what do we think about the outlook? What do we see going forward? Let's put it as simple as we can and as summarizing as we possibly can too. Next page, please. What we first of all need is a good world economy. We seem to be having one. We seem to be having a world economy that is bouncing back. We're experiencing it now, and people are, generally speaking, expecting it to continue. That's good, because that has an impact on the oil demand on the next page, where we can see that the 2020 was a low year. 2021 started off low. This is an average what we expect the year to be producing, and towards the end of the year we see a chance of reaching 100 million barrels per day again. 2022 is expecting to stay there as an average for the entire year. Okay, so what do we need in order to meet that demand? If you turn to the next page, please. Well, we need OPEC and oil producing countries to step up their production so that this could meet the oil demand increase. And we see it's coming, and it has started, and OPEC have decided to increase by 400,000 barrels a day per month. So for every month that goes throughout this autumn, we're having another 400,000 barrels a day, which is basically all to be shipped. So we are at the low end of the market right now, and we're expecting it certainly to come up with this extra oil to be shipped. Okay. I said before, if we turn to the next page, I said before that people were stocking up like there was no tomorrow back in a year and a half ago, spring of 2020, which you can see on the slide. It has taken quite a while to get rid of that overhang. Now there is no overhang anymore. We're at an equilibrium where you say this is the equivalent of the average inventories in OECD for the last 5 years. And we're even below that in some instances. So now, in order to not continue this inventory draw and to keep it at a zero level, we need the extra oil that I was pointing at before, and it's needed in the market. So that's fine. Next page, please. The flip side of demand is, of course, supply. And I've been showing this simplistic picture many times before. It shows that the net growth of ships is relatively low, which is a good sign. If we need more, if we have more demand coming up, and we don't have so many more new ships coming into the market. So the demand supply situation, we certainly are of the opinion that the demand side is increasing by a lot more than what the supply side is growing by. Okay, I think that comes to the conclusive slide, next slide, which is basically just saying why Concordia CCOR. From a market perspective, 2020, we've been talking about that. 2021, we see strengthening from second half. I know I've been saying that we should have seen it from June. We didn't. That was wrong, but things seem to be lagging, a quarter to that. But now we are seeing it. We see more cargoes in the market. We haven't really started to see rates to improve yet, but we see at least more cargoes coming back to the market to meet this extra demand that we just been through. And we are a firm believer of a structural upturn in throughout this autumn and 22 and onwards. We, Concordia, operationally functioning very well. A lot of investments gone into the ships to make sure that they can be out there and earn money during this upturn in the market in a good way. We have the time charter agreement. We have the possibility to share profits and to divest, and if we want, still a small organization, and we have the access to the companies within the Stena sphere. And it's not a big fleet that we're showing, but that we are a great cooperation with the Stena Bulk and sail in their various fleets and pools. So all in all, we have access to a critical mass and thereby having the chance to beat the market indices, as I showed before. So that concludes my presentation on Concordia Maritime. I'm happy to take some questions.
Thank you so much for an insightful presentation, Kim. My first question is, as you mentioned, you recently sold your 2 IMO 2 Maxes. Could you please give us some color on how you see the S&P market going forward and what premium your P-Max vessels might receive compared to a standard MR tanker in case of a sale? And additionally, do you plan to divest any of your remaining vessels in the near future? And will the proceeds from a sale be used for dividends or new buildings?
To answer your last question first, it's not first hand. It's not for dividend nor new buildings. It will be to accelerate the amortization towards the new bank agreement. Then we sold the 2 IMO 2 class vessels. That is correct. We got quite a good price for the vessels. So we took that opportunity here and now, more so for the reason of needing to do it than not believing in the market. We do believe in the market. We do believe the tanker market is coming back. With that, also the second-hand prices. So you could say that we should have waited a year. Yes, we should probably have done that, but this was a necessity, so we did it now when we saw that sort of good price without disclosing what it was. Yes, we think there is a premium to P-Max in the S&P market too, because it does and it goes hand in hand with the earnings capacity for people who could utilize the extra capacity. So whether that is 10 or 20%, then it's just a figure, but there is a premium to a P-Max class vessel in the S&P market.
Yeah, and it's all about timing in shipping, as we know. And environmental friendly and fuel efficient ships are becoming increasingly more important for regulators, customers, and investors. You said you're not thinking about any new buildings, but what do you think about investing in a new building in this time of cycle when the order book is around 6%, which is historically low? And in the long term, how do you see your fleet develop over time?
It is correct that the order book is, what you just said, historically low, 6%. 6% of the new orders compared to the fleet, but it has been hysterically high too. So I used to make that little distinction between historically low and hysterically high, and there has been in shipping throughout generations and decades, a willingness to order a little bit too fast, too many ships, and that's been bad for tanker shipping in general. So I think it's quite good that if people could be a little bit more, holding back a little bit more in ordering new ships. We do not need. 6% is still 6%. If we have a growth of 2-3%, and a net growth of ships by 2-3%, it's kind of equilibrium. Yeah. So I don't think we need more ships. I don't think it's a good idea to order ships from that point of view, from the market point of view. I think we should all be refraining from that. I certainly buy the argument that for the future there will be a need for different engines, different fuel types, and all of that. We all need to contribute to lower emissions. There's no doubt about that. There are 2,000 MR tankers in the world right now. You can't just swap them out in a few years' time. It has to be gradual fleet change over the years. So all in all, yes, we need to have a better emission status on the ships going forward, or the ships that we order. But right now, there is no need to rush into that. And we are right now in a status or in a position where we just, I've been through how many bad years we have had behind us. We've been through that, and we've been working day and night over the last almost a year now in order to come to a solution. Now we have a solution. Now we go forward. Now we will start to build for the future, or come up with a plan on how we will look like in a few years' time. But right now, I don't have the exact answer to that. I know that we need to be divesting of a few ships. I know that we need to be investing in others in the years to come in order to grow the fleet and grow the company.
Yes, thank you so much for your answer, and let's hope we have bright times ahead. It's going to be exciting to see what happens. And if you don't have any further comments, then I think this is it for now. Thank you so much for your participation and presentation. And if you have any further questions, please reach out to me, or I'm sure also Kim are available to respond to your questions. Thank you.
Okay, thank you very much.
Hello and welcome to the last presentation of this track today, which is with Acast. My name is Derek Laliberte, and I'm an equity research analyst here at ABG, covering primarily media stocks and investment company stocks. I'm thrilled to have Acast with me today, which posted a very strong quarter, the first one since becoming a public company. And with us from Acast, we have Ross Adams, CEO, and we have Emily Villatte, CFO. And with that, please go ahead, Acast, with your roughly a 20-minute presentation, and thereafter we will have a Q&A session. Please
Great.
Go ahead.
Thanks very much, and thank you, ABG, for hosting this and inviting us for the last slot. Hopefully, the last slot is the most exciting slot. So let's kick it off and try and be as quick as we can and as efficient as we can and engaging as we can. Em, do you want to introduce yourself first?
Yeah, sure. Let's do it. I'm Emily Villatte, the CFO of Acast. I came into the business a bit over 2 years ago, having spent some 12 years in financial services in a big corp FTSE 250 business. Most of that time in London and internationally in Sydney, but I've been spending my last number of years in my hometown of Stockholm, and that is also where I'm based right now. Over to you, Ross.
Great. As you can see, Ross Adams, CEO of the business. I'm based out of the UK, just outside of London. A bit about my background, which is relevant to where I find myself today. I spent my first 10 years of my career working for Capital Radio, which is now called Global Radio, so the biggest radio group in the UK, learning how to monetize audio through advertising. I was then lucky enough to meet a chap called Daniel Ek of Spotify, who pitched the concept and idea back in 2008. I joined the team, the early crew, 30 of us in the business, and we launched the business. My role was to launch the UK with 2 others, and I was in charge of the monetizing the free version, again, monetizing the audio through ads and helping them expand across the globe, obviously learning a huge amount. I was there for 6 years, and then I met another inspiring Swede, Johan Billgren, who's the founder of Acast. And I couldn't resist joining and copy repeating the success I had at Spotify. I've been with Acast the full 7 years of its history, and have loved every minute of it, and been CEO now for 4 years next month. So let's crack on with the presentation. Apologies to those who've seen some of these slides, but I think it's really important to those who don't know us to understand exactly how Acast operates and how the podcast industry as a whole operates, because it's quite different from other mediums, as mentioned. So here, the best way to explain it is with a great analogy, and this is looking at how the internet works. So, for example, if you are a creator and a web page creator in this instance, you need to host that content somewhere, and we've chosen WordPress as the example. So WordPress, you'll host, and that will distribute your website for you via HTML to all of the different web browsers there are out there today. So it might be that you might surf to that web page using Chrome. I might use Safari, but as an internet user, we're still surfing to that same destination, which is hosted in the same place. Podcasting works in exactly the same way. We are an infrastructure play. So essentially, if you have a podcast, you need to host, distribute, and monetize that. Now, rather than HTML, we distribute through something called RSS technology, and we distribute to all the different places out there you can listen to a podcast. And here you can see an example of the podcatchers. We call them the podcast apps, and there's over 250 different podcast apps there, and you can access that content. But essentially, when you push play, regardless of the platform you're using, as soon as you push play, it fetches the show via RSS from Acast as the host. We understand some data about who you are, the content you're listening to. We find relevant ads, relevant sponsorships. We inject those dynamically and digitally, and we send those back, and we monetize that listen. So you might be listening on the Podcaster app, or you might be listening on Spotify to that piece of content. We're the ones who are monetizing it. We're the ones streaming it to that platform, and we're sharing that revenue we're making through ads directly with the creator. The end platform makes no money. All they get is they get free content to deliver to their listeners. So if you look at last year, in 2020, we delivered 3 billion listens across all of our countries. But if you look at the platforms and how it's broken down, it helps you understand how fragmented podcasting is. Podcasting is a 20-year-old medium. Apple were at the beginning of it, hence the name podcast. It came from the word iPod. But essentially, they are they have over 60% of market share. If you'd spoken just 5 years ago, that would have been, close to 90%. More and more platforms have now launched into the space and are offering podcast listening. The sweet spot in the middle there is, a quarter of all listening happened last year with our shows on independent podcast pure players. And then if you look at the growing part of this pie, it's the music platforms. So as you can see there, the likes of Spotify, iHeart, Deezer, etc. And more recently, you've seen the likes of Amazon and even the likes of Audible join the space, and soon to be the likes of Facebook. But this market is entirely fragmented. But regardless, if you want your show to reach the largest audience, you need to be on every single platform. And you need a simple technology that monetizes, distributes your show with a simple drag and drop technology, which is what Acast does. We are platform agnostic. So if you think about how we've attracted, it's 31,000 shows now, the core about our strategy is to become the marketplace, to control the supply coming in and the demand from advertisers, and service those two sides of the pie. So as I said, today we represent some of the largest creators in over 12 markets, delivering content to 155 different countries, actually. And we're growing by thousands of shows every single month, servicing over 4,000 advertisers. And again, that grows year over year as more advertisers get used to podcast buying. But our goal is to basically be the gatekeeper of every financial transaction that happens within podcasting. And we're looking at new monetization options as well through the likes of podcast subscription, which I can mention in brief later on. Here you can see exactly where podcasting is distributed to and how Acast makes money. So we deliver not only to those podcast players, we deliver through the likes of the web, through the likes of different platforms. So the likes of Alexas and smart speakers. Wherever you are pushing play or asking to push play on a podcast, it's us delivering that out there in the industry. So if you look at the 7-year history, as you can see here from the chart, we've effectively doubled our revenue year over year. But let's go back to the beginning when we launched in Sweden in 2014. In Europe, there was no podcast market from a commercial standpoint at all. No advertisers were buying podcasts at all. So we came along and disrupted the space using digital technology. So we invented dynamic ad insertion, which is the norm technology-wise today. But we were the first to do it. And we were the first to apply those digital metrics, those one-by-one tracking pixels, which digital media expects. So, we had to apply those if we were to attract those digital budgets across to using us. However, we had to educate the ad market on how to buy podcasting. So the reason why we started to sign those key publishers, you'll see the likes of Aftonbladet, Dagens there, The Economist, the FT, was because advertisers and the media agencies were buying those media brands in other ad formats. And so it wasn't a huge leap of faith to trial out podcast buying, because those brands attracted the advertisers to the space. Behind them, we represented thousands of other shows, and we introduced them to those after they got comfortable with podcast buying. But what we found straight away, especially with English spoken content, is that content travels. So if you look at the likes of The Economist, the FT, some of our publishers, 30 to 40% of their reach actually happened, and the listens happened outside of the UK. So if we're to be fully efficient at monetizing those listens, we needed to have feet on the ground in each of those markets where their content was being consumed en masse. That also gave us a good roadmap of where we should be launching in next. And as you can see there's a lot of English spoken frags across the top, but essentially we've copy repeated that first mover model and first mover advantage. America being the only market where a commercial podcasting market existed in a different format, which we've now disrupted and changed, and the market is now buying in the way that we sell. Not much more probably to say on this one.
All right, so if we look at how those ad revenues break down, you'll see here that more than 90% of our revenues come from ads. There's a small part of non-ad revenue on the side where we have the likes of SaaS and subscription revenues, and Ross will touch more on that subscription piece later on. But if we go back to the ad revenues, there are two main formats that we deliver. Brand ads, that are those pre-recorded ads from brands. We typically split them 50-50 with our creators. And if you're a podcast listener, you might have heard those host-read or sponsorship ads where the podcaster themselves would actually deliver the ad creative. So in that instance, the standard is a 70-30 split with those creators. But mind you, the pricing and the CPM on that type of ad is higher. So at a gross profit level, after we've taken the revenue and then shared the relevant part with the creator, we still get a beautiful part of the pie. And just back to why this all matters and the TAM that is out there that we're going after. If you look at a recent PwC study looking at the global audio market, right now podcasting is just over that 1 billion ad revenue market, and 28 billion US dollars is like for like commercial radio, so radio injecting ads. And that is into a medium that does not have the same digital capabilities. They might have the reach and scale, but not the same ability to target and deliver value to advertisers. And PwC are forecasting that this podcast ad revenue market will grow by a compound annual growth rate of just under 20% in the next number of years. Now, Acast has had a track record of beating the market and also playing in the part of the market that has the highest growth within it, and that's what we have. That's what we're intending to continue to do. A little bit deeper into the numbers, Derek was kind enough to mention our strong Q2 report. We delivered 130% growth in that quarter compared to Q2 2020. Now, we always compare against the same quarter last year due to the seasonality of ad revenues that come with this space. Now, it was an easier comp last year. We did have an impact of COVID, as you'll see on that right-hand side. In Q2 2020, we had, for us, a low 22% growth. Now, some of that ad revenue where advertisers paused parts of their spending came back in Q4 of last year. So when we get to that point, that will be a tougher comp. But setting that aside, 130% net sales growth or 134% if discounting the impact of FX is still a result we have to be happy with. We maintain that healthy 37% gross margin. That's also the gross margin that we've indicated to the markets that we're targeting for the foreseeable future. And that might fluctuate quarter over quarter, but we have had a good track record of holding that healthy gross margin up and actually increasing it over time. Now, in Q2, we did list the company's shares and we incurred some costs related to the IPO. But if we set those aside and look at adjusted EBITDA, we diligently follow our ability to deliver operating leverage and, in essence, scale our OPEX line, and evidencing that by reducing our EBITDA loss margin. We've had a strong track record of doing just that in the past, and Q2 was no different, going from -45 Q2 20 to -21 in Q2 of this year. And if we look at our different market segments, Europe, Americas, and other markets, we look at their local profitability targets before allocation of overheads to make sure that everyone is carrying their weight and everyone is scaling in the right way. And right now, all of my market segments are delivering what we're asking them to do. Europe grew that 174%. Europe did have the biggest impact from COVID in Q2 2020, but regardless of that, it's still a fantastic result. And Europe cannot deliver those types of results without our most established markets, UK and Sweden, delivering stellar performances. And what that tells me is that there is no such thing as a mature market in podcasting, even those established markets are performing really well, where we already have a significant market share. The Americas was really impacted by FX. So if we strip out the impact of the USD to SEK conversion, the Americas delivered 84% organic net sales growth and went from being in the red at that local profitability line at the bottom half of the screen to being in the black. Same thing for other markets. That's mainly our Australian, New Zealand business and our international sales teams. Everyone is delivering what we're asking them to do and producing great scalability. All right, our listens. We've seen this dynamic in the past and we'll continue to see it in the future. That we'll continue to grow our listens, but we will also improve our ability to monetize those listens. We've spoken about the impact of an Apple buy that slightly reduced our Q2 2021 listens to what they would have been without this slight reporting issue. But by Q4, we'll get back to a normal baseline. But regardless of that minor glitch, that same dynamic has been seen in past quarters, growing our listens and also growing our ability to monetize those listens. And it should be said that podcasting is an under-monetized medium. So we'll continue to see that dynamic moving forward. Right, Ross, do you want to wrap it up?
Yeah. Okay. So last slide, a couple of recent events to kind of update you on. We announced a partnership with Crooked Media for international sales. For those of you who don't know Crooked Media, they produce some fantastic shows. They were founded by a chap called John Favreau, John Lovett, and Tommy Vita. And these three actually all served as staffers under Barack Obama. And they produce a huge network of incredible shows, basically, which are popular political podcasts, one called Pod Save America, Love It or Leave It, but to name a few. So they join us from an international sales representation. So we talked before about America being a very different model. You have a lot of local incumbents who do represent themselves, but actually now dynamic ad insertion has become the norm. What they're finding is a big chunk of their listens are international, and therefore they do not have sales teams internationally who can monetize that for them, creating opportunities for international sales partnerships like this. We do the same with TED Talks, PRX, and a few others. Next up was the British Podcast Awards, which was worth noting, which happened, I believe, back in August. There were 80 awards given out. You know, we have a dominant presence in the UK market, especially of the commercial podcasts. And out of the 80 awards that were given, 40 were awarded to Acast podcasts. And there was one award, which was the Podcast Champion, which is the ultimate award, awarded to a lady called Fern Cotton of Happy Place. And again, Fern hosts her show and monetizes her show with Acast. So we had kind of the dominant presence there. We rolled out our technology called Acast Plus. Acast Plus is our subscription technology, allowing creators to build their own paywalls. So if you wanted to release ad-free content, if you wanted to release, your super fans to subscribe for whatever price you wanted to, but basically access exclusive content on whatever platform they are, they can use this Acast Plus technology. We teamed up, or we have teamed up with a podcast called Hector and Laurietta. It's an Irish podcast. It does very, very well from an ad sales perspective. They launched with us and Acast Plus back in March, and they started to see successes where they would see 20% extra revenue on top of their ad revenue through subscriptions. They charge €7.99 for an extra episode every single week and ad-free. And what we've seen recently is they're now seeing on a monthly basis 59% or 58%, I think it is, extra revenue on top of their ad revenue. So this is a very additive medium. It doesn't cannibalize on our advertising side at all, and offers opportunities for our creators to earn more revenue from different sources. We look to roll out Acast Plus to in some form later this year. And then on the US scale and reach side, we've done an incredible job in the US. A way to look at that is to look at how we have scaled. So if we're the marketplace of choice for advertisers, we need scale and reach. We need to offer targeting and digital metrics to advertisers who want scale and reach, which is that big brand money that's moving across from radio to podcasting. So PodTrack is a unofficial but kind of a industry official chart within the US. We're not part of that chart. However, if you look at where we would sit in that chart, it gives you a good idea as to how we have scaled and what our reach is in the US. So, if you look at on a monthly basis, on average, 80 million Americans listen to podcasts. We represent 14 million. So we serve podcasts to 14 million Americans on a monthly basis. In that chart, we would sit comfortably at the number 3 spot for US reach, and we'd sit at the number 1 spot for global reach and scale, highlighting what we've built within our marketplace and the opportunity to continue to scale and grow that reach. And I think that is it.
Yes, it is. There we go.
Thank you very much. Thank you very much, Ross and Emily, for that. I mean, clearly you're having great success with strong growth in revenues, listens, monetization across regions, and the number of shows hosted with you. But I was wondering if you could elaborate a bit on why podcasters choose you instead of any of the other hosting services that may be out there.
I think it's a good question. Podcasting is, a global proposition. We serve, we represent, podcasts in, predominantly, 12 markets, but it's listened to in 150 plus, countries. So it's a very global proposition. And if you want to be fully efficient at monetizing that, you need to have local salespeople on the ground because, local advertisers are exactly who you need to target. They're not necessarily global. So for us, we are that proposition. We focus from an international standpoint. Also, as you look at the space and how fragmented it is right now, you need to have that independent player that is agnostic to any platform. And we are completely agnostic to where we distribute content to. So if you want, as a creator, the biggest reach and the biggest monetization opportunity and the biggest growth opportunities, you need to be on all platforms. And you need a simple technology, which is ours, which is a drag and drop technology and a simple click to monetize your show. So that's why people are choosing us, amongst other things as well.
Gotcha. Makes perfect sense. And then I was wondering if could you talk a bit more about your strategy for the US? Like what makes you stand out amongst the competitors there, and how will you win this market, basically?
A great question again. I think US is a very different market, like I'd mentioned in the presentation. And by a different market, if we kind of step back slightly, the US, unlike Europe, did have a commercial model within podcasting, but it was basically brands going direct to podcasters reading live those ads within those podcasts, essentially baking them in. We came along and disrupted that, saying, look, dynamic ad insertion is the norm. You should be able to now track your ads so you know exactly the impressions and uniques you're reaching to your media mix and your campaign. The brand advertising agencies that are piling into podcasting now and buying that reach and scale, that's what they demand. So now the market has started to adopt dynamic ad insertion as the predominant technology. What that means is, because we know that advertisers are local, or predominantly local, advertisers will say, I want a US only reach, please. Now, what we find is that between 15 and 30% of US produced content is listened to outside the US. So if you want to be fully efficient at representing that content from a monetization standpoint, you need to not only monetize it incredibly well in the US, but you need to monetize it well outside of the US. And that's exactly what we do. We released a stat a couple of weeks ago stating that our top 100 US hosted shows, 22% of their reach actually happens outside of the US. So the opportunity for us is to almost an outside-in approach and growing that international opportunity whilst also taking on those US sales. Also, US has a lot of local representation, i.e., publishers represent themselves in that market. So when you've got advertisers who want reach and scale, you've got a fragmented market of lots of small players. So they naturally then focus towards the marketplaces who can offer reach and scale and targeting and tracking. And that's, again, the technology we've built. The future of the space is going to be around programmatic and automatic buying. Also, how you can target podcasting in a more granular way from a conversational standpoint. So contextual targeting. We've built that technology. We're iterating on that right now, and we're scaling that, and we're seeing a big demand from an automatic basis. That's what we believe, that our strategy is the one that's going to win in this space.
gather that. And when it comes to content, I know you're going after both bigger names as well as smaller names. But do you have any like particular content signings of late to highlight? And also, I was wondering if like how do you go after when you really want to like get a head start in the US and sign some bigger names? How do you go about approaching these creators?
I mean, there's a variety of ways that we can attract content. You know, there is naturally we have a platform where thousands of podcasts are joining on a monthly basis, and they're automatically joining. Apologies for my dog barking in the background. But actually, if we look at some of the larger shows, which create kind of network effects and attract more creators, you know, we have more of a manual approach in how we approach that talent. So in the US, you know, recently we signed the likes of the Young Turks. We signed, you know, hundreds of new shows or thousands of new shows actually in the US. But I think I'd pick out the Young Turks as a really key one there. We're signing publishers as well as key independents. And again, once you start to sign key content that wants to grow in an open ecosystem, which, you know, a majority of all podcasts do because they want to get the biggest monetization opportunity and the biggest reach and scale, we start to attract new ones through those network effects that those bring. We see that in other markets. Look at UK, we represent, you know, 70+% of the commercial market and all the content there. In Sweden, over 50% of the market is with Acast. So that's the strategy we've had, and we're copy repeating that in the US.
Okay, and I think we have time for one final question. And sort of on that note, do you have any plans on sort of intensifying your marketing efforts in terms of marketing your own brand going forward? I get that your shows, they market themselves to some extent, and you can also market some of your shows on other shows that you host. But how are you working with your own brands, or particularly again towards podcasters?
Yep, you know, for us, it's about how do we aggressively grow that in each and every market, especially in the US. And, you know, how do we become more well-known and a more of a household name? So when you are a creator, you instantly think Acast. The key to that is using our creators. You know, our creators love our platform. We need them to talk more about that. So, you know, you'll probably start to see more noise around that from our creators, where you start to see the Acast logo on different cover arts as well. So we're getting our brand out there as much as possible. Plus, you know, from a marketing perspective, you know, the money we've raised, you know, we're looking at how we can start to promote our brand and how we do that through SEA and SEO, etc. So there's lots of ways we're going to start to market Acast. Em, is there anything you wanted to add to that?
No, I'd just say keep an eye out for those big business mags in the US and interviews with Ross over the coming weeks.
Okay, thank you very much, Ross and Emily. I think that was a really good presentation and a great way to end the day and this seminar as well, I think. So thank you very much.
Thanks for
listening in, everybody.
Thanks, Derek.
Cheers. Thanks.